Well, good morning, everybody. I'm not quite sure if here we go, there's the mic. So my name's Brian Quast. I'm a research analyst at BMO Capital Markets, based in Toronto. Have an Australian accent, but don't hold that against me. We're just going to go through a whole bunch of things here today. Today's session of 3 hours is going to be in approximately 3 sections. The first section is basically on valuation. How do we look at mining stocks? The second section and the largest section is the basically how we look at mines in general. For those of you who haven't spent much time on the ground in mines, this is to give you more an overview of the terminology that's used, some of the key things that we look at when we analyze companies, and some of the things to look at for investment decisions. And then finally, and probably a little bit out over my skis here, I'm going to go through some of the work that our commodities team has put together in terms of commodity price estimation and modeling. So that's pretty much what I just said. Oh, I guess I'm standing in the wrong spot. So going through first on the valuation and the stock selection, you can see that there's a bunch of different ways that we do this. There's a quick and simple way that most people would be familiar with for pretty much any stock. And then there's some mining specific methods, some fairly simple multiples. And then what we would call the intrinsic methods, which are very specific to mining and have some sort of intricacies. And each one becomes progressively more complex and takes progressively more work. This may be familiar to many of you in the investment space. This is what we would call the Lassonde curve. So this is basically a stock price, shareholder returns. Here we have sort of the initial speculative drill holes going to initial resource, going through technical studies and initial reserves, starting construction, and you see that typically from construction commencement to first production, there is a bit of a fall off in share price before we get to the positive free cash flow, shareholder returns and expansions. So this is, like I said, the Lassonde curve, named after Pierre Lassonde, probably most familiar to you guys from his days at Newmont and Franco-Nevada. You can see here, this is where we look at the different types of modeling as well. So the quick and simple model, this is just a very straightforward way to look at everything. So we have numbers up here, we've got gold production, we've got a gold price estimate that you've put in, calculate the revenue, calculate the unit costs, usually based on some sort of comp, and then we get an implied target depending upon what multiple we use from the calculated EBITDA that we've got here. So bull case, bear case, base case, you can see here that what we would end up with is a $60 share price target. So if the stock is trading at $40, it's something that you may be interested in. Cool. In a more detailed way, I think many of us would be familiar with how to do a DCF. So we have all of the different assets here for whatever company this is. We've built up a DCF. So DCF is discounted cash flow. So we need production, we need recovery, we need grades, we need the mine plan, we need CapEx, we need sustaining CapEx, we need a mine level income statement, mine level taxes, corporate level taxes, and then pull all of that through. Put some others in here for exploration projects, and a lot of times in here is where you would put your hedging and all of these bits and pieces here. So in this case, we've taken a whole series of mines and come up with a $21 billion net asset value and a $44 price target. So here's a case study. Some of you may be familiar with a company called Lundin Gold. Lundin Gold, obviously part of the Lundin family. This is us showing what the Lassonde curve looks like played out in real life. So here's your gold price, which has generally been in the positive trajectories over the last couple of decades. And this is, well, this used to be Fortress Minerals, so this is sort of a shell company. They acquired Fruta del Norte, which is an asset in Ecuador. It was widely known before acquisition that it was a very good asset, but Ecuador was a little bit problematic as a place to operate in. Then we have the build-up here through the technical reports, several permitting milestones, financing, mine development, and then optimization. And this stock, well, that is now, the market cap of this stock is now, I think, about $18 billion. So it's sort of gone from here in 22, it's gone straight up to the right. It's about a $100 stock now. What do we look for? The more qualitative aspects. Credible management, so in the case of Fruta del Norte or Lundin Gold that we were looking at before, Lundin Group, Ron Hochstein was the CEO, well known in the space, so check that box. Sound corporate strategy, they had good relationships with the Ecuadorian government, and they were building Fruta del Norte as one of the best assets there. They were always well backed, so even when their balance sheet was less strong, there were people behind it that were able to supply that. Deliverable growth options. It was going from no production to production, therefore there was good growth. Relatively lower risk, that was a little bit more iffy, particularly at the time with Ecuador, and reasonable valuations. I would argue that's probably not the case at the moment, but at the time it certainly was, and it definitely paid off over the last decade or so. So there's two ways that we can have the formation of a larger mining company. We can either have a mining company that buys mines. So here you would see each one of these increments that's added is a mine that they've bought, or you have a mine builder that has ramped up different mines as they've gone. Companies tend to have a reputation as one or the other. They're either good at buying other companies, seeing opportunities and bringing them into the fold, using their stronger balance sheet, using their technical expertise, or they have a good corporate development department and they're good at, other way around. These guys are good at building mines. B2Gold would be a good example of this. Buying companies that would be more of something like, let's say, a Kinross. When we're looking at M&A in the mining space, one of the ways that we do it is total cost of acquisition. So what you do is we have models on thousands of mines at BMO, so we have a pretty good idea, even if we don't cover it, sort of what we're looking at in terms of operating costs, sustaining capital, and growth capital. We build those numbers up, we take the spot price of gold, and when we've taken all of that together, we end up with the total costs as a percentage of the gold price, and you can see some of the bands that come up over here. So this is a bit of a promo piece for us. We have quite a few mining research products. I'm not sure this is of interest to everybody, but these are some of the things that we do, and please feel free to reach out to us. So maybe I'll just take a quick pause there if there's any questions on valuation. I know we went through it very quickly there. Happy to discuss any of the sort of techniques of building out a mine or a stock valuation. Or try to stand in the right place to not get the feedback. If that's the case, maybe we'll just plow straight ahead. So here's what we're going to do for geology and exploration. So this is sort of the nuts and bolts of the mining 101, if you like. We're going to walk you through how to get from a blank piece of dirt to a fully operating mine, what happens, what to look for, who does what, and some of the pitfalls along the way. This section here is just going to be on geology and exploration, and we'll move forward to mining and metallurgy after that, and some of the more the softer things with environment and permitting and the like as well. Should preface this by saying my background is as a mine builder. I started off with BHP. I guess my claim to fame is I started the oxides at Escondida, but worked around the world building mines, and then went over to the brokerage side after picking up a law degree for some reason. So here's what the Earth looks like. Any of you that have done high school geology or science, you'll see this is the Earth, solid, liquid, and up here. We only operate in the very top part of it here. It's too hard to get down into the bottom part. And what happens is we have minerals and rocks sitting up the top, what we're standing on today, and that top crust can move as a slide, or it can move as a fold. So we have anticlines, synclines, and what ends up happening is what we're doing here is we're looking for ways to concentrate fluids that are coming up from the center of the Earth. So what happens is you have water. Can be from the ocean, it can be from rivers, it can be from rain, but it's essentially water that has made its way down into the lower areas of the crust. It has dissolved things as it's gone through there. It is now under pressure and it's at a relatively high temperature, and it's kind of looking for a way out. So as it's looking for a way out, where it likes to go is these weak points on the faults, or it preferentially deposits on these folds. That's where we go looking for mineral deposits. This is probably a whole bunch more information than you need in terms of subducting plates. So for those of you who don't know, when it's loaded up with seawater, it tends to be heavy, so it slides down. And as the oceanic crust slides down, it pushes up mountain ranges here. And that's what you see with this ring of fire. So that's basically going around the Pacific plate. And you'll see that a lot of the mineral deposits that we know today are on the Pacific Ring of Fire. Think of that as a place where there's a lot of volcanoes. So you've got a lot of fluids coming up through the crust, and they're pushing up mountain ranges. And as they go through the ones that we were looking at before, some of these areas here, those fluids are being pushed up, they're being concentrated, and they're becoming mineral deposits. So, listen, there's a lot of information in here in terms of different ways to do it, and you'll also see, sort of closer to where we are standing today, there's also some, historical plate boundaries that have deposits formed in them as well. So the one that we're going to walk through today is one of the more common types of deposits in the world. It's a porphyry deposit. So what we have here is we have a hot lava type of hot rocks through here, and what ends up happening is you have fluids that are being pushed up because you've got the heat being pushed up through here. You've got a volcano. It may be a volcano, it may still just be under the ground, but generally there's an outward expression here. And as all of these fluids come up, they push up and they're trapped as they go from a higher temperature to a lower temperature. Think of having a cup of tea with too much sugar in it. As it cools, the sugar deposits down. So what we're seeing here is a precipitation of those minerals that make up a porphyry deposit. So in this case, the porphyry deposit, let's see if we can use so porphyry deposit is actually going to form just up here. And what's going to happen is you have lots and lots of fluids coming up. You have this area here where everything is depositing, and these tend to be fairly large and fairly uniform. So your big copper porphyries include things like Escondida. They tend to be copper-centric in terms of the more economic ones. So you can see here we've got copper, moly, gold. Obviously, with the gold price where it is, it has become a much larger portion of what people are looking for, but these are generally known as multi-decade, very large deposits, generally require quite a few $1 billion worth of capital to get to. And over time, what can happen is these erosion comes down, and you can have them exposed to surface, which is why they become very large open pits. Generally speaking, trying to mine down under an active volcano is a fairly bad idea because it's quite warm. So you can see some of the typical grades here. These grades are particularly getting lower because the copper price and the gold price are moving up. And here's some examples. So Bingham Canyon in Utah, El Morro in Chile, KSM in British Columbia, Pebble in Alaska. And honestly, they're pretty easy to find. I think there's a slide coming up that you'll see me just walking across a porphyry. You look down, it's a porphyry. Your foot's on it, you can see the veining. Basically, you're looking at sulfide veins in some sort of a weathered host rock. So now we're just going to walk through how they're found, what you do with them, and how you progress them to the next stage. So the first thing you can do, well, first thing you need to know is that there's a lot of different ways to start looking for things. Some of them are non-invasive. Some of you don't even have to put boots on the ground. So in this case, you've got spectrometry. You can do a lot of, there's a lot of different gravity, IP, and these types of surveys that you don't have to put a hole in the ground. I tend to find that if a geologist comes into your office with a map showing, a whole bunch of very pretty colors, I can't read it. I don't really know what they're showing, but where the change in color is usually what they're trying to highlight as a prospective deposit. And the one thing to be aware of is that depending upon what scale you're using, there's always anomalies. If we did a survey of this room and we were looking for the highest concentration of white, obviously it would show up as these desks. But depending upon what filters we put on, perhaps some of the green would show up. So it's a matter of what scale is used, and these can be very misleading. It does tend to be very iterative, so you'll go in and you'll do one form of mapping, then perhaps you go and do geochemical sampling. So you'll have generally a bunch of young people that are very fit, wandering around, picking up little grab samples, and they're going to be looking for not necessarily the mineral that you're after. So, for example, picking up gold is a little bit challenging, but you'll look for things like bismuth or antimony that are in larger concentrations, but hint at the fact that there may be gold associated with them. So remote sensing, like I said, non-invasive. Mapping and field work, that's boots on the ground, walking around picking up samples. Geophysics, that's more people walking around but getting changes in sulfide to oxide, changes in density, changes in various other things. And then we start putting in a drill. There's two predominant types of drilling. We'll get to this in a minute. RC, which stands for reverse circulation, and diamond drilling. And then geochemistry, which is getting a picture of what your prospective mineral is hosted in. And this can go for several years. This is probably a 3-year process in most cases at least. And you continually do it for satellite deposits as well. So here's the two types of drilling. We have reverse circulation, we have diamond drilling. There's a couple of bits and pieces that you need to know here. So reverse circulation is basically you take for lack of a better description, a hammer on the end of a stick, and you start putting it down into the ground, and what it does is it makes a whole bunch of rock chips in a hole, and you flush those up to the surface, bring them up. It's very useful for a couple of reasons. Number one, it's quick. Number two, it's cheap. Number three, and very important, particularly for a lot of porphyries and environments like this where there's very little water, it doesn't require water. It is somewhat depth limited. You probably can't go much beyond about 350 meters of depth, but it's very good for known deposits, working out where everything sits in an open pit scenario, or just scout drilling, if you like. The reason that we move across to diamond drilling from RC drilling, and diamond drilling is by far the main thing that you see in press releases, is because when a diamond drill goes down, it takes a whole tube of rock. And that whole tube of rock gives you a lot of information. So you can imagine if this was an RC hole, it'd just be a bunch of chips. And it'd be like this section of chips, this section of chips, this section of chips, and it'd be all mixed up. Here we can see what they call the fabric of the rock. We can see that these rocks, the ore things that we're interested in, are moving this direction. We can also see the banding. We can tell what the mineralogy is. It's more expensive. It's about 5 times as expensive. It does require water because you have to flush it with compressed air and water. But it can also go much deeper. So this is particularly useful for prospective underground deposits. Just going to introduce an important concept to you for when you're looking at these press releases, in that true width is important. So in my experience, when you're looking at a press release, if it doesn't have an estimated true width associated with it, what you're probably looking at is what we would call a director's special. So when you're getting ready to go in your boardroom, you're going to ask for some more money to do some more exploration. Typically, you have an idea where the deposit is. So if we say that the deposit goes like this, you would want to be drilling like this. You want to be as perpendicular as possible. It gives you the most information about the true width and what mining's going to look like. But if you want it to look really snazzy, you come down, you shoot straight down the middle of the deposit, and you end up with a very, very long, high-grade intercept, much better than what the mine will ever be. It is useful for other contexts, but it's mostly a promotional tool. If you do one of these holes that goes straight down the middle of the deposit, sometimes you're doing that for metallurgical testing, because that's a way to get a homogeneous sample of a rich part of the ore body. So here you go. So steeper structures are more likely to be overstated. So steeper, so shallower to steeper. So if you're like this, you don't want to have a drill hole coming from basically flat coming in there, because you've spent a lot of money to drill those meters to come in from here. So what ends up happening is, as you work out the deposit, that may end up becoming a problematic thing. So you can actually do mathematical calculations. It's a fairly straightforward Pythagorean theorem. So here's where we go for the capital intensity. So once again, it's our life cycle. We use this quite a bit. So this is your junior company, first on the ground. They're in the middle of the jungle, they're in the middle of the desert, they're out in the tundra, wherever they are. They are wandering around. They've seen some things on often a geological survey that they think are interesting, or that there's something analogous to something else in the area. They're starting to get in here. This is relatively cheap, but there's a lot of these companies. Hopefully they find something. So when they find something, that's actually typically when your highest profitability as a shareholder comes in. So there's speculation on there. People get excited. They're like, oh, we found this deposit. We're going to bulk it out. We're going to look at it. And then you've got the full discovery here. And then we go into sort of the boring part. Let's see how big it is. Let's see what grade it is. Let's see what the economics look like. Let's put out technical reports. Let's do the permitting. Let's do the environmental baseline, do the social engagement. Let's do all of that. And then here we get to sort of the clients that I mostly talk to, the institutional clients, and they're putting money in to make it become an operating mine at the end of that permitting and drilling process after some technical reports. So you can see here's sort of the reports that you'd be looking at as you go through here. So we have a fair bit on QA/QC. For those of you who are old enough to remember it, and I guess I certainly am one of those now, one of the biggest controversies in Canadian mining, and a lot of finance is raised in Canada for mining, one of the biggest controversies was the Bre-X deposit. A lot of it was around quality control. So this is about the instrument calibration, but we'll go through sort of why it's important to have good custody and why we have the framework of technical reports that we do now. It's basically designed to prevent fraud, because Bre-X was, I think it's quite easy to say right now, was a massive fraud on the market. And that's when all of these came in, was the late 90s. So you can see these are some of the results, and we do, this is calibrating your instrument. So let's think about it on its most simple form. We have a bag of dirt that we've pulled out of a drill hole. That bag of dirt has a lot more material in it than we need for just a simple sample. So we will take one of those samples, or several of those samples in a row. We'll measure them, and we'll have a whole series of results. Then we'll duplicate them. So that's where you have high precision, high accuracy is when your duplicates are the same grade. When you have low precision but high accuracy, you can see there, is where there's a bit of a scatter. So that bag has like a fairly variable amount of grade in each one of the little rocks there. This is where you're a bit off, and this is where you're way off. So, and you can see all of these in the technical reports that come out. This is the chain of custody that I was speaking to before. So you have, there's procedures that are actually governed by law nowadays. It's to minimize the risk of sample tampering or salting. So there's a couple of ways that you can, I guess, perpetrate a fraud in these ways. You can either sprinkle some gold. So I spend most of my time with gold miners. You can sprinkle some gold on the assays and make them look pretty good. There was one case, I guess, late 90s, early 2000s, where the CEO was getting all of the assays through his desk, and he just moved the decimal point over 1. So that made it look quite good. So what you'll see here is JORC standards, NI 43101, that's sort of where we stand. You come out with a couple of 100-page report. It has a lot of this type of information in it that is really, really unnecessary until it's really, really necessary. So this is what we're talking about in terms of resource estimation. So here's a series of drill holes. And we've got diamond drill holes here. These are your assay results. So these are the grades that we found. So the red areas are the bits that we're interested in. But this has actually happened quite a few times in history where people generally doing the right thing have interpreted the ore to look like this, because this is the only information that you have, is these holes here. What you can end up having is, instead of, when you get underground, instead of it being this big tabular ore body, it's just a series of stacked lenses. Mining this is very different in both technique and profitability from mining this. So basically what you have to do is try different angles, do replicate twinned holes, there's a whole bunch of things you can do to prevent this, but even today this does happen on occasion. So I don't know how many people here know Smarties or M&Ms, but I guess we've BMO branded some of them. But what we're trying to do here is, remember my analogy, looking for the amount of white in the room? Here we're looking for red Smarties. Are the red Smarties evenly spread through the box? Are they localized in one area of the box? So here you can see it's a fairly general distribution, so that would be a more disseminated deposit. Disseminated deposits aren't necessarily bad. They do tend to be lower grade, but they're also much easier to mine because they're in bigger zones. You can do cheaper mining methods. So that's why we're looking for these red Smarties here. Now, if we have continuity, that would be a string of red Smarties coming through, let's say. And then we would only have to mine that part, and we could leave the rest behind, which is also not mining waste is as important as mining all of the ore. So this is a little bit out beyond me because I'm not a geologist, but these are some of the different ways that we do the resource estimation. Generally comes down to a wireframe model, out to a block model. It uses a program called Leapfrog. These days the computing power is a lot more than when I started, when it was just a bunch of guys drawing on sheets of paper. But you end up, typically you'll see these types of things in most working mines, where you know where the high grade is, you know where the various, they're called mineral domains. So within a given deposit, the metal that you're most interested in can be in different formats, if you like. So you could have gold in sulfide, and you can have gold in oxide in the same deposit. And that might be because of weathering. So at the top, you've got oxide. Down below, you've got fresh ore or sulfide ore. So you would have it modeled that way. You could say that some of this ore is higher in copper, which can be a problem if you're using cytidation for gold. But there's different domains here. And this is probably the most important part for understanding when people are coming in and looking at stocks. It's understanding the relationship between resources and reserves. So you've got your exploration results, and so you'll see here we've got this. We've basically turned this into a resource model. So we know where the high grades are, we know where the low grades are, we know where the ore tends to go. And at a certain drill density, so if we just stuck 2 drill holes in this room, we wouldn't know exactly how much white tabletop there is. But we'd have a decent guess out of the 2 drill holes. Maybe that's an inferred white table resource. Now, if we then put 2 more holes in, we got an even better idea where the white tabletops are. We're in either the indicated or the measured category then. Once we've done a pre-feasibility report, so that has economics for capital, for operating costs, and it has all the development costs and operating costs associated with it, we can then move a portion of these resources into reserves. So you can go from indicated to probable, you can go from measured to proven. You can also go backwards, but the goal is to move as much of this to here. And that often does require a little bit more drilling density, but when you go from here to here, it's an economic decision. It's not necessarily a higher density of drilling thing. We understand what the economics of this look like. So here we go. This is sort of the overview of what the investment process for an exploration company looks like. Management, always key. Do they have experience in these relevant deposits? So if you've got a bunch of guys that have come out of a big copper company like a BHP or a big iron ore company, and now they've come to you with a tiny little epithermal out in the middle of Mexico trying to explain about a silver mine, probably not the guys you want to go with. Do they have a discovery track record? There are I think the statistic is that 98% of the world's deposits are found by 2% of the world's geologists. So discovery track record is important. Goal alignment. This seems like motherhood and apple pie, but what that really means is, do we have geologists that just love being out in the bush, or are they really going to, and they're just going to keep drilling this as long as you keep giving them money to drill it? Or do we have people that are willing to progress this either by a transition of management from a geology-based management team into an engineering-based management team, or are they going to sell it and go on to the next thing? It's important to know what their goals are and make sure that they meet your goals. That's what generates the value. So they get cash when they give you an exploration plan that makes sense. So I think we put hundreds of deposits here, but I would say that that's probably hundreds of thousands of prospects. You then delineate the target, say $1 million or so. You've got then drill testing, so now we've gone from that flyover, maybe walk around a little bit, take a few samples, to actually putting some drills in the ground, and then we've got to 5 targets, build out the resource up to $100 million. Putting that into a reserve is another $200 million sort of at minimum these days. So this is we're going to go back through that whole technical reporting process because it is, from an investor standpoint, one of the more important parts of this. So a preliminary economic assessment, usually your first kick at this. So you got some drill holes, you got some ideas, you think you've put together a deposit, you can do it internally or you can use third-party engineers. I think there's a few wandering around out here. And you'll have the processing route, the mining method. You can use some comparable examples to then go forward and make some estimates. And we're talking like sort of plus or minus 30% on the cost estimates here. You'll have some idea where you're going to put the mill, but maybe you haven't done the geotechnical testing to be 100% sure yet. It's important to note that while this is generally your first step, number one, it's not always done. And number two, it can be done on existing mines. You can actually go back to the drawing board in a change of metals prices, which has been happening more and more often. It can happen as an expansion plan of an existing mine. It can be just another company coming in and wanting to have a revisit of, what about if we mined this in a different way? So you can see the cost here. 1 or 2 people, 1 to 6 months, in and around $500,000. That's what it takes to put a PEA together. About 10 years ago, the SEC/Toronto stock people basically said you're not allowed to use this as a funding document anymore. There were, and still are a few cases, but there were many cases where companies would come by and say, listen, we've done a PEA, so we've done a preliminary economic assessment, but it's at a pre-feasibility level. We just didn't have X or Y to make it truly a pre-feasibility level. There were a few companies that did this that ended up being massive failures, so the governing bodies have put a stop to that now. Pre-feasibility study. This is the study that we were talking about where we can move resources to reserves. This is the only way you can get a resource into a reserve. So it has a full mine plan, it has processing rates, it has not necessarily full permitting, but it has a pathway to permitting that is defined. It has market studies, so that's very important for those that are producing a concentrate. What does that concentrate look like? What are the penalty elements? And you have, like I said, the full capital operating cost metrics, and you've got a sensitivity and a financial metric. So this is like the prototypical 43-101 document that you would be looking at. You can see that we've got a much higher cost now. I believe the Pebble PFS cost about $500 million, as an example. Teams of people doing environmental, metallurgical, mining, geology, tailings disposals, and the like. And it takes 6 months to over a year. From here, this is where the bankers get excited, particularly the guys that do corporate credit. So this has everything a pre-feasibility study has. So this is generally considered to be about plus or minus 15% on the costs, down to sort of a plus or minus 5 to 10%. This has all of the above here on a much more detailed level, and this is what you, I wouldn't say need, but it's almost a prerequisite for getting credit. These are for equity, these are for credit, is probably the easiest way to think of it. So once again, wanted to use a different way just because it's so important to go through how a resource becomes a reserve. So you have this ocean of resources here, which has a subsection of reserves. And like I said, you can go between the two. So how feasible is it that it'll be economic? Is it in a, I mean, you can have a resource in a place that you can't really have a permit. So that's not really mineable. It's still a resource, but it's not mineable. A reserve has to be mineable. So think of under a conservation area. It's quite challenging. You have and like I said, this is measured and indicated, this is proven and probable. So you also have a degree of geological certainty. So if we were to say that here is the indicated resources and here is the measured resources, what that would mean is that we have more drill holes in here than we have in here, in this subset of data that we're looking at. And so those measured resources can become proven reserves, and those indicated resources can become probable reserves. Outside of this is the inferred basket. So I am seeing it more and more often these days in reports that they are lumping everything together in what's called a mineral inventory. Theoretically, that shouldn't be able to happen, but a mineral inventory would be your inferred plus your resources. And in Australia, they have a potential categorization that doesn't make a lot of sense to me at all. The other thing to know about reserves is that going from resources to reserves, you have to incorporate dilution. We will get to that in the mining stage, but typically speaking, if we were to mine this whole room, not all of it would be ore. We're only after the white tables in this case. So a lot of this stuff is going to be waste. So a resource, let's say we've drilled it out very carefully, we know exactly where the white tables are, but we know that our mining method has to take this entire room. The reserve would have a diluted white table grade incorporating the amount of waste that we have by taking this whole room. So this is actually, for those of you familiar with Agnico Eagle now, but this is the old Detour pit, and it's an illustrative one. You can see how things come together here. We have a starter pit and then various stages. And we will go through this in much more detail in the mining section, but this has the reserves. We also have, we've got sensitivities, because there'll be another table here with a different cutoff grade. Cutoff grades are important because you've basically used in this case, gold price assumption to say that above that grade, it's ore, below that grade, it's waste. That's becoming more and more problematic as the gold price basically doubled in the last 18 months or so. So things that would normally be considered waste are now, I guess you could call them, it's now called mineralized waste, I guess, and it'd be stockpiled separately. But here's a typical mine plan. So we've got, this is quite old now, this mine's been changed quite a bit since then, but we've got 17 years of mine life. Here's our cutoff grade. We start high and we go lower. And so you can see the head grade starts high and goes lower. So everything above 0.7 is ore and goes to the mill. Everything above 0.5 here, and then that's what derives these numbers here as you go through the various stages. And the material that is above 0.5 but below 0.7 in that first 3 years gets stockpiled and then put down into pushed into the subsequent years. One of the other things that we'll be able to go through in the mining section as well is what a strip ratio is, but that's basically the white table to room size, so it's ore to waste ratio. So once again, just sort of wrapping all of this up, pre-discovery, that's somebody on a donkey, on a helicopter, walking around, has found an outcrop. You often hear them talk about finding an outcrop. So typically, I guess the most recent deposit that I was at that sort of strikes me for this would be somebody was walking along a river, saw a rock that bore a distinct resemblance to something that would be a gold ore. They took a hammer, hit this piece of rock that's sitting next to the river. Sure enough, it was mineralized. They said, and then they used that and a couple of other bits and pieces to say, we're going to stake this ground and going to raise some capital for it, and they're just going to understand what that is. Then you go initial discovery, you've got your first drill holes going in now. So now you've walked around a bit, you've worked out where the high density parts are, you've worked out where the high polarization parts are, you've worked out where your geochemistry is, and you're looking for potential structures. So you might have, the size of this conference center, and we're just looking for white tables. So you have to come into this room to find a white table. Let's just assume there's no white tables out there. So they'll be wandering this whole conference trying to find white tables, and it's not till they get into this room that they're now going to raise capital to find white tables. And then we go pre-resource, so more drilling, and this tends to be a 3 to 5 year process depending upon the size of the deposit and the complexity of the deposit. And we'll start to know, how big are these white tables? What orientation are the white tables? Are there more white tables in another room? That's where we start to really get a feel for what this is going to look like as a mine. And then we've got a resource, and we're going to then do infill drilling. So we're going to put more drill holes in to get more certainty on where the white tables are. And we're going to do expansion drilling to find out if there's more white tables elsewhere, because we now have an idea of what forms the deposit. So if you remember where I went back before, at the very beginning, we were talking about folds, we were talking about faults, we were talking about all of those things. Once we've found sort of a prototype deposit on our property, we then look for analogous parts of the property that will have either a continuation of the fault or a splay fault or another place where those same fluids could have come up and been trapped to become another deposit. So here's the cutoff grades. This is the really tricky thing. One of the most valuable tools you can have in your toolbox as an investor is when you're looking at drill holes, is a grade times thickness. So typically in gold, that's a gram meter. So if I told you that I have a 10 gram per ton 1 meter width, or if I had a 1 gram per ton 10 meter width, you would be agnostic, basically, on which one you took as an investor. And the reason for that is because taking 1 meter width is a lot more expensive, but you've got the grade to do it. You've got that 10 grams to do it. Taking 10 meter width is a lot cheaper, but now you're only playing with 1 gram per ton. So your revenue per ton that you're getting is lower. So on that basis, basically take everything, and that's why that true width that I was speaking about before is so expensive, is so important, is because if you have the true width and you have the known grade, you can get a feel of the profitability of what that deposit is going to be. Another thing to be aware of is, particularly in underground scenarios, a lot of times, I see this a lot in Canada as an example, where you have what's called orogenic. So you think of your greenstone belts. You have the Abitibi belt in Canada, you have Kalgoorlie down in Australia, you have actually up here you have the Nubian Shield as well, but you have Guyana and West Africa as well. But what you have is typically large deposits that can go very deep and are not especially uniform, but they have some very high-grade portions, and we're talking hundreds of grams per ton gold, whereas the actual deposit itself is probably like a 4 or 5 gram deposit. So if you allowed that hundreds of gram assay that you've taken out of a very small part of the deposit to then play out through the statistics that you do as you work out what the average grade is, you'll end up with a very highly skewed number. So they do what's called grade capping. It used to be really simple. You used to just do it 1 ounce per ton, so 31 grams a ton. Anything over that was designated 31 grams a ton. You go on with your day. These days they have multiple indicator kriging, which uses a lot of geostatistics. And they have essentially multiple caps. And they're typically under 100 grams per ton, though. It does make for positive reconciliation when you get underground and start mining it, though. So it's a two-edged sword. Basically, when you're looking at deposit estimation or resource estimation, you want to cap it, but when you're underground and mining it, it can give you positive reconciliation to what you had capped in the past. So once again, our chart: discovery, engineering, production, and then revaluation. I spend most of my time talking to people about here. Most of the people that are much wealthier than I am, that like to tell me how wealthy they are, they made most of their money over here. And this tends to be a very sleepy part of the curve, but it's the part that makes our bankers very happy because that's where they raise all the financing. I'm just going to pause there if there's any questions on geology. Let's see. Oh. Okay. So once again, we're now going into mining and metallurgy, definitely closer to home for me. I am a metallurgist by training. So technical studies, we've gone through this a few times now, and each development stage unlocks a different portion of value. As you progress from that guy out in the bush knocking chips of rock off of another rock, all the way through to an operating mine, you get different groups of investors that can come in along the way here. So that can typically enhance the value, and it also allows each progressive stage to trade in and out of a stock. And there's internal and external risk. So internal risks would be, is the deposit really there the way we think it's there? And external risks would be people tying themselves to trees or blockading sites. As per usual, we have to put our usual promotional material in. So this is how you build a mine. This is what we used to do. Exploration, we just went through that. So we go from exploration, then we go to engineering. So like I said, preliminary economic assessment, all the way through to preliminary feasibility study and a full feasibility study. That's where we choose how we're going to mine. We choose how we're going to process. We've done the reserves now. We've got the economic, and we've done the numbers as well. So we go through here. Sometimes we go back. Sometimes we're like, well, that's not really good enough. We have to go back and do some more drilling, or actually maybe it's not good enough, let's get rid of it. But so the next step from there is optimization. So this was good. This is a good first cut at this. But what about if we mined it this way? Or what about if we added this to the processing flow sheet? What about if we did this or that? So we've optimized it. And this is also for on a mining stage, particularly in open pits, but also in undergrounds. Sequencing your zones to maximize your net present value is also very important. So then financing, construction, commissioning, and all of that funnels into commercial production. Now, when you're in commercial production, as I mentioned before, you're still doing exploration, you're still doing engineering, you're still doing optimization. A mine that's 10 years old often doesn't bear much resemblance to what you were originally planning to put in, or indeed what you actually did put in. But this is your general process. And like I said, you go around and round and backwards and forwards between all of these throughout the life of the mine. Even at the mines, when the mines shut down, there's ways to optimize the shutdown in a more profitable manner. So first things first, geologically sound project. So we just went through all of the geology bits. Like I said, we went through in a rush. I should preface this by, this used to be a 2-day course. We're trying to compress it down to three hours, so I'm speaking very quickly. We now think that we have a deposit that can be mined. And then here's the risk. So, if I'd have showed up as or if a company had showed up to my office with a $3,000 gold price in their estimates and a 5% IRR, I'd have laughed them out of town 2 years ago. Right now, it's not looking quite so silly, but optimistic commodity price assumptions, they can come true, but as a first cut, you want some conservatism in there. Unreasonable operating and capital assumptions. So, on average, the mining costs, if you like, at the moment are averaging about 3 to 5% inflation. Some areas are sort of more like 4 to 7%, but 3 to 5% is a good number for things like labor inflation. Of course, you have foreign exchange and stuff like that, but we have enough deposits around the world of enough types that we can get a fairly high degree of confidence using comparable other deposits that are in operation to sort of be able to truth test these operating and capital assumptions. If somebody says that they're going to put a 6,000 ton per day mill up in the Arctic for $500 million, you'd be like, well, I don't know how you're getting it up there. You've obviously not used travel costs. So this is what we're trying to get to today. And we're not going to get to where we're all mining experts or metallurgy or geology experts today, but we're trying to get to, here's some of the fundamental concepts that go into this. Many investors and almost all operating companies have independent technical reviews. I would say that at BMO, one of the slides that we've taken out, we have, I think, 15 analysts in research with 100 years of industry experience, not brokerage, but actually industry experience. We have, I think, 40 or 50 investment bankers, many of whom have industrial experience. But we also have third-party consultants that we bring in just to make sure that before BMO either puts money in or does a deal for a company, we've had this tested by people that are outside of our space. So independent technical review, and there are quite a few consultants that can do this for many investors. The other thing to look for is management experience, and that, the longer you spend in the space, the more people you work out you want to invest with or you don't want to invest with. So here's all the different types of financing that you can have. Here's permitting issues, and now we're into the mine design section. So it's going to repeat a bit of the stuff that we went through before, but in more detail. So this is in the Philippines. So this is the Masbate project. So in Q4 2008, it was a historic mine, so you can see some activity, mining activity here. It's on Masbate Island. This is actually a big harbor over here. You can see it's overgrown. There's not really too much that looks like a mine. And this is the same picture in 1 year's time. And you can see there's the plant there. So this is, we've got a resource, we're raising money, we're going to build something. We've got a mine, we're operating, we're generating cash flow. So once again, that iterative process we're talking about here, maximizing the financial return. I guess it says here, the challenge is many sets of results. It's many opinions on the same results is probably the way I would put it, but nevertheless. And this was a company called CGA. They were not particularly flush with cash. So they did things in a cheaper way than a large established company with other operating mines may have done things. ESG in the Philippines, this one was fine, didn't have too many issues, but Philippines has been challenging in the past for ESG matters, and that could be environmental, seismic, health and safety. I mean, some of the risks here are just, where do we get miners from? That's actually one of the biggest challenges these days is very few people that are, my kids are all in university right now, and none of them are doing mining. So there's just not people that are going into mining. As you might, I think most people will be aware, there's two types of mining, open pit and underground. So when you're open pit, you're out in the open. So you have environmental factors, you have rain, you have basically the hazards of working in an open environment. I sit in Toronto, and about 8 hours north of me, there's a whole string of open pits. It gets pretty cold up there, and people always seem to be surprised. I don't really know why, but it gets cold up there, and sometimes that could be a challenge with mining. Now, many mines operate successfully in that, but it's something that you have to deal with and plan for. There's mines in Papua New Guinea. It rains there. People forget that it rains there and forget how much it rains there. And that can be slippery for trucks. If a truck goes over the edge, your mine may be down for a day or two. So that's some of the things, but some of the good things are that you're out in the open. So if something goes bang, like something comes flying off of a drill rig or off of a truck or something like that, it's less likely to hit a person. So on average, the safety record for open pit mines is about 5 times as good as the safety record for underground mines, just because you're in a contained environment. So you have a lot more room for bad things to happen and not hurt anybody in this scenario. The sort of another negative, and we'll get into this a little bit more when we compare open pit and underground mines, not all of this pit is ore. Actually, a small fraction of this pit is ore. So you have to take the stuff that is not ore to get to the ore. So back to the analogy of this room with the white tables, we have to take this whole room to get the white tables. Now, as you get deeper in there, you have to keep pushing this wall back, because you can't have vertical walls, because they'll just fall over. So we have to have what's called a slope angle, and that's designed using geotechnical drilling, so that we know what that angle is that will not slide in there. And we want that as steep as possible to reduce our strip ratio, but we want it at a level of safety. And we also need a plan to have ramps getting in there. You can see this is where the trucks go, through here. And we also have to have plans for water, to get rid of the water in the bottom, because we don't want to make a lake until after the project is well and truly done. So here's some of the key sort of schematic here. So we have a working bench. So that's where there are drills putting in explosives, and then the explosion happens, and well, that's up here, and so there's your muck pile, and then you have a big excavator loading things onto a truck, and then the truck takes it up to the mill. The ore recovery is a bit different in an open pit than it is in an underground scenario, because some of the ore that you know would go through and would be profitable is just, it's made unprofitable by the amount of waste you have to remove. So if I have 1 gram per ton ore and it costs me X amount to process it, if I have to then take 10 tons of waste to get to that 1 gram per ton, it may not be profitable to run through that mill at the costs. So here's the steps. Drill, blast. There's your excavator loading into trucks, and there's the big trucks that everybody gets excited about watching them coming in out of the pit. There's a whole science devoted to all of these bits and pieces. Like, so blasting, there's a couple of companies that are very good at it. There's a lot of finesse that's involved with blasting. So we're going to get to this in the processing section, but if you can imagine, this is the cheapest crushing you can do. So the more holes you stick in and the more explosive you put in, the finer the rock is and the less crushing and grinding you have to do on the back end. But it takes more time and it does cost more. It is cheaper, but you have a time factor as well. Sizing an excavator. This is one of the most expensive pieces of kit in a mine. Getting that size right for, you'll often have 2 different sizes, one for ore, one for waste. So you'll have the big ones for waste. So that is, you want to be as efficient as you possibly can, getting the waste into the trucks and having them go to the waste pile, which is hopefully as close to the open pit as possible. And what you want on average is 3 to 5 of these buckets to fill one of these trucks. That's kind of a typical ratio to use. And then these days we are seeing more and more autonomous trucks, particularly in the large iron ore mines. There's some great videos from Rio Tinto, for example, on how they're doing all that, but they are starting to use it in more and more. And there's also a lot more technology coming out to make these electric rather than diesel, or making them diesel electric. So there's new technology coming to reduce, probably not reduce the cost as much as reduce the emissions. So you can see here, me and some of my colleagues standing in front of a copper concentrate. That's the end product of a copper mine. Here's a big pit that BHP runs. But why do we open pit? It is safer. You can get more out. It's cheaper per ton usually. And it can be much more mechanized and automated. So your number of tons extracted per employee is much higher for open pits than it is for underground. It requires less specialized labor. It requires, but it is more difficult to permit. I should get that down here. Pit wall stability, we talked about the slope angle there before. You've got large equipment running around. One of the most dangerous jobs in an open pit mine is changing tires. More people are killed changing a tire on a truck than anything else in an open pit mine. Waste rock disposal, particularly if you have a high strip ratio, you've got to put that waste rock somewhere. It's just sitting in a pile. Sometimes that waste rock has elements in it that you don't want getting into the groundwater. It always has to be contained. And the air quality impact, like I said, that's part of the reason we're moving to more electrification, is that we don't want the diesel there. We've also got the dust, because a lot of these places, like, I mean, imagine if you were putting an open pit mine here somewhere in the desert. When the wind comes through, that dust is going to go to wherever it's going to go, and it will probably impact the community's lives around you. They do cost more to start up because they're bigger. They require more fleet. They require, a pre-stripping campaign. Another concern, and we will go through this, is metallurgy. So that's what I was talking about with this concentrate here. So a copper mine, generally speaking, does not produce copper. It produces a copper concentrate. That concentrate is sold to a smelter. That smelter has to manage your concentrate, your neighbor's concentrate, another person's concentrate, and what they're managing for a lot of times is the impurities in your concentrate. There are things that they don't want that they have to either blend away or they will charge you for. So having a clean concentrate is important. Social and environmental, I think many people, particularly on the copper side, they want more copper in their world. They want to electrify their world. They want their data centers. They want their electric cars to be charged. They want all those things, but they don't want a big hole digging copper out in their backyard. So social and environmental concerns, can be an issue, particularly if you're near anything residential. Infrastructure, particularly on some of the larger copper mines or the iron ore mines, you need railways, you need a port, you need ways to get your product out that are more efficient than driving it out on a semi-trailer. Power, because you've got so much tonnage, when you go to mill that, you need a lot of power to do that crushing and grinding work. So now we go to the underground. So here's one of the things I have to warn you about is mining has a lot of very weird terminology. So for example, the roof is the back. So like there's all, and anyway, so you have drifts, declines, adits, skips. Probably doesn't really matter too much here, but just sort of wanted to introduce you to some of the terminology. So portal is here in this dotted line. So that's where it's coming out the bottom of the open pit. So that's the portal. Decline is this spiral path that goes underground here. And the shaft, obviously here. And the elevator that goes inside the shaft is called the skip. And the skip can be used, it can be in two compartments. So if you go to some of the larger skyscrapers, they'll have dual compartments where you have people going on odd floors and people going on even floors. In this case, what you typically have is the top part or the bottom part will be where they put the ore, and then there'll be a place where they can put people. And if you don't have a decline, which is particularly the case in Canada, less so in many other parts of the world, but if you don't have this decline, you have to actually use a hook and a chain to bring all your equipment down underneath this skip to basically, you cut it up, bring it down, and then rebuild it underground. So that's how you get the capital equipment in. What are some of the key things that you have to be aware of? Well, geology and the geometry. So this is a fairly steep dipping. So remember we were saying steep, shallow, fairly steep dipping. That means that gravity is your friend. So you've got now every one of these levels, when you blast in here, which is your ore, it will then fall to the bottom and you can truck it out. And we're going to go through this in a little bit more detail in a bit, but this is basically what's called long hole stoping. So if we were taking this room, this would be a stope. So that's what the terminology would be. So we're going to blast this room, and it will typically fall down to the level below, and then we'll have trucks coming in, shoveling it all out, and taking it all either up the skip or up the decline to the production plant, the mill. Ground conditions. As you can imagine, particularly some mining methods are more sensitive to this than others. When you're blasting holes in rock and you're living in a tunnel, you want the blasted rock to fall, and you want the roof of the tunnel or the back to not fall because you're under it. So you have to do a lot of ground support. If the ground is very friable, if it breaks up easily, it's very expensive. If it's more competent, then it's less expensive. You do have to do less ground support. And ground support to me, I mean, I've studied it, I've lived it, but I still think it's black magic. You stick a whole bunch of holes in it, you put the rods in, and that's basically what makes an arch support over the top of your head, and it stops it from falling. And like I said, it's black magic to me though. And so then operational financial performance, that can come down to who's working, how well they're working, productivity, that can be changes in ground conditions, that can be changes in the ore deposit where you are mining, because you're not always mining in the highest grade areas. You try to do the highest grade areas as soon as you can, but if this is your highest grade area, it's, an NPV would tell you to go down here, take this first, and then work your way up. But you may not have the capital, particularly if you're just starting up a mine, you may not have the capital to do that, so you may be taking from the top and working down. You can do either. There's merits to both, because the further down you are to start with, the more you have gravity working with you, the more you understand what you're doing, but you are capital constrained. And you can see, as we were talking about before, it's iterative. Here's more of the decline, and they're doing exploration drilling down here just to make sure that the deposit does continue. So the mine where I was showing that copper concentrate before, it's actually quite well known to go quite deep, a lot deeper than what the resources would show. And it's well understood to be doing that, but they have a mill that's too big, so they actually need to find more low-grade material at the top to justify going in for the high-grade material at the bottom. So like I said, this is always iterative. You're always looking for the next thing that makes the mine better, and it will, like I said, a mine will change dramatically over a 10-year period. When we're talking about mining methods, we talk about selective versus bulk. So this is kind of a middle-of-the-road one. This is a long-hole stoping. If we had a very wide ore body, like this, there would be different techniques for that. We could use a block cave or a sub-level cave. And in those cases, you are generally much higher capital up front, but much lower operating costs on the back end. Now, if you have a very narrow, and I mean, I've seen mines that are profitable with ore zones that are that wide. And it's just that wide is carrying 50 grams per ton. You still have to take something the size of this room to get it, but it's very profitable. But you want to be as selective as possible, because the stuff outside isn't paying you for anything. So wider is generally seen as easier, but there are geomechanical factors that come into that, and narrow is generally seen as harder, like more complicated to do. So here we go. Here's some of our mining methods that we were referring to. So we're going from more selective to less selective. So shrinkage stoping is one of the most selective ones that you can do. And this is where we have, I mean, in a lot of cases, it's guys underground with a jackhammer. That's literally how we're pulling this out. So we come down here, we drill, and the way that you work with your rock mechanics, the way that you stop everything from falling down is you leave as much in the stope as possible. Listen, there's a lot of complexity that goes around this, but this is where they're drawing it out. And like I said, gravity's your friend. This is full of ore. Here's where you're pulling it out. Cut and fill. This is often when you have, I mean, you can use it in fairly steeply dipping, but a lot of times you also use it when it's a little bit flatter, because you don't have that run of ore just bringing everything down to you. Open stoping, that's what we're talking, long hole stoping is what we were talking about before. Less selective, you can see that we've got a wider ore zone, but we're going further between levels. So this will typically be 15 to 20 meters. So you'll be looking 50 to 20 meters there. There's different ways you do it. You can either uphole, downhole, or both. But you've got drills here, blast here, and draw points here. This is actually a transverse one, I guess. Sub-level caving, less. Block caving. I mean, if somebody comes in and says they're going to start a block cave for under $1 billion, just laugh them out of your office. I mean, that's how much capital goes into one of these things. This basically relies on the rock falling in on itself and then coming in through these draw points, and then you take it out. This is very common in what used to be an open pit for a copper porphyry is now underground. You're sitting underneath the pit, and you can see it here as sub-level caving as well. Long hole mining, that's more for coal than anything else. There are long hole techniques used in hard rock mining, but this is more for coal. So here we go, benefits and risks of underground mining. So it's generally easier to permit. You're taking less rock, you're leaving less rock on the surface, you're doing less surface disturbance. You have most of your dust is trapped underground, so it's not getting out into the environment, out to where there are people. You're not using a lot of land because you're not producing as much rock. So we will go into tailings, but only a very small fraction of even what you call ore is actually removed from site, unless you're in like an iron ore situation. But when you're talking gold or copper, there's actually only a small fraction that leaves the site. The rest has to stay there, generally in a tailings dam. So less resources, less intensive land use, smaller tailings disposal, less contact with surface water. So, if you're in a wet environment, and you're in an open pit, all of that contacted water, all of the water that goes and touches your waste piles, your open pit, your tailings dam, all has to be contained and treated before it can be disposed into the environment. And the higher the rainfall, the higher the risk on that. In an underground scenario, there was less things that contact the surface water. And less noise. You're underground. It's harder to hear all the blasting and everything that's going on. I mean, I would note that, in mining towns, every once in a while you feel a bit of a bump on the floor when the blasts go off, but it's not typically, definitely not what you'd hear on a large open pit if you live nearby that. But it is risky. Like I said, you're working underground. Your roof is rock, and rock is a natural product and it has natural variability, and if that's not dealt with appropriately, it can fall on your head, and it'll be your last day for sure. You're in a confined space. There is large mobile equipment underground. Just by way of anecdotes, just give you an impression of what the safety is like underground. Many years ago, when I was still working underground, one of the guys, actually the guy that I took over from, he died. And the reason that he died was he was operating a underground piece of equipment, and the truck was coming back towards him. He's operating a joystick, same as you would with a remote control car, because the ground conditions were too bad. He wasn't allowed to go where the truck was allowed to go, so he's operating by remote control. And as it was coming back towards him, he forgot that right is left and left is right. And so when he turned left to make it go left, it actually went right and crushed him. Right where he was standing. So that's the type of thing that can happen underground that's much less likely, because you can run away when you're in an open pit. When you're underground, you're in a much more confined environment. Ventilation issues, that's another reason that we're pushing a lot for, particularly underground, even more so than open pit, electrification. Those diesel fumes, they're no joke. You'll definitely feel it. If any of you used to be a smoker or was a smoker, you'll feel like you've smoked a pack by the time you come up in some of these mines. If you can do that with electric trucks, you have a lot less emissions. A lot of the capital development work in undergrounds is for ventilation. So we're putting fans up on surface to drive air, and there's a whole science of mine ventilation that people have devoted their lives to. I would actually say, when it says most underground mines here, any underground mine that I've gone in has a safety induction, and that's even as a visitor. Like, you have to go through a fairly short safety induction process. The only ones that wouldn't, I guess, would be family mines, probably things that you wouldn't get to anyway. And underground coal, because now we've taken all of those risks and added flammability to it, is even more dangerous than hard rock mining. So we're going back to mine construction. So we've gone through how to find the deposit, how to delineate the deposit, some of the techniques for mining the deposit. This is sort of what we're bringing it all together, going into the construction stage here. So some of the things that are important. Well, the main thing that's important is, if somebody offers you money while you're building something, take the money, because you're probably going to need it. This is where most of the delays and cost overruns happen. Like I said, I sit in Toronto. Somebody asked me last week, could I put together a list of all the companies, of all the mines that had significant CapEx overruns in Canada in the last 5 years. I gave him a list of 10, and I said, I can't give you a list of one that hasn't had that. So they do, this is where impactful delays, and by impactful delays, I'm talking, in many cases, hundreds of millions of dollars. Actually, some of them are even $1 billion. And this is kind of your best defense against that. If a geologist comes in and says, I've got this deposit, and he says, I've found other deposits like this, I'm a credible guy, and you're like, yep. And now I've delineated this resource, and here's other resources like this that I've delineated before, and you're like, yep. He says, now I'm going to build it. And you're like, well, who are you going to bring in as the CEO? Because you can't build a mine. And we're like, well, it's my baby. This company is this is my flesh and blood. I run this company. I'm like, well, your skill set was very good to bring it to this point. You're either going to have to bring in new management, either via being acquired or hiring the right people. Now, maybe you can stay CEO, but you're going to have to bring in a very competent COO or VP of Ops or something like that has experience in building this type of a mine. Because you've got experience in finding them and delineating them, but you have no experience in building them. So this is what you really, really need to look at. It's your best defense against these overruns. Typically speaking nowadays, there's a group of firms that sort of outsource this, but even if you're using, I don't know, AMEC or G Mining or any of these companies that do the startups, you need somebody in-house that knows how to police them, do the contracts, and make sure that it's meeting everybody's expectations. it's probably the litmus test for how good management is. Not just for how good they are at what they're doing, but how good they are at hiring people to do what needs to be done. So here's what goes into an initial CapEx. It's a lot. Some of the key touch points to look at here: labor. Can you get the people? Are there people in the area that have the training? Are they available? So one of the best case studies for this, I cover quite a few mines in Western Australia. So Western Australia has a very deep labor pool. They have a lot of people that do a lot of mining there, and they know mining really well. But there are gold mines, there are sometimes lithium mines, there are iron ore mines, and they're all competing for the same labor. Like, I mean, my background's as a metallurgist, so I tend to be a little bit more metal specific. If you're a miner, you've just been told to take the white tables out. And you don't care if they're white tables, black tables, blue tables, that's your job. For lack of a better description, I'm probably doing my mining engineering colleagues a disservice, but they can mine pretty much anywhere, anything. And so if the iron ore price is moving, BHP, Rio, Fortescue, they're paying top dollar. All the good gold guys are going up to the Pilbara. Now, when the iron ore price falls, when CapEx projects come off, then they go back into the gold space. Now, if you're young and you want to be able to tell your mum and your dad, and more likely your girlfriend, that that you're doing something good for the environment, you want to be a lithium miner. You want to be into the spodumene mines. But you know, the lithium price has done what it's done over the last couple of years, and some projects have come on, some projects have come off. So there's a labor dynamic there that has to be understood. And like using Western Australia as a continuation for the case study here, that labor cost inflation can be huge, and it can be very localized. So you have to have management, you either have to have experience yourself or management coming in that has a good understanding of the labor dynamics in the area that you're operating in. So as a compare and contrast, there is an Australian company that operates mines in Western Australia and in Northern Ontario. Northern Ontario, also very deep labor pool, very knowledgeable people, but it's much more stationary than the Western Australian pool. Western Australian pool tends to operate by contractor, and they're mercenary. Like for an extra $50 an hour, 50 cents an hour, they'll go to another mine. In Northern Canada, I mine here because my grandfather mined here, my father mined here, and in November I go moose hunting, and in the summertime I go fishing. I'm here because I'm here. I'm not here because I'm here to be paid to be here. So that understanding those dynamics has been very problematic for Australian companies going to Canada. It's also been very problematic for Canadian companies going to Australia. Just understanding that. Further afield, if you're outside of historic mining areas, so maybe let's turn to our example in the Philippines. Visa requirements. You can get somebody in to do a contract, but can you get them in there to be a trainer for 2 years? Culture. We're here in Saudi Arabia. The culture here is quite different from the culture in Australia, which is quite different from many other cultures. Are you going to have, well, the saying in Mexico for Canadian miners is he had to go north for his health. And what that means is that he's played up down in Mexico. He's generally done something horrible to somebody he really shouldn't have. They're coming after him, so he's had to go back home. So understanding culture. Wages. Do you have a whole bunch of expats there making hundreds of thousands of dollars, telling people that are making $3 a day what to do? That could be an issue. Relations, support, skills availability, training, all of those things. Just that bucket alone is a massive problem for pretty much everybody that is trying to work out how to build a mine. And it's not just in new areas. Environment. Definitely a big and growing part of the permitting process now. Bugs and flowers, keeping the water clean, making sure that there's not slides in the ground. Topography is really important. So I was at a mine, I guess October last year, and as I'm walking around, I'm like, where are you putting your mill? They're like, over there. I'm like, well, how are you going to stop it falling down that mountain? Because there was just no flat place for them to put a mill. Not only do you need a flat place, you need a flat place that's exposed to bedrock, so you can put the crushing and grinding circuit on solid ground. So that all comes into the permitting requirements, and I think I've mentioned whether it rains or it snows or it's hot or it's dry. That's also important. Infrastructure. we talked about having rail, having electricity, having roads, having all of those types of things. This is probably the easiest thing to wrap your head around. If you're in the Arctic, everything has to be flown in. If you're in an existing mining area, you can probably drive there. All adds to the initial capex. And I'll give you one example of how it wasn't encountered in an initial capex estimate. So a company that was building a mine in the Arctic that shall remain nameless because I think they're presenting here, needed to get some extra fuel in for their generators as they were building the mine. And so they said, well, it's not frozen enough to get it up on the ice road, and it's not hot enough to get it in on the barge, so we have to fly it in. So they took Hercules, filled it with fuel, flew it up there, and they'd ordered 5 barrels of oil. It was HFO, so they ordered 5 barrels of oil, and they started unloading the oil from the back of the Hercules. And as they're unloading, the second and the third barrel, the pilot's like, well, what are you doing? And they said, well, we ordered 5 barrels. Here's 5 barrels. We're taking the 5 barrels. I said, no, I need 4 of these to get back. So, it's that type of a cost overrun you can run into when you don't think about, like remote locations, as an example. So commissioning. This is what I used to do. I used to commission mines. So basically, commissioning is when it's built, the mine has been built, and then once it's built, there's a process of making it run smoothly. That's your commissioning process. There is no standard definition for when a mine is quote-unquote commissioned. When it is deemed to be commissioned, that's when we're entering commercial production. From an accounting balance sheet perspective, that's when you move things off of your balance sheet and onto your income statement. A typical thing would be 60% of throughput for 30 days in a row. That would be one definition, but there is no standard definition for it. So that's the final hurdle there. This is actually a gold pour. There's about to be gold coming out of this furnace here. Here's some copper anodes. I guess that must be at Olympic Dam by the looks of it, but that's cathode copper, never mind. So you can have, they can actually produce copper here. And that's commercial production. Permitting, we touched on this a little bit. You have to start early. So I cover a company that is not expected to be in production this decade. It is already doing all of its environmental baseline work. It's monitoring rainfall, it's monitoring water movement, it's looking at caribou migration, it's looking at patterns of flora and fauna, all of those types of things. Even if you have a really good deposit that you've only had for a little while, you still have to do this, and it still takes years. Like, there is no way around it. You have to do it. It's actually also a very important part of the social engagement process. So you can actually bring locals in to count the frogs, count the orchids, look at the caribou. Like, it's actually a very good way of also doing First Nations or Indigenous peoples engagement. It's actually a good way to bring the community on side with you. So it's important from many aspects, but it still takes time. Different jurisdictions have different levels of rigor that have to be applied in fairly benign areas, or places where it's relatively well understood, or if you're in an existing mining area, a lot of the stuff can be taken as read. But like I said, bugs and flowers, who lives there, who you need to move, moving the water, what's going to happen. So when you're in construction in a mine, you have 3, 5, 10 times as many people as you would normally have during the operation of a mine. Where are you going to put them? Who are they going to bring with them? That's a fairly large moral issue for a lot of religious areas. What are they going to do when they're there? Is it going to be a dry camp? Is it going to be a wet camp? How are you going to monitor all of that? And then you've got waste disposal, mine closure. All of it it comes down to public review with stakeholders. It's an ongoing process through the life of the mine, but it's particularly important as you start up a mine. Government. So here, this is your teenage popularity contest at high school. So the Fraser Institute, in response to some criticism for British Columbia's permitting aspects, they did this study, and it's a measurement of what people think are good places to go from a permitting perspective. So you can see Finland was #1 in 2024. It's probably a surprise to many. Nevada being number one, not much of a surprise. But then Alaska, there's plenty of mines that have been held up there. So, like I said, it's a popularity contest. It's a bit of a flavor of the month thing, but it is probably the most widely used metric of where is a good place to go mining. So if somebody comes in and says, so I don't see any of the local places around here. My home state's down here for South Australia. And Guyana's probably number one this year, for example. New Zealand has typically seen as a worse place than most of Australia, but there's nothing Australian above it. So like I said, it depends upon where stuff's being found, where stuff's being permitted, and where people are excited to go. And this changes quite a bit year to year. But it's widely used as a barometer. I would suggest that Mali probably goes down this year. As I mentioned, I'm also trained as a lawyer. Strength of contract law, property rights, your mining property. The intricacy about mining, and something that I've often thought about, is that when you take resources out of a country, those resources are gone. That is that country's one chance to get revenue out of those resources that are leaving forever. Many countries think about it that way. I think it is a good way to think about it, but you do have to make it a way that everybody can benefit. There are ways to make that go. And if you look through the vast majority of mining codes all over the world, and we've done a survey on this, on average, 50% of the revenue from a mined product goes to the country that it comes from. So most people have got it down to about a 50-50 blend. And that comes through from income tax for the people that are working there, royalties for the stuff that comes out, income tax for the company that pays, that's being paid into, all of those types of things. We've worked it out. It's about 50-50. Corruption. One of the other unique things, I'm not originally from Canada, but one of the unique things I learned when I moved to Canada is they've only taken bribery out as a tax-deductible expense in 2005. So that used to be actually something you could put on your income statement and deduct from your taxes. So funding options. I think many of the people here are probably more familiar with this than some of the other stuff that we've been talking about. Private market, this is basically going from earlier on to later on. So private market, that's when you do a family and friends round. Listen, I found this property, think it's pretty good, need $600,000 to drill, $200,000 to get the office running. I'm going to raise $1 million, pass the hat around, you all have some extra shares, a private market funding. Equity funding, that's where our BMO bankers go in and say, listen, issue X amount of stock, we'll give you Y amount of money, and you can go on with your day from there. Royalties and streams, for those of you who are interested, I'm actually moderating some royalty companies, Franco-Nevada, Wheaton Precious are some of the larger ones. You do get them in other commodities as well, but it's typically in gold and silver. Basically, they take a cut off the top, they give you a prepayment on that. Joint ventures, now we're talking about some of the larger companies, larger prospects where, not only is there a desire to have smaller bites of capital, but there's different desires from people that mine different things. So if you think of, why would a company like BHP need to partner up with anybody? They've got the capital to do whatever they want, but perhaps they want to partner up with somebody like Sumitomo who wants the copper offtake. So Sumitomo is going to give them preferential capital to a banker because Sumitomo wants the copper concentrate, which then becomes an offtake agreement. And then obviously debt funding, which is probably familiar to most people here. Okay, so I've seen many examples of these types of things. This is sort of the ones that we could cobble together that had the best charts that we could steal, I guess is probably the best way to say it. 27 mines got certificates and were supposed to open from 1995 to 2022. 14 of them went into production, 13 didn't make it. 7 of them went into operation, 7 of them had delays, and 7 of them opened on time. So your batting average is 1 in 4, roughly, in terms of being able to get something that goes as predicted. I would say this is quite optimistic. You can see here, 16.3 years from discovery to production. kind of a misnomer. A lot of mines that are put into production were discovered decades ago, but the true rediscovery, if you like, is probably what's being done here. But that's 12.3 years of studies before you're even sticking a shovel in the ground. After the feasibility study, 2 years to build, construction to production, another 2.3 years. So this is all from S&P Global. I think they're actually wandering around here. You can probably get their exact data from them. But the project timeline, we used to say it was 7 years. Now it's 16.3 years, and it's only getting longer. One of the things that I could probably note it in the permitting section that we have here, but very much flavor of the day is fast-track permitting. Many countries and jurisdictions are going to what's called a fast-track permitting system, where they give you we will tell you within 12 months or 18 months or whatever it may be, a go, no-go on your project. We will actually be able to come up with that in this time. It's going to be defined by various stage gates, and this is how it goes together. So you say, okay, well, typically we were thinking those jurisdictions were like 3 years. So you've really massively compressed it. What it's actually done is made it go longer. And it seems counterintuitive, because what's happened now is that bureaucrats tend to go at one speed. Actually, two speeds. They go at the speed that they're going or stopped. Those are the two speeds that you have. So at the speed that they're going, they are not going to work any harder just because the government said they have to do this timeline. So what they do is they say that we have to vet your application to get into the process before it goes into the process. So they then actually have their regular day job meeting the process, and then they have sort of a nighttime job, if you like, basically making sure that everything, when it gets to them to start the process, is actually ready to go through the process. So it's actually made things take longer. So I think stakeholders generally want stricter mining legislation. I think that is probably true. We always want a cleaner environment with less harmful things going on. But I recently sat on a panel discussion where we were talking about corporate social responsibility in the mining space. One of the things that the mining sort of space does very, very well is basically rural infrastructure. The number of people that you will meet in a mine say, my parents were subsistence farmers, I went to university. That's something that mines do well. They build roads into places that didn't have roads. You can argue that perhaps changes their historical way of life. In many cases, the youth are grateful for that. Anyway, I've probably gone on far too long about why things go wrong, but it's safe to say that just in this group alone, you get 1 in 4 going right. And this is ones that were permitted. This is like before the ones that have fallen out in the permitting stage. So this is just indicative. You'll often see this in corporate presentations as they're going through, but this is just an indicative timeline. This is that from, where are we? From here to here is 16.3 years on average. Once again, I keep putting this chart up. If you're a shareholder or an investor, this is where you look. We're a little bit more optimistic on this one. We didn't make it actually go down there. So technical studies. So we've gone through a lot on technical studies right now. They're all important, they're critical. Not only are those technical reports critical for investors to work out the valuation of a deposit, they often are the foundation documents for your permitting. And each development stage unlocks value, and we've got more promotional material. So what I'm going to do now is I'm going to walk through this, walk through a case study, but I realize that we've got a little bit of time here. So does anybody have any questions that they wanted to bring forward? Okay, quiet group. So here we go. I put this together, I called it the popsicle. So this is a porphyry deposit. You remember I was saying you've got fluids coming up because you've got a heat source here, you've got the fluids coming up here, they're depositing here, making a porphyry, and then this gets eroded down. Our illustrious editors have actually cut off a piece of this, but this is supposed to be a cylinder. The width is 460 meters, height is 800 meters. Anyway, like I said, there's a big piece of this missing, but I've made essentially a cylinder out of what this ore body would look like, and it is 100 meters under cover. So how are we going to mine this? If you could see this a bit better, it might be on a future slide that might show it a bit better. You would see that it's fairly close to surface. It's a big homogeneous cylinder. It's 0.5% copper, 0.5 gram per ton gold. It's a large deposit, so there we go, 1.8 million tons contain copper, 5.8 million ounces contain gold. You can see I put this together a few years ago, so there's the prices that I used, but that's $19 billion of revenue. At these prices, it's 38% gold. I would argue that if we put today's prices in, it's probably closer to 50% gold. So one of the things that you can do when you're doing the economics of these things is work out an NSR per ton. So that is the sum of the revenues for each ton of ore that you get. So $53.29 at these prices and at those grades. And I've incorporated recoveries in this. So what do we need to think about? So we've got what looks like a big open pit. So open pit, then processing method. What's in there? We've got gold, we've got copper. What format is it in? It's a porphyry, so it's most likely sulfide copper and gold. We'll go through this in a minute. What production level do we want? We know this is what we're going to be pulling out, and we've assumed no additional material, no satellites or anything like that. This is what we're going to pull out. How much time do we want to do that over? Do we want to put in a bunch of CapEx and get it out over 3 years? Probably not. Do we want to put in a little bit of CapEx and be operating this, well, have our grandchildren operating this? Probably not. So we want the right amount. Typically speaking, when you do a first cut of this, you want 10 to 15 years. On a bigger one like this, a bit longer. On a smaller one, probably a little bit shorter. What do we got in the area? Do we have energy? Like, do we have power? Is there a power line nearby? Are we running on hydropower? Are we going to be running off of grid power? Are we going to be running on diesel power? What do we have in the area? Is mining allowed? There are plenty of countries in the world that mining is just not allowed, so you can't go there. Do we have enough water for what we want? Do we have enough water to do the processing that we want? Or do we have too much water that we're then going to have to treat on the back end? What does the taxes look like? Do I have to give a free carried interest to the government? Do I, how much do I have to pay my people? How do I think about my corporate structure to be the most efficient that it can possibly be? We talked about this before. Is there a trained workforce in the area? Do I have to buy this land or can I lease it off to the government? These are all, I've got a resource that I've drilled out and I'm very optimistic about. Here's all the other things that we still have to think about. So yeah, this is what it is. So 460 meters wide, 800 meters high, 100 meters under the surface, and this is what you would call a long section. So it's a slice through there in 2D. So here's the impact of the strip ratio. So you typically mine an open pit in stages. Stage one, this is your pre-strip. There is no ore in this. This is dirt you have to move before you can start mining. So no ore there. We've got, this is step one. So phase one there. That has a very low strip ratio, right? Because you're just taking the top 100 meters of the ore and you only have to mine this much waste. If we look at phase 8, you've still got the same amount of ore that you're picking up, but you've got to now mine all of this. So that strip ratio is much higher. So as mines get deeper, typically strip ratios go up. So in this case, the total for this case study, which is highly stylized, is a 9.2 strip ratio. So for every 1 ton of ore that I pull out, I've got 9.2 tons of waste to move and store, treat, and remediate at the end. I knew where it was going, so I made it at 50,000 tons per day. So 50,000 tons per day for a porphyry like this is fairly modest sized. There's many that are double or triple or even quadruple this size. It's quite, like I said, that's quite a modest one. There are smaller, but that's quite modest. So on average, with a 9.2 strip ratio, I move 50,000 tons a day of ore. Therefore, I'm moving 510,000 tons per day of dirt. So think of how that affects your truck size. If you said, oh, well, 50,000 tons a day, a couple of thousand, 300-ton trucks, how many trucks do I need going this fast, going that amount of distance? No, you have to move the waste too. You also have to work out where you're going to put the waste. How far away is that waste pile? What is that cycle time? And like I said, we're doing it in phases here. So you can see these are the phases that I've put in here, phase 1 through 8. So pre-strip, 100 meters off the top. So that is $116 million worth of capex at, there's the mining cost there, $1.75. I would argue these days that's probably closer to $2.50 or $3. So I guess I've been at BMO for a long time. So you got $116 million capex. That's before your roads, before your mill, before everything like that. That's just removing the dirt off the top. One of the cheapest parts you can do, minimum $116 million. You've got a $1.5 billion mill. That would probably be $2.5 billion today. So you can see we've got a fair amount of money that has to go into this before we get a single dollar of revenue. Payback in this case comes in 10 years. Now remember we were using copper price and gold price that are much lower than today's prices. I would argue the payback comes in probably about 3 years at today's prices, but nevertheless. And this is just one of my things that really annoys me, is that this phase 8, under those operating conditions, is actually not profitable, but the way that accounting works, you can actually make it look profitable, so they always do. Because you never want to shut a mine before you have to. So here's operating profit. So here's your negative from your stripping, and then here's the profit, cumulative profit as you go through. Now, one of the things I promised I'd get to is tailings. There's been some fairly large catastrophes in the mining industry over the last 5 or 10 years with tailings dam. I know ICMM is here at this conference. This is one of their biggest pushes at the moment, is basically tailings management. These days, almost all tailings have to be done downstream. Why is this important? Why does it matter? I mean, we're just storing dirt. That's all we're doing here. Now, this is much more stable, because you can see that every additional lift is on top of an engineered surface, because you've built this, then you build this to go on top of it, you build this to go on top of it. That's downstream. That is much safer from a seismic perspective, but it's a lot more expensive. If we compare it to upstream, look at the size of this block, this block, this block, this block, compare it to the size of this block, this block, this block. We have to find that material. Now, in our case study that we're doing right now, it's not that hard to find, because we've got 9.2 strip ratio. We've got a lot of waste rock. The problem is that this is waste rock from around a porphyry, which is often acid generating. You can't use acid generating rock in this. Not always, but that can be a consideration. So sometimes you actually have to build a quarry next to your mine to provide material for your tailings dam, which can be quite frustrating and very expensive. And then centerline is sort of the combination between the two, where a bit of each lift is on the tailings. So there's fine residues of tailings. So that's what comes out the back end of the plant after we've done all the processing. This is how you store it. And I'm often asked when I'm on site, why don't you just build this to start with? Probably cost almost as much as the mill to do that. So you do it in stages. See, this is enough for, it's about 1.5 to 3 years per lift. Each one of these is called a lift. It's typically what you do. And so in sustaining capex, although some people do put it in growth capex these days, in sustaining capex, there will be a cost associated with adding to the height of this. And this, there's thousands of people that do just this for a living, working out the stabilities, working out locations and the like. You try to find a valley, so you don't have to do as much. You try to find a place that doesn't have a river running through it, which is tough for a valley. But anyway, that's this whole thing here, having a place for your tailings dam, having material for your tailings dam, and having your tailings dam signed off has become a much bigger focus of new mine startups over the last 5 years than it was previously. So I just thought I'd give you some of the key things to look at there. Like I said, main thing you need to know is if somebody says that they're downstream, you can probably nod your head and say, okay. If somebody says they're upstream, you might want to ask them a couple of questions. Oh, I guess some of the slides have been cut off. Many of the slides, so I guess. So maybe we'll go back to here. So like I said, we have to talk about processing. So we've gotten to the tailings dam part. We have to be able to work out what we're going to do to take broken rock. So the broken rock can be from the size of a small family sedan to dust. And we have to take that from the mine. We have to get it to the size that we want, to do the type of processing that we want, to get the material, the product that we want, and then dispose of it in that tailings dam, whatever's left. So this is a porphyry. So porphyry, it is copper and gold, usually attached to sulfides. So what we have to do is separate the sulfides, because they contain the copper and the gold, from the things that aren't sulfides, which are typically quartz-like things. So the way to do this is best described through a story that I learned at BHP many, many years ago. I can tell you right now the story is absolute nonsense. It bears no resemblance to reality whatsoever, but it's a very good example of how flotation works. So the way that you separate sulfides from oxides is the same way you separate grease from water in your dishwashing. So you put in soap, you froth it up, and the sulfides stick to the bubbles, and the oxides sink to the bottom. The way this was found was there was a washerwoman in Broken Hill. She was washing her husband's clothes. He'd come out of the copper mines, and she noticed as she was washing, her name is Rosie O'Grady, according to the story. Rosie O'Grady's washing her husband's clothes, noticed that all the stuff that her husband says is the good stuff was sticking to the bubbles at the top, and all the stuff that he said was nonsense stuff was going to the bottom of the wash basin. So she went to the mining company, which became Broken Hill, and said, listen, I think I've worked out how to separate the good stuff from the bad, and you've got, back then there was no way to do this, so you've got all these mountains of basically not profitable, what could be ore. It's probably running 30% ore rather than 50% ore. I think you can do something with this. They went and did it and then became BHP, the company that we know today. Like I said, it's complete nonsense. It was actually come up with by a German guy in 1880 something or other. But it gives you an example of how you separate the sulfides from the oxides. Now, when you look at these porphyries, they tend to be quite finely disseminated. So what that means is there was a picture on the other slides that I had here that showed my foot standing on top of a porphyry, and there were about 6 veins running through sort of the length of my foot. So on a mining scale, that is fairly homogeneous, because those veins are what contain the sulfides that you want. So the sulfides that you want, they're in there with the oxides. You go through froth flotation, it goes in several stages, and at the end you end up with a sulfide concentrate. That sulfide concentrate is mostly copper, well, chalcopyrite or chalcopyrite, depending upon where you're from. That chalcopyrite has gold associated with it. So some of the key things that you have to know here: how much crushing do we have to do? How much grinding do we have to do? Why do we have to do it? So what we need is to not make binary particles, and this is true for every single, pretty much every single process that there is. You want every particle to either be waste or ore. So you now take you down to your finest size of ore, basically, so that you're not making binary particles. So everything that floats is 100%, every one of those particles is 100% sulfide, and everything that sinks is 100% oxide. That's how you get your best recovery, because if the stuff that sinks contains sulfides, your recovery goes down because that's getting flushed out to the tailings dam. If your concentrate contains oxides, it's less saleable because it's lower grade. So on average, a chalcopyrite concentrate runs 29% copper. Because chalcopyrite, I think, is 33 or 36% copper as a mineral. So that gives you some idea of some of the other sulfides. So there could be arsenopyrite, marcasite, other pyrites, but that's your sulfide concentrate, and it has the gold associated with it. So we have to grind down to the right size. Typically speaking, in a porphyry system, that right size is going to be about 100 microns. So we're very small. So we've gone from family-sized sedan down to 100 microns. How do we do that? We've got crushing. Crushing is done dry. That's where we can load everything in, and often it's in multi-stages, but there's a jaw crusher, which is simply like this. There's a gyratory crusher, kind of works like a coffee grinder, spins around inside. There's other forms as well. The most common one you see is a jaw crusher. It's basically two jaws pushing against each other, put the big rocks in the top, small rocks come out the bottom, go to a screen, and you do subsequent steps after that. When you've got it to a size that you can go to the grinding stage, that's a ball mill, a sag mill, an autogenous mill, that's when you add water. So you're typically running about half water, half dirt, and you tumble it around like in a tumble dryer with big steel balls. And you do that in multi-stages. There's cyclones to do the sizing. That's also multi-stage. But you eventually come out with these particles that are about 100 microns on average. You'll hear it often referred to as a P80. So that's a fraction passing 80% passing this screen size. So a P80 of 100 microns. That means roughly by weight, half is above and half is below, because the number of particles above 100 microns weigh more than the number of particles below. So on balance, it ends up being about 50-50. So we've got our 100 micron particles. So on that basis, what we can then do is do that flotation step, recover the sulfides. Those sulfides then go to a smelter. Typically speaking, some of the companies here do own their own smelters that are next to their sites. BHP has one down in Olympic Dam. Ivanhoe has one at Kakula-Kamoa. They do have their smelters, but there are plenty of other companies. Think Trafigura is a big smelter company, and they also buy concentrates. Sumitomo, there's many other Asian companies that do it in particular. Plus some like Trail in BC. So there's many places that'll take a clean copper concentrate. And we were talking about penalty elements before. You don't want too much arsenic, you don't want too much water because you have to pay for the transport. And that's why you need the railway, because you've got to get that concentrate out. All right, so this one here, we're moving on to a second case study now. So this is closely related to the porphyry. So if we were to look at this, this is a VMS. So I don't know if any of you watch National Geographic. They're called black smokers. They're down in the bottom of the ocean. They pump sulfides out. There are actually companies that want to send submarines down just to pick it straight off the floor. But there is essentially that underwater, so underground rock. This typically happens underwater, under quite a deep water, and it just pumps sulfides out. And you can send a submarine down there, look at it. There's tube worms there. They think are some of the earliest forms of life that live in this environment. But it just keeps pumping this out for a few million years. And you end up making, as you can see, like a sort of a lens shape. So you often hear them talk about lenses. This essentially becomes a lens shape, like this. Over time, with a bit of luck and a bit of crustal movement, you'll hope that it comes up. And this is now the lens on its side. It's moved up like this. So this is loosely based on one of the Canadian VMSs that I used to work with a bit. So now we're much smaller. So you see the width here is 10 meters. It's not 460 meters as it was with the porphyry. We have a dip that we're now going to talk about. And we have a strike length. So that's your strike length there. So down dip, a long strike, if you're wondering what those mean in geology. VMSs, often a chemical soup. So you've got copper, lead, zinc, gold, silver. To give you an example, Agnico Eagle, who I'm pretty sure is here, is Ag, silver, Ni, nickel, Co, cobalt, and they're a gold miner now. But the reason they're called Agnico is because they were originally mining a VMS that had all those metals in it. So here's all of the bits and pieces, some of the things that we were talking about before. This time we're going underground. Why are we going underground? Well, you can make an argument that here would be a nice little starter pit. It'd be 500 meters long, 10 meters wide, but you'd have a nice little skinny pit. These things happen. And we've got it going all the way to surface. So odds are in this case you would actually have a little starter pit. But the bulk of what we're after is down here. And the strip ratio for the amount of ore that you get out, it just doesn't bear thinking about. It'd be hundreds to one. So we're definitely going underground. The next case study that I was going to do, so like I said, whoever, our editor did the compiling and cut out a bunch of slides. I guess they wanted me to talk faster. So the way that you process this is very similar to those copper porphyries, but you can do differential flotation. So in this case, those sulfides, when you pick them up, you can take the copper first, and you would depress the lead and the zinc, and then you bring the lead up, and you depress the zinc, and you bring the zinc up, and then you can depress everything else. And you take the gold out at the end. But in this case, you're going to be doing much more selective mining, very similar to the schematics that I was showing before. And yeah, and we go through basically the same steps as we went through on the previous one with the porphyry. This one here is also another hydrothermal system, but here, so you would have, this is your porphyry system. As those fluids continue up and out, they become a low sulfidation epithermal. This is a low sulfidation epithermal been expressed to the surface, very typical in Mexico. This is very standard Mexican open pit mining. In this case, we're going to go open pit again. Here's the gold and the silver. There's some intricacies about how much silver you can have with gold depending upon the processing route, but really what this case study is about is a heap leach. And a heap leach is different from the other processing that we've spoken about before. In a heap leaching, there is no grinding. So a heap leach, you take those rocks that we've dug up out of the ground, in this case in an open pit. Some of them will be the size of that family sedan. You hope there aren't too many that big. You can either crush those to, typically speaking, about an inch in diameter, or you can leave them as they are. If they're low grade, you just they don't have the revenue associated with them to pay for the crushing. And you push them up essentially on garbage bin liners and make a big pile, and you sprinkle cyanide on the top, and the cyanide trickles down through it, dissolves the gold and the silver as it goes. That then goes into a pond. The pond then goes through a treatment plant where the gold and the silver are recovered. Now, I guess most people most people that aren't familiar with mining get a little bit scared about cyanide. Yes, it's that cyanide. It's the one that you hear about. It is the one of a very small number of chemicals that can dissolve gold. Gold and silver are called noble metals because they don't dissolve. Cyanide dissolves them. It's a complexing, so it's a AuCN6 ion that it makes, but for lack of a better description, it is the far predominant way of producing gold. So instead of floating up sulfides, this doesn't work for sulfides. What happens with sulfides is that the gold is inside the sulfides and the cyanide can't get at it. In this case, what we're doing is we're dissolving the gold. So we need rocks that the cyanide can get into, so spongy type of rocks. Oxides work very well. So the cyanide needs to be able to get in, dissolve the gold, and a gold particle, if there is such a thing in the deposit, we're talking 1 angstrom, so 1/10 of a nanometer, I guess that is, would be a typical size for a gold particle that these things are dissolving. You can't see them by naked eye. You can't even see them with a regular microscope. So very fine grained within a rock that is porous enough to allow cyanide in. That cyanide flows through. Now, in order for cyanide to be useful in dissolving gold, but not a problem in becoming the gas that can kill people, you have to keep the pH high. So you add a lot of lime. The pH has to be above 10.5. So you have the pH above 10.5 with the cyanide. You wash that through, it comes out the bottom, and then through electrorefining, which is the same process that you may have used in high school chemistry. Remember where you took the key and you put it in with a copper sulfate solution and it came back out covered in copper? It's basically what you do. You take steel wool, you put it in there, and it becomes covered with gold. And it becomes a sludge down the bottom that gets refined into a furnace. So the two main hydrometallurgical routes for processing materials are leaching, and you can use leaching for copper. So anything that you dissolve is a leaching process, and anything that you float is usually almost always separating sulfides from oxides. And that's because you can sell those sulfides or subsequently treat those sulfides to get the valuable metal that you're interested in. Typically speaking, leaching produces the metal in the end that you wanted in-house. So if you are leaching copper, which is done widely, you essentially make a big pool of copper sulfate at the bottom, and you're you've essentially then got your bath to make your cathode copper on the back end of that. There probably were some slides, but I'm probably running too short on time to go through how you refine that big lake of copper into a much more concentrated state. You'll hear SXEW, which means solvent extraction electrowinning. Electrowinning is that process I told you with the key. Solvent extraction is basically an upgrading process where you mix essentially kerosene in with the acidic solution in the case of copper, and you concentrate the copper into the kerosene, because that's where the copper wants to be, and then you move that to a subsequent stage, you put more of that kerosene in there and a small amount of highly concentrated acid, and now the copper wants to be down in that smaller concentration, and you've done a 10-for-1 or a 20-for-1 concentration that way, which makes it easier to do the electroplating onto your cathodes. Anyway, so leaching, that becomes a heap leach. The other interesting thing, not only does heap leaching not need a grinding circuit, it doesn't need a tailings dam, because when it's a heap, it's sitting in a heap, and you don't have to move it after that. Sometimes you have to put grass on it. That's about it. You end up with these rolling hills. They do have to be monitored. Obviously, there's a lot of things in there that can affect water quality, and they often affect sort of eye lines and things like that. So sometimes they have to be moved around a bit. But for lack of a better description, it is better for not needing tailing storage. It is cheaper by a lot because you're not doing any of the grinding. It's much less power consuming, and it was sort of seen as the next evolution of gold mining back in the 60s. That's how they'd mined most of Nevada, is pulling it out. The Carlin trend is, majority of that is heap leached. The reason that you don't do it with just everything is it takes forever. A leach cycle is often a year. So you can imagine you've got high-grade gold, and you have to wait a year for it. And if it's high-grade, you would have to wait longer because it takes longer for bigger particles of gold to dissolve. That's when you go through that expense of doing the crushing and the grinding and leaching, so that you can just do it in a leach tank rather than in a heap leach format. So probably not worth going through this at the moment. Some of the things to be aware of, this is what we were talking about with the sulfides. This is gold in arsenopyrite. So arsenopyrite, as you may guess, is arsenic-based sulfide. Nobody wants to deal with that. It's quite bad for the environment. However, some of the highest grade gold deposits in the world, you can see these are actually full gold particles. These are quite large. You want to do the mining. So the simplest thing to do is convert this arsenopyrite, and you can do it with any sulfide, to an oxide and then do the leaching. Here's several techniques that are used for it. Roasting is quite common in Nevada. Bioleaching is quite common globally, I guess now, but especially in Africa. Pressure oxidation is probably the most common one. You'll see that all over the world as well. So all we do, heat it up with pressure. So roasting, you just heat it up. Pressure oxidation, you put pressure in it as well. Biooxidation, it's actually a bacteria. Eats the sulfides and poops the oxides. And that then allows cyanide to get in there, and that can dissolve the gold, and that can be subsequently processed. These do have to be richer deposits because you do have to pay for that secondary processing, and the permitting can be a nightmare. And yeah, so this is the circuit for that. Like I said, it adds $20 to $40 per ton. So this is the solvent extraction that I was talking about before, and I am going to run through this quite quickly, but ore stockpile, got a crusher, then we put it on a heap leach, and then that goes into the electrowinning cells, and you end up with copper cathodes. And the preparation here is the solvent extraction. Uranium, another leaching process. So you can use alcid or alkali. One of the unique things about uranium and also some copper is you can do it in situ. You don't even have to dig it up. You just put down a well and you pump the solution in, and you can pump out the solution from there. It requires some very significant planning for bedrocking to staying out of artisanal water suppliers, but when it works, it's like the cheapest thing you can do. You can see, once again, solvent extraction, precipitation. My colleague has a bit of a sense of humor, so yellow cake, and then you can sell that. And there's the in situ. So injection well to extraction well, and there's yellow cake. We do have a whole section usually on steel making and iron ore. I guess with the iron ore price very recently, it's probably not a bad thing to look at, but in this case, this is one of the few cases where the stuff that you dig up is pretty much the stuff that you send. The strip ratios tend to be very low because it's not a high revenue per ton material, so you can't afford the strip ratio, and it's also very plentiful. Like, there's plenty of 66% iron dirt lying around, so you wouldn't have to. The beneficiation we're talking about here, there are some flotation processes to remove some bits and pieces, but in many cases it's just direct rail to port. This is for the nickel bulls. This is usually what keeps the nickel price in check, is the HPAL. So this is very similar to what we were talking about with the refractory gold. You have leaching in an autoclave. Basically, these laterites are oxide nickel deposits. There's many of them all over the world. And so every time the nickel price moves to a certain level, it triggers all these to come on and knocks the nickel price down. It's been that cycle for decades now. But this is what keeps the nickel price in check. Aluminium, the easiest way to think about aluminium is it's solidified electricity. Most aluminium smelters, for lack of a better description, are located near cheap power sources. So in Canada, that's Quebec, because they have hydro. Hydro is 4 cents per kilowatt hour. They can produce aluminium quite cheaply there. Coal, similar to steel, similar to iron ore, in that most of what you mine gets trucked. You can do it underground, you can do it open pit. Obviously, a little bit tougher from an ESG perspective to do the investment on that these days. This is where I do my best impersonation of our steel analyst and talk about steel making. I'm not sure how much detail we want to go into for this because we are starting to run a little bit tight on time. But so steel making, in this case, you've got an electric arc furnace. So a lot of times when you talk about steel making, they're always talking about steel scrap. You need an amount of steel scrap to make this work. And you can have either a blast furnace or an electric arc furnace. So you've got the recycled steel here. Blast furnace is primary steel supply. So that's where you're taking iron ore, coal/coke by that time, blasting it with a bunch of air, and then it becomes and then gets reduced into steel. Electric arc basically melts it down and goes into here and goes into continuous casting. This is what makes your slabs, thin slabs, blooms, and billets, depending upon what product you want to move to, because then you go to steel finishing, which is often a different company, reheat it if you want to do hot rolled. So you got hot rolled coil, which would be here. So there's hot rolled coil. You have plates becoming pipes. And all of these have separate prices that trade differently. So you can see the slabs and thin slabs go through to these various products. So hot rolled, cold rolled, and then you can do heat treating. And then you've got blooms and billets, which are the square shaped ones that go into seamless tube, I-beams, and bar and rod. So a bit more detail here. Blast furnace steelmaking, iron ore gets pelletized and into here, or it can be sintered and put in here. You need limestone, you need coal, which becomes coke, which is a sort of a deoxygenated coal, for lack of a better description. It's more structurally competent. You put it all in here, heat it up. You can put it into the steel making here. So where you do your refining, you can add bits and pieces, and it goes into continuous casting. In this case, you can see that it's blooms coming out. Electric arc's a little bit different. The inputs are fairly similar, but the one thing you'll notice here is there's a much bigger portion of scrap that has to go in. Here's your electric arc furnace. You can see where it comes out. And then that's the roof. And here's your blast furnace. Like I said, iron ore, coke and coal, limestone, and coming out to, there's your bag house and your dust catcher. So a lot of this is also about reducing environmental emissions. So this is now we're moving into the products that they make: bloom, billet, rounds, beams, slabs. Like I said, each of these has a separately quoted price, and there are companies that. So this is where it comes out and becomes this, and here's the steel finishing. So put it through rollers. If you've ever seen some of these rollers, they're some of the more impressive pieces of equipment in the world. I mean, I just encourage you to look on YouTube for some of those things. And here's where it all goes. We will be getting into this in a short minute here. All right? And I'll get the people in the back to change over the presentations. And while I'm doing that, are there any questions on what we went through that probably covers 100 years worth of mining experience, but we did it in about an hour? Yep.
So I came a bit late, so you may have addressed this, but I saw on the slide you had a trade-off between CapEx and OpEx. Can you explain that?
Yeah, so the question is, how do you work out the trade-off between CapEx and OpEx? The way I described it in the presentation was that you don't want to have a mine so small in CapEx that it goes for 100 years with a very minimal revenue, and you don't want to have something that mines it out in 3 years. So you do want to come to a sort of a sensible balance on your mine life. And that's delineated by your reserves. So before you go into the building process, before you go into that CapEx cycle, you know what size of reserve you're planning to mine. And on that basis, you then choose the most acceptable amount of CapEx to get the amount of throughput. Secondary to that, on the OpEx side, is particularly in more selective mining, there are different mining methods that have different costs associated with them, and they take different CapEx and OpEx costs. So the more selective you are, the less of the property you will mine, but it may be more profitable, but it will be more operating cost intensive. So as we're showing on the slides there, it's iterative. So you have engineers come in and say, try this, try this, try this. And you will come to an optimized solution. And that optimized solution may be subsequently re-optimized many times throughout the life of a mine. So you'll quite often see a mine that was shrinkage stoping moving to long hole stoping. That's going from a more selective process to a less selective process. That's generally governed by either being unable to source the expertise for what is an expertise-intensive selective mining process, or more likely these days that the commodity price has moved up, that the marginal stuff that you weren't planning to mine before is now profitable, so now you can change your mining method on that basis, which often gets accompanied by a mill expansion because now you're mining at a faster rate. So every time, so if you, on a dollar millions basis, if you double the throughput of your mill, you usually only add 2/3 to the price. So you get the economies of scale through that. Sorry, right behind you.
My question about copper production.
Oh, you've got a microphone coming.
Thank you. My question is about copper production. Do you think there is a future in copper concentrate leaching in situ to arrive to anodes, or is the smelting, here for a long time?
Smelting's here for a long time, absolutely. That I would 100% say that there will be smelters here for a very long time. Is there a future for copper leaching? I would say that in specific cases, yes. So copper concentrate leaching, you would often do, remember we were talking about arsenic being present in the copper concentrate? There are processes that you can use to generally oxidize and then leach your copper concentrate, and that then circumvents those deleterious elements from being pumped up into the atmosphere, well, more likely being treated subsequently at exorbitant costs. So is there a future for it? Yes. As we get into lower and lower grade copper deposits, there's probably more of a future for it than less, but the stock standard, we've got a copper porphyry in the ring of fire, we're going to produce a copper concentrate, that's here for a long time. Sorry, you had another question.
Yes, just a follow-up. So if you had some OpEx... Thank you. Yes, a follow-up. If you had some OpEx processes which are relatively more or less expensive, I'm just thinking about access to capital, particularly for smaller or medium-sized companies. do you get situations in which a company is constrained into an OPEX methodology because it couldn't raise, if there's a trade-off between CapEx and OPEX, it couldn't raise enough capital to go in full, which would somehow give you a lower cost OPEX?
Yeah, so there's good ways and bad ways to approach that. So, for example, right now in the Canadian market, there's a company called Artemis. Artemis is a single mine operation. It's operating a fairly low-grade gold mine in British Columbia. It was never going to be able to raise the capital to build the mine that made the most sense from an NPV perspective. Billions. Like you were taking a $10 million company and trying to raise billions of dollars. It didn't work. But with a couple of management changes, a couple of bits and pieces, they were able to what's called bootstrap it. So instead of starting at 80,000 tons a day, they started at 20,000 tons a day. And they did what I would call picking the eyes out of it. They found the highest grade portion of it, started that at 20,000 tons a day, so that's now offset your higher operating costs, used the cash flow from that to build the 40,000 ton a day expansion. So then now they're operating at double the speed and they can afford to go some of the lower grade material, and they've used that they're going to use that capital to go to the 80,000 tons a day. So that's a successful way of being capital constrained and operating a mine, and that's actually worked very well for them. In a way where it's less successful is where you never got the capital to do what needed to be done in the first place. So another mine that I deal with up in the Arctic, they didn't get enough money in to get the equipment in to be able to do long hole stoping, so they went with shrinkage stoping, which required them to get a whole bunch of skilled labor in up in the north in a bull market. It was very challenging from that perspective, and they were just capital constrained. They couldn't get the capital to do the bigger one, the more reasonable plan. In the end, the company kind of hit the wall. Another company bought them out. That company's still struggling a bit, but they're doing okay now. And they've moved over to long hole stoping because they have deeper pockets. So I don't know if that fully answers your question, but anybody else? Okay. This is where I get way out over my skis. This is our commodities team put this together. I'm kind of doing my newscaster impersonation with a little bit of found knowledge along the way. So this is about commodity price estimation. I'm very blessed at BMO. We have 15 analysts. We are the biggest mining team in the world. So we have people that do all of this stuff, and I don't have to look at it anymore. If I did look at it, I would only be looking at gold anyway, and it's notoriously the hardest one to forecast, so I'm very glad I get to blame somebody else for our gold price forecast. Nevertheless, here's how we group metals. LME base metals, quoted on the LME. Precious metals, been a bit of a change on how those have been quoted over the years, but gold, silver, and PGMs, and they're obviously some of the more topical ones these days. Bulk commodities, iron ore, thermal, and metallurgical coal. Minor metals, this is where we're starting to find some of the more interesting critical minerals and the like, which have fairly opaque markets. And the one thing I can't stress enough is that many of these, particularly called rare earth elements, are the furthest thing from rare you would imagine. They're actually everywhere. It's the trick to them is working out where they're in enough abundance and you have enough expertise to be able to refine them. And then you've got minor bulks. These are very rarely quoted, although I did work in a mineral sands plant for a while. Steelmaking, we talked about this, iron ore, metallurgical coal, and then you've got for making stainless here, and battery raw materials, lithium, cobalt, nickel, and graphite. We sort of touched on the nickel market, having that sort of overhang from the oxides sitting there. That tends to keep the nickel price in check. It's been not the best market to be in, but it seems to be showing a bit of sign of life. So you should trend to supply to demand fundamentals. There can be lengthy dislocations. So here's your exchanges. And there's trade publications where an exchange isn't necessarily the easiest place to find things. I know we subscribe to all of these at a fairly large cost. I think I've seen some of them out there. But the thing to know is that when we talk about gold, because that's where I'm most familiar, we're not talking about, well, I mean, we're basically talking about 24 karat gold. We're not talking about 18 karat gold. Like, that's not what the gold price is set on. The gold price is set on 99.9999% gold. The copper cathode, minimum, they call it 4 nines, 99.99% copper. But if you start talking about iron ore, some of these other ones, there are different prices depending upon the iron content of the material that's being quoted. And that's either reflected as a premium or discount, or there are actually standardized ones that are quoted separately. In some cases, the premiums and discounts can be between exchanges, and sometimes they're between individual buyers. You'd be like, listen, I like your iron ore better than that guy because it doesn't have as much of this stuff in it. I'll pay you a little bit extra so I get yours. And you have a separate agreement there. And obviously the supplier would prefer to go with the premium. Discount, this is either something that's got either something nasty in it or not enough of what you want in it. That's usually what provides a discount. And that's kind of what we were talking about with the copper concentrates. So if you have a copper concentrate with high arsenic, you'll generally get a discount. Somewhat strangely, there's been a massive change in copper concentrates. You used to get a penalty, a discount on your copper concentrate for too much antimony, and you would actually have to pay them to process your antimony. Now, everybody wants antimony, so you get a premium for it. So these things do move around, and they can move fairly quickly. This is how we do the analysis. Well, how my colleagues do the analysis, I guess. Top down, so this is macroeconomics, this is GDP growth, this is construction, this is all those types of things. We just sort of know what goes into GDP, we sort of know what goes into construction on a metals blend basis. That's how we're talking about, make sort of the broader arc, and honestly, at least in my experience, it's what drives investor sentiment for various metals. Bottom up is what we spend most of our time at BMO doing because we have detailed mine models on pretty much every significant mine in the world. So the hardest part of bottom up is getting the supply data. We're lucky enough to have that. So mine by mine detail, specifics on consumption and end uses, that tends to be more specific to consulting houses, of which there are quite a few. And then bottom up analysis, I think my commodity analyst is talking her own book here. Bottom up is crucial. And there's a bit of a 80, what's her statement? Getting deep in the weeds is good, getting tangled in them isn't. Mine supply, which is what we've been talking about, smelters and refineries, we were touching on there as well. This is how we see essentially the supply flow into the market. It's based on refined products. So mined supply changes due to its own dynamics a lot more than it changes due to demand. It's the overall long-term trend is for demand to pull supply. But supply, as we showed, it's 16.3 years to go from discovery to a mine. That's longer than a demand cycle. So it's very difficult to pull the commodity price, the commodity supply up simply by an increase in demand. And we're seeing that right now with a lot of the sort of more energy-intensive metals, if you like. So you see here, this is one thing we didn't touch on, is average head grade in the world is declining. Simply put, all the easy stuff's been found, all the high-grade stuff has been mined, and now, because copper price is up a bit, that marginal stuff that we just sort of left behind as waste is now profitable to mine. Plus, there was a whole bunch of other projects that didn't make sense 20 years ago that make sense now at these prices. So grade is coming down. Supply is actually coming up. We talked about aluminium being basically solid electricity. Efficiencies have helped with that. So now there are less kilowatt hours per ton to make electricity. So this is one of the very rare cases where there's been enough technological innovation to make a difference on the supply side. So supply is generally price inelastic. That's what I was talking to about the demand being able to pull the supply. Platinum refined supply is pretty much flat. 6,800 to 6,800. And you can see palladium price has done this. So surely you would have wanted to produce more there, if you could, but you can't, because you just don't have the ability to get the capital in, to get the construction done, to be able to do this. And what you really don't have is the ability to downsize here in an efficient manner that you keep all of your stakeholders on
1, 2, 3, 1, 2, 3, 1, 2, 3.
The other thing that comes in is substitution.
1, 2, 3, 1, 2, 3.
So our commodity analyst who put this together was recently on a tour through Asia, and as she was talking about copper, they said, well, have you thought about the substitution of aluminium for copper? And not only that, think of how much aluminium is already used in these data centers. It's not really being accounted for. Shouldn't we be more interested in aluminium right now than copper? Because people seem over bullish on copper and over bearish on aluminium right now. So that's an example of where other metals impact each other. There's complementary and supplementary metals, I guess. But you can see some of the others here. Some of them, obviously, most concentrated. Like, there's not much you can do with a chunk of iron ore except turn it into a piece of steel. There's not much you can do with a piece of uranium other than make a nuclear device with it. Nickel just goes into stainless for the most part. So you can see when you have very specific here, but when you have aluminium or copper or steel, they go into a large number of, and that makes the demand analysis much more complicated. And this is sort of what you were talking about with the stockpiles. So apparent consumption is what people sort of model the easiest. It tends to go best with stock. Oh, hello. Thank you. And then real consumption here is uses that inventory build, and you'll often hear talk of shadow inventories. Whether that's a hedge fund with a boat full of iron ore sitting off a port somewhere as a short-term inventory, whether that's the pictures you see in Chinese basements of cathode copper sitting there waiting to come on there. I mean, if you go back to the 1980s, there was a big run on silver market, and the number of Grandma's silver tea sets that came out and got pushed through a mint was quite astounding. So that's another form of stockpile that can come out in these types of things. In here we've done the real steel consumption, but you see it just sort of overshoots with the influence of the stockpiles. Why do we talk about China so much? So that's because they use so much. And you can see where we are here. They're better than 50% of a lot of the things that we make. And here's another example. Here's the end-use sectors. So we spent a lot of time, I mean, the number of times I've heard about new housing starts, real estate market in China, that basically is what drives the steel market. It's not everything, but it's enough that it moves the needle. So now we've sort of touched on it a couple of times. Electricity. We're changing our sources of electricity. Solar, kind of seen as silver intensive. The batteries, seen as lithium intensive. One thing to be aware of, lithium is also not rare. I remember I was on a flight a couple of years ago. Somebody says, I'm buying these lithium stocks because lithium is so rare in the world. And we happened to be flying from, I think it was New York to San Francisco. And I looked down and I said, you see down there, that's Utah. He says, yep. And I said, the Salt Lake City, Utah. Yep, that's the capital of Utah. I said, they're mining the Salt Lake for lithium right now. So no, I had no idea. Like, lithium is literally in every dead lake in the world, plus there's other sources beyond that. It's very easy to find. The trick is refining it and making sure that you don't oversupply the market. But nevertheless, solar, wind, here's the cumulative capacity added through the year. So that's 2025. So that's just last year. And so ETFs is one of the things that I deal with quite a bit, being in the gold space. A lot of that stockpile basically either real or virtually sits in vaults. What I mean by real or virtual, I mean there are literally large rooms full of gold bars, sort of, I don't know if you guys watched Goldfinger, the movie, like, it looks like that. One of the larger vaults full of gold is actually the building next door to where I work in Toronto. Its basement's full of gold. Actually, it's more full of silver than it is of gold, but nevertheless, there are large stockpiles. Those ETFs, now, depending upon the structure of the ETF, whether it's open-end or closed-end, they have to buy or sell every day. They're always buying and selling, and that moves the market. That's actually been one of the largest portions of the move in the gold market over the last few years. Finally, that ETF holding has started to come up, and as that ETF holding has started to come up, that has taken more of the supply away for other investment products. Gold doesn't really have a use outside of investment. And so you can see here, gold ETF throws by region. And one of the things we talk about quite a bit on the gold side is de-dollarization. So it doesn't really matter what your politics are. If you go back a couple of years, the US dollar was the main currency of trade. Whatever your opinion on the US economy and so on and so forth is right now, it's clear that there is less of a use for gold, less of a use for the US dollar now than there was previously. It's still by far the largest. But whether that becomes euros, whether that becomes gold, whether that becomes crypto, whether that becomes something else, it just means that because the US dollar market is this big and the gold market is this big, every incremental bit away from the US dollar and into gold has a magnified move on the gold price. And I would assert that this is the biggest reason for the gold price moving over the last few years. Feel free to have a chat with me about that if you want. And there's a fair bit of skepticism around this, but the China official gold reserves seem to go up fairly regularly. Copper warehouse stocks and other inventories. Like you said, sometimes it's not always visible. So as more and more of it comes out, whether it's Granny's silver tea set, whether it's that the copper cathode sitting in a basement, whether it's diamonds sitting in De Beers, whatever it is, when it comes out, it tends to stay out. It doesn't tend to go back. So it more and more becomes visible. So it's so less and less inventory has become on exchange, but it's become invisible in other uses. And so, like I said, here's all the absolute inventory and relative levels. This is where I'm sort of getting a bit beyond myself on zinc warehouse stocks and total reported stocks, but we do have the stats on that. And so we get to supply and demand. So one of the things you get here, we try to replicate the state of the market and predict the future. So we're trying to get the future prices. This is one of the more interesting statements that she put. They will always be wrong, but it's more being directionally right than it is being absolutely right. So new supply, we've seen that more recently with the fears of what was going to happen with the new iron ore supply coming in. And perhaps that fear has been overblown, so now we've seen iron ore prices move up. Demand and demand trends, we've seen the data centers come in. That's added to a demand fuel, depending upon which metal we're talking about here. And inventory shifts, as we get color on those, things move. Sometimes there's seasonal patterns. I think there's always a flood in Queensland in December, I think. So there's a cyclicality to metallurgical coal coming out of Queensland. There's always a cyclone. For some reason, the seasonality still works, even though we know it's going to happen, but it still does seem to pan out. And here's, I think, one of the more interesting charts. So this is what sort of sets a floor and a ceiling to a metal. So I was using this for different processing methods in nickel, but you see this with copper or aluminium. That's probably the most common one that this is talked about. Aluminium gets to here, copper gets to here, aluminium demand increases, marginal, consistent, no substitution. So you can see how the copper price moves, and that's due to aluminium. And these are one of the more popular things that come out from our commodity price team is marginal cost. Most of the time people talk about the P90. So this is sort of your marginal switch on, switch off. But you have a cumulative cost curve built up here. And if you've gone back in history, most commodity analysts would have said, that's my copper price forecast, or that's my aluminium, that 90%. That's become less relevant because I think demand has moved up faster. I don't know the full reasoning for it, but it seems that demand has outstripped the supply to where there's now a belief that eventually we will be here and we will be profitable. So long-term price incentive curves, sort of what I was talking about before. Do we have to be here to actually incentivize new supply? Sort of that 16.3 year mine build that we were talking about here. what makes them confident that in 16.3 years they'll have a viable deposit? TCRCs, so we were talking about copper concentrates before. Copper TCs are a function of how much smelters want concentrate, for lack of a better description. So sometimes it goes negative. So they're actually paying, rather than the miner paying for processing of their concentrate, sometimes the smelters are so desperate for concentrate that they will pay the miner for supply. So that is where it's gone negative very recently. So to your point, that may inhibit adoption of more advanced technologies if the smelters are putting out cash for it. And then here's the availability concentrate, that's what's driving a lot of this. So concentrate availability has gone down and smelter capacity has gone up. And so this is what we're talking about with the different types of iron ore. This is a premium. Now, if this premium for 65% iron ore gets small, why bother? Just sell them 62%. It's cheaper to mine. You can put waste in there. It's easier. And here's, for the steel making people, here's some of their cash margins, which have obviously shrunk quite a bit. So it's obviously very interconnected. Mining, smelting, refining, all have their utilizations, all have their costs. Each stage, in theory, should build upon each other profitably, but there's always dislocations, like we saw with those TCRCs. There's a dislocation there. And when there's a bottleneck, one part will make exogenous profits over the other. It tends to be temporary, but it also tends to be longer than you expect. So right now, the miners are winning. It's been a while. This is the thing I've never quite understood. There's a massive deficit. Like, it can't be. This is the projected deficit. It self-solves. So this is, do we substitute for aluminium? Do we bring on new mine supply? Can we bring on new mine supply? Can we do a mill expansion rather than building a new mine? Is there ways that we can thrift the copper? Like, can we use less to do more? Remember, we were seeing with the amount of electricity used to make aluminium. Is there a way we can use less copper to do more with the electrification? You know, how do we get smarter about where we put charging points for electric cars? How do we get smarter about where we put data centers? How do we get smarter about all that? This is an unoptimized supply-demand balance. The world optimizes over time. It's prolonged deficits don't happen. And I would say that this is the number one conclusion. It's a black art. And each is different, but some of them trade together. They're interrelated, either positively or negatively correlated. And volatility is high due to supply and demand being price inelastic. There we go. And this is, so when the commodity price is moving up, shareholders want more. So we are seeing an increase in dividends and share buybacks. Governments want more. Royalty rates are going up. Workers want more. Workers' participation, employee share plans, and the like. And it works over the long time. Over the long term, supply and demand fundamentals do pan out, but it can be longer than a career. And sell-side prices are a lagging indicator. You can see that from our gold price forecast. We're still lagging. I think our long-term gold price forecast is $3,000, and we're one of the highest in the world. And this is another important thing. Forward curves are not price forecasts. Those are the prices for a contract today for stuff tomorrow. They're not a forecast of what the price will be tomorrow. And I believe that gets to the end. So thank you very much, everybody. We've managed it with 10 minutes to spare, and happy to take questions. Thank you. And if you're all feeling shy, oh, we've got one.
I have a question. So there is a lot of in the US about real world asset tokenization.
About, sorry, real world.
Real world asset tokenization.
Okay.
How this would potentially reflect into the mine?
I can't actually, I don't think I actually know anything about that. Real world asset organization. No, I can't say that I've heard of it, sorry.
Hello. So, I was listening to your lecture when we're talking about copper. The demand for copper seems to be going up because of application, EU, electric vehicle and stuff. So how will those material, vehicle, e-vehicle and others, the price will be affordable if the copper price keeps going on, and the mine, it takes average of 3 to 5 years to produce from discovery to production. How will the EV, electric vehicle and stuff, be affordable in the short run if supply cannot catch up with demand?
Yeah, I mean, so that's what we're talking about here. Supply not catching up with demand, negative inventory, going more and more negative. We've had this fear before, whether it be from EVs. I mean, EVs have been around, how long has there been a Prius? Since the 90s, I think. I mean, there's been EVs, there's been, I think a previous slide, well, you show, yeah, so the electricity intensity of GDP growth, right? So every bit of GDP growth costs more electricity now, which needs more copper. Now, to your point, you said 3 to 5 years for a new copper mine. 16.3 was the number I put up before, 16.3 years. So it takes even longer. So to your point, the copper price is going to keep going up in an unconstrained environment. And you can say, well, then how is anybody going to be affording an electric car, being able to wire their house, probably more important, being able to do any of those things? Well, like I said, we've been hearing about this for a long time, and I've seen this negative inventory going like this for decades, but it didn't. And the reason that it didn't is because we get smarter. We get smarter about how we build our houses. We get smarter about how much aluminium we use. We get smarter about how to use less copper to do more. So we get smarter. We find other ways to do things that are not as copper intensive, either by putting in other materials or by using less copper. That's what's happened every other time. I would expect it will be similar this time, because you're right. If this actually does come to fruition, there's almost no copper price to solve for it, because it just means that the copper price has to go up exponentially to stop people buying stuff, right? Which is sort of your point. So, if an electric vehicle, so if an electric vehicle costs 3 times as much as a V8, you buy the V8. The demand goes down. If a data center costs X amount with copper, the guys that, when you use your chat GPT or whatever, the rates go up. You use it less. That's another way. It destroys its own demand. So you're right. I don't think that this ensures that there is exponential growth in the copper price, but I do think that there's, like I said, this has been around for a while. That we find ways to solve for it. Sometimes that means the copper price has to go up, but there's more subtle things happening behind the scenes that I think mean the copper price increases versus expectations now. We're not talking about versus today, we're talking about expectations in 2030. There's ways that expectation of demand will come down. So that's what moves it. It's the expected demand more than the current demand. Does that make sense? Yeah, so obviously as a gold guy, World Gold Council, there is no substitute for gold. There we go, that's their slogan. All right.
Sir, thank you for your lecture. I had a question about coal.
Okay.
Both energy coal and metallurgical coal, which you briefly mentioned in your lecture. If you talk publicly to global major mining companies, they all say they're moving away from coal for ESG reasons. When I talk to them privately, they say, especially about metallurgical coal, but also about energy coal, that they would never move away because there are another 20, 30 years of growth and there is cash to extract. What's your longer term view on coal fundamentals?
Yeah, you'd have to ask our commodity price analyst on that one. I'm not as familiar with her coal price prognostications as I am with others. I would say from having talked to probably the similar people that you've talked to, there is definitely a business model for coal that is profitable. It's a matter of whether you want to have your name attached to it or not, and that's what I think the companies are struggling with. There's been more of an effort to quasi-privatize that, to get that away from the books. By sort of almost the same token, or maybe a slightly different token, there's been maybe I'm being controversial here, there's been a realization that ESG investing doesn't necessarily work as well as people thought. So people are getting more comfortable for investing in dirtier companies if they make more money. So listen, perhaps that's controversial, but that does seem to be the trend in investors that I speak to. So I guess I would agree with your assertion, and there is a move away from thermal coal, but as I showed before, the energy intensity of GDP growth keeps going up, so why shut down something that's running to build something new just because that runs coal? I think that becomes the thesis in the end. Okay.
Oh, thanks. Really enjoyed your presentation. Wondering if you had a look at how geopolitics infects any of this, or how it's infecting this sort of split in trade blocks, de-risking, decoupling of producers and markets, and so the attempt to create separate supply chains, and how that gets into your investment and in trade flows.
Yeah, there's probably another 3 hours to talk at least about that, unfortunately. Some of the simpler things to look at. How does geopolitics affect things? Governments want a bigger take of every mine. And there are many ways of doing this. Countries that you would not think of as being sort of more hungry for tax revenues are just as guilty as ones that you would think of in more dire political or economic situations. So overall, as the vast majority of commodity prices have moved up, I think I mentioned in my talk, there's a recognition by various sovereign nations that as resources leave their nation, that's the last chance they get to look at them. So they may as well take as much money as they can along the way. Whether that comes into trading blocks, my best example, I think I gave it up there, is the de-dollarization of trade. So whether that's a block or not, that's a move away from the US dollar that has had a dramatic impact on gold. So to me, that would be a large example of a trading block, which is everybody against the US.
Hello?
Oh, you go.
Yeah, so I watched you talk about copper forecasting. It's not that good. It's difficult to tell, right?
No, I would say ours is as bad as anybody else's.
Yeah, so how would you compare? I mean, nobody really knows, right? But, not blaming your
I don't do it, so that's good.
But then how would you compare it to oil price forecasting, for example?
Well, I'm even further out from here. So oil price has, the oil market in general has one thing that's very different, even though it's an extractive industry, from mining. Their exploration holes are their production holes. So their cycle is much, much faster. We're not talking 16.3 years to build a mine. We're talking put in a drill hole, and you know what? I haven't got enough money today, so I won't put that drill hole in today. I'll put it in tomorrow. They can make that type of decision. Miners can't make that type of decision. So I would argue that's the biggest difference. And then sort of to the previous point there's a thought that reducing our reliance, consumption, whatever, of oil and moving to other things, there's a thought that would be a nice thing as well. So I'm trying to be as delicate as I can, given that we're here in Saudi Arabia. But so oil price forecasting, I find that our oil guys tend to be better shorter term, but I mean, my old mentor many years ago said that the best estimate of the gold price is today's gold price, and the second best is yesterday's. So like there's no way to pick that one, and I would say copper is just as difficult, especially these days where new technology seems to be relying more and more on copper, and it's even harder when you get down to, like, let's talk about antimony. Have you seen the antimony price lately? I mean, who thought that the US needed antimony so badly, whereas before people were paying to get rid of it?
Hey, thanks so much for being here. I wanted to go back to our conversation on de-dollarization in gold. So I believe that you mentioned that gold could be a potential next reserve currency or something of the sort, along with cryptos or euros or anything else. I guess I wanted to ask you to clarify your viewpoint on that. While gold is a great store of value, generally agreed upon as a great store of value, it's tough to transact in, like trading gold bars around. Could you clarify how gold could become or supplant the US dollar?
So not supplanting the US dollar, not by any stretch of the imagination. What I'm saying is that the US dollar market is like this, and if it goes like this, the gold market goes from this to that, which is double. So that's why it's the relative size is a part of the thing. So if gold is a portion of the solution for less reliance on the US dollar, its effects are exaggerated because it's a smaller market. Now, to your point about trading gold bars, nobody trades gold bars when it comes to this stuff. The futures market for gold is second only to the NASDAQ. Not the NASDAQ, the S&P, what is it, the XI, the TSX, sorry, not the TSX, the S&P 500 global ETF. It's one of the most liquid ones that's out there, and it's got a liquid futures market, more so than many other things. So on that basis, if it's part of the solution, it's a smaller market, therefore it has an outsized effect. But to be able to embrace becoming a larger portion, albeit still small, there are mechanisms in place that don't involve me having to bring a gold coin to a grocery store. Now, I think there are basket solutions that are more likely. So whether somebody says, I want to come up with a BRICS currency plus gold, or a Chinese yuan plus crypto, or something like that. There will be other means and mechanisms. We've got a lot of ability to self-solve for things nowadays, and I think the world gets like a little bit more individualized on how trade settlements are done. The bulk is still going to be in US dollars. It's just that little bit less is a huge amount more for gold, for crypto, for other currencies. Does that make sense?
Yeah, that makes sense. So like as reliance on the US dollar decreases, that capital is going to be held in gold, and that's where you see.
And it can be held in many forms.
Or anything else, but gold will likely benefit.
Yep.
Got it. Thank you.
And I think, well, it's gotten us actually past lunch. So thank you for sitting with me, everybody. It's been a real pleasure. Thanks. This used to be a 2-day course delivered by 8 people that we've now trimmed down to about 2.5, 3 hours. We're going to cover off some valuation. We're going to cover off the actual nuts and bolts of how to find a deposit, how to delineate a deposit, how to mine a deposit, how to process it, and then what to do with it afterwards. And then we're going to talk about commodity price forecasting a little bit at the end there. So obviously a lot of ground to cover. Like I said, my name's Brian Quast. I'm one very small part of the BMO Metals and Mining research team. We are one of the, well, I think we are the largest research team in the mining space in the world, and we are the preeminent global investment bank for mining. So all of your mining financing needs, you feel free to come to one of us. With no further ado, I'm going to get it started. Just to give you a bit of a background on myself. So I come at this from a practitioner standpoint. I started my career in mining. I actually started working in my first mine when I was 16 and ended up working through school, working after school. I guess my claim to fame would have been that I started up the Escondida copper mine for BHP, but sort of started up mines all over the world. So I'm a commissioning metallurgist, would have been my more official title. So that's sort of why I get this, because I kind of sit in the middle of all this. I've been in brokerage for a bit over 20 years now. So I can talk to you a bit on the stock selection stuff. So as I said, first section is going to be on stock selection, how we look at valuation of stocks, and then we're going to get into the nuts and bolts of actually mining. So this is section 1. Then we're going to go to geology and exploration, and then mining and metallurgy. So in a nutshell, and there's probably as many varieties of this as there are, people that do stock analysis, we've sort of loosely bucketed how you analyze a stock or how you value a stock into 3 sort of simple buckets. So quick and simple, you can do this on almost any company. Price to earnings, price to cash flow, EV to EBITDA. You compare it to comparable other companies in the market. Lower is better, higher is worse, away you go. Going from that to something a bit more mining specific, production per share. So obviously it doesn't work for a pre-revenue company. If you're talking about an exploration company, it doesn't work. Reserves, if it doesn't have reserves, you can't do that either. But loosely, there are some, particularly in the larger producers, there can be some merit in that. And it's really quick to work out. It takes you 20 seconds to get it done. And you at least have some sort of a feeling for what the market perception of a stock is. Then we get into the more intrinsic things. Price to NPV. So in order to get price to NPV, price is the easy part, NPV is the tough part. You have to do a full bottom-up analysis of the company. You have to have mine plans, capital schedules, financial statements, all of those types of things to build up your NPV, and then work out a price to NPV. IRR, actually even harder, because you have to have the full NPV model, but then adjust your discount rate to get a price to NPV equal to 1. And that's how you get the IRR. Implied commodity price, even harder again. It's a similar type of a goal seek arrangement where you try to get that price to NPV equal to 1 based on a gold price. We do all of those. For all of our stocks, and it takes a fair bit of our associates' day, but in the end, there's still a qualitative aspect that has to be used, and you'll find during the course of this presentation that I'll be talking a lot about the qualitative stuff as much as the quantitative. One of the other things that you'll see quite a bit during this presentation is this curve. This is called the Lassonde curve. It's fairly familiar to most mining investment professionals, but you'll see it in quite a few different iterations, and in fact, we'll show you a case study in a minute. Initial discovery, that's, let's call it first hole in the ground. First guy with muddy boots coming into your office saying, "I've found something." That's you deciding whether you believe him or not, completely subjective. Initial resource, now we've got some holes in the ground. We've got a bit of an idea what's there. We've got some maps. We've got, a feel for, how big this could be, what this could look like. Technical studies, we're going to spend a lot of time on this in the middle part of the presentation today. Initial reserves, technical studies, what do the economics look like here? How do we compare it to other deposits of a similar nature? And what are the industry standards for doing that? Construction, first production, and you'll notice that from construction to first production, there tends to be a bit of a dip, and then going through commissioning, generally a bit more of a dip. This is the dreams to reality. If it works out, you get the reality being a very good. It can go dreams to nightmare, and you can go to zero as, and one of the things we'll talk about is cost overruns in construction and the like. And you can see where those different models we spoke to about before, where they come in on this investment curve. So here's a quick and dirty way to do things. So gold production, this is your gold price estimate, whatever you want it to be, calculate the revenue. You've got the guidance from the company for the next 3 years. So therefore, this times this equals this. And there's your calculated EBITDA. And then you can pull the EV off of Bloomberg. And here's EV to EBITDA. Do 4 times, 6 times, 8 times. Bear case, bull case, base case. Quick and dirty, take you 5 minutes. It'll give you an approximation, and it'll sort of give you either a reason why it's trading expensive to its peers because it's expensive, or because there's a reason, there's some other value there that this doesn't capture. This is a DCF model. So for those of you that have done a little bit of finance or a bit of math, DCF, NPV, you use a discount rate here, but you need reserves. You need production and recovery. You need a mine plan. You need operating costs. You need CapEx. You need a mine level income statement. You need taxation schedules. You need site level valuation for each operation, and then you calculate the target price. So this is, actually, as I recall, this is from a copper mining company, but you can do this with pretty much anything. But you can see it's like each one of these mine 1, mine 2, mine 3, that's a separate mine plan with recoveries and grades and so on and so forth. This is a lot more time. This is a few days worth of process here. So here's the case study. So as promised, you remember the curve, sort of a dip, and then when the dreams come true, we end up here with the positive free cash flow. This is a company called Lundin Gold. They bought a mine, they bought a deposit in Ecuador that was well known to be world class. It had run into a little bit of troubles under its previous owners because they couldn't get a deal done with the Ecuadorian government. The good folks at Lundin Gold, and many of you are probably familiar with the Lundin family, they spent some time with the Ecuadorian people and managed to get some rules and regulations that sort of suited both parties. So here they bought the mine. They did a bit of work on it to get a feasibility study. We'll talk about studies in a minute. And then here's the key thing. This is where they got their permit, and this is where they got their financing, and that's where they poured their first gold. Bit of a dip, as I said, there's usually a dip when you pour your first gold, and then commercial production. This is a bit out of date, so we're just using it as a case study, where it says 3 billion. That's, I think, an $18 billion stock at the moment, and it's still the same mine. So it's been doing very well. It's one of the most reputable gold miners in the space. So this is what we look like. This is the look for. This is the sort of the secret sauce. And unfortunately, I can't just give you. I can give you a list of what to look for. I just can't tell you how to look for it because I've been doing this 20 years and I don't get this right every time. Credible management. I was once told that being able to trust somebody doesn't mean they're a good or a bad person. It means you can predict exactly what they'll do in each situation. So credible to me means you know what they're going to do in any given circumstance, which comes down to the corporate strategy. Are they going to do a bought deal after they said that they weren't? Are they going to sell out to a low premium bid because they want to cash something in? Are they going to not sell when they should have because they're entrenched? That's the type of thing. Stronger balance sheets, obviously better than less strong. Deliverable growth options, that's sort of what we're here today. We're going to talk about how to build a gold mine or build a mine in general. Can they deliver it? Are they the right people? Do they have the right people? Is there the right equipment? Do they have the right financing? Relatively lower risk. That comes in many facets. That can be geopolitical, that can be management, that can be environmental. It could even be just topographic. And reasonable valuations. Sometimes that matters the least, which is why it's at the bottom here. So we've broadly bucketed producers into two groups here. Here's a mining company. Mining company number one. They're not very good at building mines, but the important thing is that they know that they're not very good at building mines, so they buy them. So let's give their corp dev team a bit of credit. say that they've bought some good mines. Their production is actually up overall throughout this process. You would argue they would have liked to buy a mine here to keep things going, but 2015, 2016 was a tough time to buy. Well, actually, arguably it was the best time to buy a gold mine, but it was a tough time to get through the market. Now, these are companies that you know that they're going to buy something, or you're fairly confident they're going to buy something, and you always wonder what their next transaction is going to be. So if you're comfortable with what they've bought in the past and what their messaging, their sort of parameters are for looking into the future, that's a company you may want to buy. This is the company that people try to talk about, Mine Builders. We have in-house expertise. We have the right people. We have the operational nous. We know how to build a mine. We know how to do all of that type of stuff. We buy deposits. That's the cheapest way to get ounces. Well, in this case, copper. It's the cheapest way to get copper tons. Buy them while they're still in the ground and nobody stuck a shovel in there yet. The other advantage to that is if you're good at building, you can actually build it to your recipe. Most companies have a recipe that they like to build things to. They like a certain type of device. They like a certain type of truck. They like when you're starting with a blank piece of paper, you can use whatever you want to do that. And if you're good at it, this is the type of company that the market loves. But it's hard to build a mine. And having the expertise and keeping the expertise is challenging. So going back to the mine buyers, how do you work out whether a company has bought the right company to grow? One of the things that we look at, this is our first cut analysis, is a total cost of acquisition. So total cost of acquisition means that we know what the gold price is on the day that the transaction was announced. We have models of almost every gold company that's out there, or we can build one pretty quickly. What we do is take the operating cost per ounce, sustaining capital per ounce, growth capital per ounce, take the gold price and divide it by the sum of those three costs, and work out what it costs as a percentage of spot gold. So you can see some are done at a premium. So here's 100%. And so some are done at a premium. Most are done at a discount to the spot price of gold. And you'll see that it comes in different buckets here as well. Producers, higher, because let's face it, you don't have as much initial capital that you have to put in. You are buying an operating mine. Now, maybe you're cleaning it up a bit, maybe you're doing an expansion, but that amount of capital doesn't have any permitting risk, or very limited permitting risk. There's just less risk associated, so you pay more. Developers, they tend to be down here, because you're taking now the capital risk of putting this thing into production, plus sometimes you're taking a bit of permitting risk, which is one of the things that we've seen lately is M&A has been very challenged until permits come. This is some BMO-free propaganda for you. These are some of the reports that we do. If you're interested in anything like that, have a chat to me after. So now, into the nuts and bolts, unless anybody has any questions on the valuation section. Okay, we'll keep plugging along. So we're going to go through basic geology, exploration cycle, QA/QC, which sounds very boring. It is a little bit boring, but it's very important. Technical reporting and reserves, that's probably the key thing to take away from this. And then exploration, we try to put it all together just from a geology perspective. That's before we get into the actual building and operating a mine. This is, I don't know, high school science. So, and it's just tailored a little bit more towards mining. So, Earth, here's the surface, here's where we live, here's what we're all standing on, bit of ocean off of here, and all of the mining in the world happens right up here. You can't really get down below there. It's too hot, too hard to get into. So everything that we scratch the surface to pull out metals is up in here. In most cases, it's coming from down here. So we're going to show you how it gets from here to here and why it becomes a mineral deposit. So up in this part of the world where we live, the ground is moving. I think we mostly understand tectonic plates now. That's what makes earthquakes. Now, an earthquake is basically a fault moving. So strike slip, reverse, normal. Doesn't really matter what direction it's going. The important thing that we've got here is at each one of these faults, there's a pathway for fluids to flow. So the main way that deposits are formed is that fluids and we'll show you, I'll tell you how they get there in a minute, come from down in here, and they're looking for a way out. Easiest way to think about it's a volcano. Volcanoes, this stuff here coming out through a mountain. So that's lava coming out. Now there is fluid that either comes from the ocean, and as the ocean, so you can see we've got a mountain range here, and I'll show you this in another slide in a second, but you end up with a subduction zone here. So basically this part of the Earth is pushing down underneath. That's why you've got the thickening part of the Earth here and pushing up those mountains. As it does that, it drags a lot of ocean water with it. There's 1 trillion ounces of gold in the ocean. There's gold dissolved in the ocean. There's, lots of lithium in the ocean. Like there's all kinds of things in the ocean, and if we push it down, and we've got it under heat and under pressure, it starts looking for a way to get out. These faults are one of the ways that it tries to get out. Another way that it looks for weaknesses is folds. So a fold is essentially a more ductile version of this, but you'll see a lot of mines, they'll talk about hinge zones. So you'll have basically fluids flowing up from one side or the other and just sitting up against a contact boundary because it can't get through for one reason or another. What we're trying to do to make a deposit is we want to take a natural concentration that's in fluid that has generally come from water, been pushed underneath the surface of the Earth, it's been heated, it's like 400 degrees C, it's under a lot of pressure, so it's still liquid, and as it comes up to the surface, it's looking for the easiest way out. So as it comes out, for those of you that have had a pressure cooker, the boiling point's much higher. You take that pressure off, it boils. So boiling is one of the ways that deposits are formed, because that liquid all boils away and you're left with essentially salt. And that salt can contain metals, it could be a sulfur salt, could be anything like that. And because it's all going on these preferential areas, that concentrates it to a level where it's economic. Another thing that can happen is this unit might be like limestone, and this unit might be granite. And a hot acidic fluid is going to go through limestone pretty easily. Limestone's basic acidic fluid, and you've got the granite sitting here that doesn't really dissolve stuff so easily. So as those fluids come up, it's the pH difference here that's now dropping out those minerals. So there's EH, pH, pressure, there's all sorts of mechanisms. Each deposit is formed differently. One of the things that I turn to first when I read a technical report is called the deposit orogeny, which is how the deposit was formed. If the company has a good idea of how the deposit was formed, like where it was formed, how it's moved, where it's faulted, all of those sorts of things, there's a good chance they have a better way of finding extensions, satellites, more stuff in the property that they have. So, as I was mentioning, subduction zones, ring of fire. So it's basically a ring around the Pacific. You can see there's a lot of mines, and they're mostly porphyries. And we're going to be talking about porphyries a fair bit today. Porphyries are one of the most common types of mine. They tend to be fairly large. A lot of our copper and quite a bit of our gold come out of porphyry systems now. So, as I mentioned, there's an ocean spreading ridge, and then you have the trench, which is that subducting plate. So, if this was, so where are we now? I guess we're not, so if we were on the edge of Chile, this is the Andes, this is the Pacific Ocean. This whole band here, through here in the Andes, is full of copper porphyry mines. So, like I said, porphyry deposits, we will be talking about them quite a bit today. Mostly driven by copper. The economics tend to be driven by copper. These days, there's a lot of gold coming out through there because the gold price has gone up so much relative to the copper price. Silver and moly also are quite prevalent in there. Like I said, they're all over the ring of fire, and they're really common. Like you would think that, big things like this, there must be only a few of them. We should have found them all by now. We've found hundreds of them that are not in production, whether that be for permitting reason, infrastructure reason. We'll get to a lot of that in a minute, but like these are everywhere, and they're easy to find. Giving you some examples here: Bingham Canyon in Utah, El Morro in Chile, KSM is in British Columbia, Pebbles in Alaska. So that's that whole line going up the Ring of Fire there. Like I said, they're easy to find. You can actually just find them from the air. In fact, in a lot of these cases, there are certain trees that only grow on top of porphyry systems. So you see the tree, you know you're in a porphyry. Here's some of the typical sizes. I think there's some even bigger ones, and there's definitely some smaller ones. And here's some typical grades. You see, it's not the highest grade thing on Earth. 0.2 grams, well, better than 0.2 grams. We'll have a case study in a bit where I use 0.5 grams. It ends up being a fairly rich mine. But they do come with a nice gold and silver kicker on occasion. What you want in a porphyry system, because they're so large and because they're so low grade, is you want one that has been eroded. So it sits on the surface. So the porphyry itself is here. This is the volcano, which may or may not, it could be there, it could have been eroded away, it might still be there. Nevertheless, you want erosion to have come down here, if you can. Because then you can open pit mine it. Big trucks, big shovels, big economies of scale. That's the easiest way to get into it. That being said, we'll show you some underground methods that work for these as well. But think big and low grade needs low cost and economies of scale. So there's a lot of bits to geology. I'm not a geologist, I can tell you that. I find many geologists a little bit weird. And this is why they get a bit weird. Because they look at stuff like this and they'll say there's the best gold mine that's ever been found right there. And it's just a tie-dyed shirt as far as I can tell. And they'll be pointing out like different colors. So this is a potassium map. This is actually done by hand sampling, but they'll have airborne geophysics. They'll have ground mag. They'll have all of these charts with all of these different colors on them. And the one thing that I've learned is that there's always anomalies. So I think the last time I was doing this, I was using the example of this room to work out anomalies in this room. So let's say that the thing that we want to mine is white tabletops. So we're after white tabletops. Now, we can all look around here and see that there's, was it 6 bands of white tabletop here. So if we do these tests and we're looking for white, well, if we're looking for white, how do we set it so that like this light green color or these silver colors or this lectin, which probably doesn't have anything to do with the white tabletops, doesn't show up? It all comes down to the scale and how you perceive these things, and I find that that's the black art to these things. There are people that swear by this stuff. I generally can't get through it, and there's a lot of techniques. But eventually you do get down to, like I said, the field sampling. That's where you send some generally very healthy young people out to go walk the ground. And they walk along and they literally take a sample off the ground and put it in a bag, geolocate it, and they analyze that sample. Now, if you're thinking about that for gold, let's say, gold is in very, very small concentrations even when it's worth mining. So you look for other indicator minerals. So it won't be like, this is a potassium map. Don't mind potassium, but potassium is the indicator that's being used here for a porphyry system. So the potassium is a better guide to where the system is than the actual copper or the gold itself. So you can see here, see, as it's projected, there's the porphyry system. And then there's a quartz carbonate here. And whole bunch of different bits and pieces, but like I said, this is done with the benefit of hindsight. If you gave me that sheet there, I wouldn't have any idea. But the good thing is, you can do this, then you can drill a hole here, then you can come back and do some more testing. You keep developing your understanding of where things are and where things could be. That's the real thing you need to learn out of this. All of these methods are just another iteration to extend your understanding of where things are and where things could be. Which takes us on to drilling. So you don't want to stick a drill in a random spot. Drilling's expensive. Like a RC hole, $100 a meter. Drill core, a couple $100 a meter. So doing this when you want to put it down a couple 100 meters and you're a guy with mud on his shoes and a couple $100 in his pocket, like, you're not going to want to do this too often unless you're pretty confident of finding something, because you have to find something to get the next dollar to do the next drill hole. So this is an RC kit. So two main types of drilling. One's RC. So RC stands for reverse circulation. So reverse circulation means you're basically sending down, let's call it a rotating hammer, and it goes straight down into the ground. I guess you can angle it, and it just pulls out rock chips because you're just smashing the ground as you go down. Those rock chips, you go down this far, you pull up all the rock chips, you go down this far. So you have increments of rock chips. It's good because it's cheap. It's good because it's fast. In many cases, it's good because it doesn't need any water. That means water that you don't have to source, and even in places where you have a lot of water, whether there's a river running by or whatever, you don't have to treat the water that you're using, makes it more difficult. Being able to do RC drilling is a useful first step. It's also a useful secondary step when you're operating an existing mine because it's quick and it's cheap, and you can shoot it down whenever you need just to get some confirmation on a deposit. But all you get is rock chips. You don't get this information. This is your drill core. Number one, you can orient it a lot better. Number two, it goes a lot deeper. RC can only go down about 350 meters. This can go down about, if you really want to spend some money, you can go down about 3 kilometers, but that's putting up some pretty serious coin. But you get this type of information. Look, you've got a slate footwall here. You can see it's called the fabric of the rock. So the slate has this type of bedding. Probably means like when it was formed, it was like this. It's been metamorphosed, become slate, and now we've got this coming through here, this chlorite and feldspar. It doesn't really matter what the names are here, but here's your chlorite and feldspar, and at the top of the chlorite zone, that's your ore minerals. That's what you're looking for. So we know that it's at a different orientation from how the slate was formed. It means it was formed in a different event. And then we go back into the slate again. So this is something that's interjected itself into the slate. That's not knowledge we could have necessarily gotten from the RC hole. And we certainly wouldn't have been able to see the difference in orientation of the fabric as we went through. So that's why diamond drilling, well, despite being more expensive, is definitely the method of choice when it comes to somebody delineating a deposit. The next thing that I need to explain is what's called true width. So we'll get to that in a minute, I guess. So true width, if you think about it, most deposits don't form flat like this tabletop or rectangular in a block like this. You have to drill at an angle, and you never, well, at least at first, you don't know what angle the deposit is. So there's many examples of deposits being found by somebody turning the drill rigs by 90 degrees because they'd been missing these ore zones that were all going one angle. They were just shooting parallel to it and missing them. Turned 90 degrees, they started to find them. So if you want to find the true width, which you do, is you need to be either hitting perpendicular to it with the drill hole. Sometimes that works, sometimes it doesn't. More often than not, what you do is you come in at an oblique angle like this, and you do some trigonometry to work out what the true width is. And you need several holes to do that, but it's fairly basic sort of high school algebra stuff. It's important to know because one of the best tricks that most explorationists can play is they can do what I call a director's special hole. So the way that you do a director's special is instead of drilling perpendicular or near perpendicular to the deposit, you drill straight down the deposit. There are actually reasonable reasons to do this, but usually what it's done is a promotional tool, because then you've taken the richest part of the deposit and said that it's this big. It's not this big, it's this big. So now, as you're coming down here, you've got 100 meters at 10 grams per ton gold, and everyone's like, wow. Then you realize it's straight down the middle of the deposit. It doesn't really mean anything. You already knew that it was 10 grams per ton, but over a much smaller region. You do it for metallurgical holes sometimes, but like I said, that's one thing to be very wary of when you read exploration press releases. So like I said, we are going to see this chart quite a few times in various different formats. Capital intensive, here's digging in. Junior exploration companies, first on the ground, either a guy that's got a family tenement, a guy that's just done some staking, do some speculation. Most of the people that like to tell me how rich they are in the space, that's where they made their money, usually because they knew something about some guy over here. And then over here, then we start, they start meeting me in my office. We start talking about what they've discovered. We do the technical reports, and then financing, usually a bit of a low ebb, And then operating mine, we're doing much better. So we do put QA/QC in here. It's really boring, but it's really important. For those of you with a bit of grey in their beards like myself, you may remember Bre-X. There was a Matthew McConaughey movie called Gold that sort of fictionalizes the Bre-X example. It was a fraud. They did a whole bunch of drill testing in Indonesia, came up with what was supposed to be the next greatest gold mine in the world, and it was basically, nobody really knows what happened, but basically it was a fraud that could have been worked out with a bit of QA/QC. All Canadian technical reports, and most mines all over the world have a Canadian-based NI 43 technical report, have this in them. So this is, the way that you do this is repeatability of measurements. So you take that piece of diamond drill core that you've got, you take 1/2 of it, you send it off to the lab. It comes back with 5 grams per ton. You're like, well, let's see whether the lab equipment's working all right. So test the other side of the same drill core, and maybe it's 4.9 grams per ton. So if they match up well, high precision, high accuracy. Now, what you can have is a situation where it's a very nuggety deposit. And what I mean by that is, if you're on the left side of the core, there's a gold nugget in it. And if you're on the right side of the core, there's not a gold nugget in it. But on average, if you do enough repeats, it ends up being the same average. That is low precision, high accuracy. See, the average is still the same. Now, if your repeats all go one direction or scatter in one direction, there's either something wrong with your equipment or somebody's trying to pull a fast one on you. So those are things to look at. That's why we've got the, there's also a chain of custody. There's a fairly famous fraud case in Canada where it was simply the CEO was getting the assay results before anybody else, and he just moved the decimal point. So he 10 times a lot of his assays. Upshot of quite a bit of fraud in the mid-90s, 43101 and JORC, where you have qualified people and they must be, they have to be vetted and be independent. And this is what I was talking about before, to some extent. You very rarely drill diamond drill holes straight, because you want to come in at an angle to your deposit. One of the reasons you want to come in at an angle is you want to get that true width. Now, this is somebody that's not trying to do a fraud. This is actually a thing that has happened more than once in the market. Somebody has drilled these holes, looked at them, said, oh, it looks pretty good. My interpretation of the fabric of this deposit is that it's a flat, tabular, thick zone that looks like this. We're going to be able to mine using bulk methods, and it'll be like lots of tons at a decent grade. They get underground, and it's actually this. It happens, and it's catastrophic when it happens, because if you put the capital in to do this, and all you got is this, you've lost your payback, because there's just not enough tons to support the equipment and everything that you bought to do that. So we try to put this into some sort of an analogy that people understand. I don't know if it's a Smarties place or an M&M's place up here, but let's have a look at, how do we work out geostatistics? Geostatistics is not my forte by any stretch of the imagination, but what we're doing is we're trying to work out how many red Smarties are where. So, if you stand back and eyeball it, could you come up with a zone here that is richer in red Smarties than the zone next to it? Maybe. Is there a pod of red Smarties up here? That's what they're trying to, and it comes down to geostatistics, because you're only measuring, you're interpolating the grade between each hit that you've had with red Smarties in it. So here's the exclusions that you do, and basically what it comes down to is you're using some not especially complicated but somewhat sophisticated statistics to work out essentially how far, every time I hit a red Smartie with a drill bit, do I want that result to carry across the deposit. So, if we did that here, so here the interpolation is from here to here, and the interpolation from this one is from here to here. So we've basically interpolated this here. What we should have done, thinking of the type of deposit that it turned out to be, is it should have been a much more narrow interpolation. That way we would have only estimated a small amount of tonnage versus the much larger amount of tonnage there. So does it have continuity? Is it shallow dipping? Do we select this point? Is it in the right type of mineralogy? So you also have to have an idea of what type of rocks you're looking for that have grade. Sometimes they have grade, sometimes they don't have grade, but having the right type of rocks is important as well. Like I said, it's all a bit nerdy. It's stuff that geologists go on about for a long time. It is kind of important, but it's kind of beyond most investors. So this is how they use those geostatistics. So here's the holes, then they put the grades to them so they know what the grades are. So they've drilled all these, then they say, well, we'll color code it for where it's high grade, low grade, mid grade. Then we put the blobs around it. This is where you do the interpolation. Then we say, like, remember how I was saying that the distance of influence? And then we make a 3D shape out of it, out of all these strings, which then becomes, we then carve this up into blocks. Those blocks are typically designated as something that we could mine, like one block is a mineable thing. That becomes your block model. Then you start working out a mine plan, and here's where you add back in those grades into your block model, and this is essentially what forms the basis of your mine plan. This is another important thing that we're going to get to a lot in the section on technical reporting, but there's different categories of resources and reserves, I guess is probably the best way to say it. So when we stick drill holes in the ground, and then we do all of this work, we have to come up with a definition of what we've come up with. So if we were, once again, using this white table analogy and we had 2 drill holes in it, we might be able to say that this room is 5% white table, but we've only got 2 drill holes in it, and maybe both of them missed, in case we would say 0% white tables, or maybe both of them hit. Maybe then we'd say the whole thing is a white table. So that would then be called an inferred resource because there's a low degree of certainty. Now let's put 2 more drill holes in, 2 different more places. Now we're getting up to what would be an indicated resource. Now we've probably hit with 3 and missed with 1, or hit with 1 and missed with 3, but we're getting closer. Now let's take that up to 10 drill holes. Now we're into a measured resource. So we've gone, by doing more drilling, we've gone inferred, indicated, measured. What we need to do then is a technical report, technical study. It needs to be independently third-party verified. There are many firms that do this, but that report, which is a preliminary feasibility study, is the only thing that can tell you that a portion of this resource is a reserve. These are reserves. The difference, there's a couple of differences, but the main difference between a reserve and a resource is a reserve is something you have confidence that you can economically mine. A resource is some metal in the ground, I think. Inferred cannot be converted to reserve except by more drilling. Indicated goes to probable, measured goes to proven. And they go backwards and forwards too, depending upon how your project's working out. So what do we look for? I mean, I would argue here, how it says hundreds of prospects, there's hundreds of thousands of prospects. You narrow it down, you've used some like geological surveys, you said, okay, this looks prospective. Now we stick a drill in the 24 most likely, and now we're into 5 targets and 1 mine out of hundreds of thousands of prospects here. How do we get there? Management. If you have a management team coming in from Vale, big copper company, big iron ore company, they're saying, listen, I have this small high-grade epithermal in Mexico you should look at. Well, you might want to double check that because they probably haven't got too much experience with that. So relative deposit experience. Do they have a history of discovery? It's estimated that 98% of the world's deposits are found by 2% of the world's explorers. Goal alignment. Well, are they there for a long time or for a good time? Are they going to raise money and spend it on themselves? Are they going to raise money and put it all in the ground? Are they going to sell when they should? Are they going to hold when they should? Are they aligned with you? And can they create value is sort of the bottom of all this. Budget and strategy, that's cash is usually what they're asking you for. And to get the cash out of you, they have an exploration plan where they're going to find the next big thing. So as I mentioned, we've got various technical reports here. The first sort of easiest stage is a preliminary economic assessment. So economic assessment in medium-sized to larger companies tends to be done in-house. Takes 1 or 2 people, about 6 months, costs a couple $100,000. It gives an idea of what we're planning. So we kind of know what we're going to do with the mine, we kind of know what we're going to do with the mill, we kind of know where everything's going to go. You often do these for mill expansions as well, just to rejig the mine plan, to have just sort of a record of the date of what that looks like and make sure that you're sort of starting to think about how you can optimize this. Big one's the pre-feasibility study. You cannot use a preliminary economic assessment for a financing document. You can use a pre-feasibility study for a financing document. That is independently verified. Costs here, plus or minus 50%. Costs here, plus or minus 20%, in that range. And you can see your cost to do it costs a lot more. You have tailings people, permitting people, environmental people, mining people, metallurgy people, geology people, geostatisticians. They all have to work on one of these. So it can take a while and it can be expensive. And to be honest, a lot of companies these days, they don't even want to do this because they're way better off coming into an office and saying, listen, this is the deposit, it's this big, it's going to be massive. This is where the rubber hits the road. This is where they have to tell you how big it is that they, from what they currently know, and more importantly, how much it's going to cost to get it out. A feasibility study is the next iteration from a pre-feasibility study, as the name would indicate. This is for raising equity, this is for raising debt, is the simplest way to think about it. So this is where the credit bankers sit there with their very conservative price decks, their very conservative banker hats on, and say, we're putting our money into this, we want a rate of return, we want to make sure you can give us our rate of return. Here, you know it's a bit speculative. This is a guy that's coming in there, they're looking for equity. So once again, reserves, resources. It's a different way of looking at it. I'm not sure which is clearer to you, but resources, the stuff that we know is in the ground. The more feasible the economic recovery is, so that's the amount of it that we are confident that we can pull out at the right cost, and the amount of certainty that we have, like the number of drill holes that we have. When you're at the top left, you're a reserve. There are a couple of other intricacies that I'll skip over for now. For example, reserves have to include dilution. So if we had a really good idea about the white tabletops in this room, we would say our mining width, the best we can do is 1.5 meters. And these tables are only 1.20 meters wide. Therefore, we have to incorporate that extra 30 centimeters into our reserves. So reserves often have more tonnage at a lower grade because of the fact that you have to mine more as a reserve, if that makes sense. So this is the Detour Lake mine up in northern Ontario. This is a very old one of it. I think this is about 15 years old now, this plan for it anyway. One of the things that often catches people by surprise is that you don't essentially mine it all uniformly. You don't just chug your way down to the bottom. You mine it in stages. And our case study is going to work through some of these stages as well. But a couple of interesting things you can see. This is a live example from a 43-101. So here's your reserves. You can only have reserves in your mining schedule. Here's your mining schedule. This is what you're building your model on. So here's 17 years with the ore mined, the ore milled. So how much you mined, how much you milled, what grade it is. You know what the recovery is from the technical report, and that way you can start to generate your mine model. One of the things that we'll get into a little bit more when we go to the open pit mining is strip ratio. If we're going to mine these white tabletops and we're going to mine them starting at the ceiling, we're going to get down to them. This is all waste. So your strip ratio is that waste divided by your amount of ore. And you have to pay to remove that waste. It doesn't go away for free. So typically what you do is you find a high grade near surface part to start. This was actually an old underground mine that they could open up. So they've opened up an old high grade mine here, and it has paid for all of this. And then the cash flow from all of this has allowed them to do the pre-stripping, so coming from the ceiling down to the tables on all of this, which has bootstrapped its way down. Very typical and very normal for an open pit mine. But this is the mine plan that's produced from having a reserve and having a preliminary feasibility study. So here's what to look for. Identifying and understanding the targets. Like, do the rocks match what the person in front of you is saying? So if somebody comes to you and they've got a whole bunch of red crumbly rock and they're telling you that this is a coal deposit, I mean, obviously nobody would do that, but that's what you'd look for. You want to look for red flags where things don't match what you would expect. Geophysical anomalies, they may be positive, but they're pretty tenuous. Here we go, what to look for, mineralized structures. That's what I was talking about, those diamond drill holes. Looking for what the structure is. What's holding the gold? What makes sense? Or what's holding the valuable metal? Now we should, as we move to pre-resource, do they know where they're drilling? Do the step-out holes? Does each hole that we move across this table find another piece of table as we go across here? And then infill drilling, we're going to now come in, that's where we go from the 2 to the 6 to the 10 drill holes in the same area to really give you the confirmation. And that continues on after you've put these technical reports together. The more confirmation you have, the better. So when you're comparing projects, one of the tools in your toolbox should be your grade thickness. So that's why I said it's so important to get your estimated true width. So if I have a 1 gram ore body over an estimated true width of 10 meters, you should be agnostic compared to a 10 gram ore body over 1 meter. In essence, all things being equal, they're basically the same. But, higher grade looks splashier, it looks better, but in many ways, thickness is more important than the grade. The other thing to be cautious of, particularly in early stage deposits, is capping. So it's particularly noticeable in gold mining. But so what happens is, as you might imagine, for those of you who've watched any of these reality shows, gold tends to come in nuggets. And even underground, it comes as nuggets. So when it's a nugget and the drill hole goes through it, I mean, the difference of that much could mean whether it's got there or not. But if you've hit that one gold nugget, your drill intercept over 30 centimeters is going to be 1,000 grams per ton. Now, if you say that 30 centimeter section of ore that I'm looking at, it represents the size of this room, which is what you're doing as you go from a drill hole to a deposit. You're saying, I'm taking this tube of rock and saying it represents this whole deposit. If you've got 1,000 grams a ton there, this is going to be a very high grade deposit, which it really isn't. It just means you've hit one nugget in there. So you have to cap it. It used to be very easy to cap things because they would just say 1 ounce a ton's our cap and we're done. That was pretty much everybody. So 31.1 grams, that was your ton. That was your cap. Now they use a lot of geostatistics. The good thing about a mine that makes use of capping, or they all have to, but that makes extensive use of capping, is when it goes into production, you get that back. And it generally becomes a positive reconciliation. So what you've done is you've essentially added an element of conservatism because you don't know how many of those nuggets are there, whether you've just got one abnormality. I can tell you a company that I dealt with about 15 years ago, 78% of their multi-million ounce resource was in one drill hole because it had one nugget of gold in it and they hadn't capped it. So that's the type of thing that could happen. And the company went bankrupt 2 years later when it tried to go into production on the basis of a technical report that was uncapped. Once again, our Lassonde curve. Speculation, engineering, and we're going to start getting into this section now, but this is where we're headed. So just while we're here, does anybody have any questions on the geology section? Let's wait to the microphone.
You mentioned that when we start drilling, so we go for the most expensive place. We will start with the most expensive place and take out reserve from there. And then we go inside, which is much expensive. Is that correct?
Yeah, so your discovery hole will generally be sort of, it is up to geologist interpretation, but a lot of times there'll be like okay, as we walk along the ground here, we can see characteristics that are consistent with a fault. And when I was walking along here, I picked up this rock and it's got some of the good stuff that we want. So what we're going to do is we're going to start over there and drill back underneath me here. Let's see what we got underneath my feet. Now, if that comes back positive, the next thing I want to do, because I know that the strike's going this way, I want to put a hole, same angle, same distance away, over here. And then go this way, I want to do the same thing, come over here. Now, I could have gotten lucky. Remember that very, like, instead of tabular, we had the very thin lenses? I could have gotten lucky, just hit 3 times. So now I do infill drilling. So I put one here, and I put one here. And that's typically, on a vein deposit especially, that's how you're going to do it. And then you do step outs further, and then you go looking for other veins. But the first thing you do is you find the most prospective place that you can find, and then you step outwards from there. Because wildcatting is rarely a fruitful endeavor, like just going out and saying, I'll stick a drill hole there. You have to have more dollars than cents to do that.
In the TDEM, you have shown one slide. Just can you go back to that?
Say when?
Go back. This one.
This one, okay.
These anomalies, whatever is coming in the TDM helicopter examination, how far this is really proving in the practical when we do the mining?
Yeah, so usually before you fly a helicopter over, you have an idea of what you're looking for. And you've usually gotten that from various geological survey maps. So there's somebody's like, I've got a hunch. It's about all you got. You got about a hunch. This data here is actually a potassium map. So what this was done with was actually people walking this ground and picking up rocks. You can do the airborne spectrometry, and that will pick up that can pick up various other things like induced polarization, there's magnetics, there's all kinds of different things that produce anomalies. And it's generally when you overlay the different scans, whether that be boots on the ground, whether that be spectrometry, whether that be polarization, whether it be gravity, you start putting all of those on top of each other, and where you get concentrations of, let's say, density, bismuth, and polarity, that's now that's going to be a sulfide deposit. Like I know that's going to, because it's heavier, it polarizes well. Like I know that there's going to be a sulfide deposit there. So that then starts giving you an idea that here these big red blobs are probably of interest as a sulfide deposit. And what you're actually mostly interested in when you look at these types of charts is where they intersect. It's not, you don't want the hottest part, you don't want the coldest part, you usually want the bit where it transitions. So I actually don't know what deposit this was originally, but my guess is that under this Finger Lake here is probably your best bet. Because you've got a topographic low, because it's a lake. You've got a high resistivity, actually in this case high potassium mound here, and low potassium on this side. So I bet when that lake freezes, because I bet it's in Canada, that's where I'd be drilling right away.
What may be the percentage of dependency? It may be 5 to 3% minor, or it is dependable.
So the difference in density, you said?
Depending on that anomalies, we conduct the drilling. but many a times it is proving negative.
Well, like I said, the thing that we're doing here is it all depended on scale. You can make red bright red by having a very small scale. So that's why I always query whether that's actually a thing. But I'm not sure if that answered your question correctly.
Okay.
Yes, in one of the slide, you have shown the reduced area for the exploration from 500 kilometers square to, yeah, can you go to that slide?
That one?
Yeah, this one, yes, of course. So you are saying from 120 prospects up to this one and reduced area. So it is hugely reduced, 10,000 kilometers square up to, you are saying, less than 5 kilometers square. So what are the techniques you utilize to reduce the area from first one to the 1 kilometer, less than 5 kilometers square?
So the main way that you do it is actually through negligence, to be honest. So what you do is you say, I'm going to stick with my top 120 first.
Yes.
If you find something there, you kind of don't go back. So it's kind of just ignoring them that makes them go away. And then out of that 120, then now I've got to put a drill in the ground. So I'm only going to do my best. So my best in this case is 24. Stick my best in there. If I find something, now if I don't find something, maybe I come back. But if I find something and I get all the way to a mine, that's how you triangulate.
So it means it is, you are doing the hit and trial. So it will increase a cost of the, once you start the exploring the things, exploration, all these things. Why you are not using any other technique to identify, to get the concrete result, so that you will be sure that I have now, I will just focus on less than this area.
So I guess
so it will be hit and trial, and it will involve a lot of money. Because
so
you are, as you told, that you will go back if you didn't find anything.
So number one, you do go back after you've got the mine. Right? So your goal is to get as prospective as possible. So you've got the financing to do the mine. Now you've got a mine, you've got a mill, you've got a permit, you've got staff. You've got all the time in the world to go back and do all these. So they do come back eventually, if they're worth anything. But when you're an exploration company, one mine is your best outcome. You can't finance two mines. You don't finance one mine. So that's the pathway you want to go down. Now, like I said, these have resources on them. Like, you've got one mine, you've got 5 targets with resources on them now. Odds are those become reserves over the life of the mine, almost certainly. So it's not that, and why would you spend the money on something you had less confidence in when you have enough confidence in one thing to move it to the next stage, to get the financing to move it to the next stage, to get the financing to move to the next stage, to then be able to have a mine and then go back. Does that make sense?
Okay, thank you.
Can you please come back to the cash flow slide?
Which one? This one? No.
No.
Sorry,
I think it's ahead.
Further back? Starting to get back to the beginning here. That's the beginning.
No, I think it was ahead, where you mentioned that for the first exploration you need this much amount of money, and then...
She's probably, I mean, this is probably this is the time, which has a bit of it, but I think you're talking about the different technical reports.
Yes.
Which is this, right?
Yes, this one.
Yeah, this is just, that's the cost to write the report. That's not the cost of the deposit.
So this is the first slide, the first preliminary economic assessment is for the just the discovery.
No, you've got the discovery. This is what you pay for somebody to write it up in a report.
Okay. And then you came to the pre-feasibility study,
yep.
Right? Here you mentioned that it will be equal to half to 1.5%
yep.
of estimated project cost.
Yep.
What if there is no reserve there? There is no...
Well, this is what creates a reserve. You can't have a reserve without a pre-feasibility study. So by definition, before a pre-feasibility study, you have no reserve. Your goal with the pre-feasibility study is to create a reserve that shows the economics around the deposit that you may have a PEA on. You can jump straight to pre-feas if you want, but you may have a PEA on it. You have some sort of an idea. You have inferred ounces, but now you want to move to a, listen, this is what we're going to mine. This is what we're going to build. This is how much it's going to cost. That's the pre-feasibility study. That's the one that needs external people. That needs your permitting, your tailings, your mining, your metallurgy, your geo. Has to be all vetted by independent third parties.
Okay, and how about the last one?
So this one, in many cases...
Then after this, after pre-feasibility, right?
Sorry?
This will be done after pre-feasibility,
Yep.
right?
Yeah, this is afterwards. This is much more detailed. This is generally for much bigger mines. Many mines don't even have this. It's very expensive, and it's mostly done when you need credit.
Okay, thank you.
In the back?
Sorry, thank you. It's a very good presentation. I enjoyed it. But why would you say some projects don't need a feasibility study? You've pretty much got to have a feasibility study.
So I cover like 20, 21 companies for BMO.
Yeah.
Of them, and I've done this for 20 years with that many companies under coverage, I've seen one full feasibility study in the gold space in my life. If you don't need it, you don't need it. Because if you're not raising credit and you've got enough access to capital, I mean, the pre-feasibility study, by their argument, is enough, plus their internal work that they've done as they've done the commissioning. They don't need a formal document with third-party verification if they're confident they can deliver something that is accretive at that level.
Okay. My experience would be that unless it's an internal expansion, then you nearly always go to a feasibility study. I mean,
it'd be lovely if that was true, but people are in a rush.
Look. Oh, so you're saying you skip the pre-feas and go straight to the feasibilities?
No, what they would, more likely they'll do a pre-feasibility study and say that it's at a feasibility study level, which is in inverted commas.
Yeah, yeah.
It's a way that you can incorporate things that you, so the best trick that you can play if you're promoting is you take and this was done many, many times, you take a preliminary economic assessment, which you're allowed to have inferred resources in your mine plan. Say, that's pretty good. It was vetted by third parties. I did it to a pre-feasibility study level, so we're going to go ahead and finance based on this. I've covered 3 bankruptcies that did that. Okay. So we're going to move on here to the mining and metallurgy section. Oh, sorry, one more question here. Did you have questions?
Brian, what is the biggest risk you have faced in your life in mining?
Working underground. Yeah.
And how about the financial side?
From a financial side, investing in specky mining stocks. No, the biggest risk is always around management. Always. Being able to trust management. Like I said, trust isn't a matter of them always doing what is right. Trust is me knowing what they're going to do in every situation. So if I can predict them and I can predict their strategy and I'm aligned with their strategy, then that's what I want. That's by far the biggest part of any mining investment. Oh, apparently I've walked to the wrong spot again. Anyway, so like I said, technical studies. We're going to talk a little bit more about these development stages, sort of to your point with the feasibility studies. Anyway, so one of the things as you build a mine is it's an iterative process. So we've talked a bit about this exploration stage here. Selecting targets, doing the drilling, defining the resource. Then we go PEA, PFS, and then feasibility study maybe. Mining, you're selecting the method. Metallurgy, what are we doing with the metallurgy? Reserve estimation, technical this is probably the smallest part of every report, and oftentimes the part that needs the most scrutiny and doesn't get it. But like I said, it's an iterative process. If you do this and you've got a rubbish return on capital, well, go back here, drill some more, maybe find some more, or just maybe go back and look at some of those other deposits. Come back here and then see what it looks like with that. Then, oh, this does look okay. Why don't we optimize it then? That's when we start working out pit shells. That's where we work out our mine plans. That's where we do a little bit more metallurgical testing. It's also a good time to really hone in on your tailings dam. We're going to go through that a little bit as well. And this is sort of the financing, construction, commissioning. This is the development part. This is probably the most iterative part, is that as you're developing and after you've developed and when you're in construction and when you're in production, you are constantly optimizing. I had a very good friend. His overarching statement was that there is no technical report on Earth that can withstand contact with a shovel. What that means is that whatever these reports are is never what is built. You've optimized it a bunch of times, sometimes de-optimized it, but you've usually tried to make it better as you go. Every day you learn something new about it, you can continue to make it better. So what are you looking for? So a geologically sound project. We've got the drill density we want, we've got the management team that we want, we've got good enough grade to get us on site in a low commodity price cycle. Here's some risks. What about if they've put in, well, what about if a year ago somebody came to you with a gold project and they did their study at $3,500 gold? You'd call them crazy. Here we are at $4,500 gold. Maybe it works, maybe it doesn't, but you want some conservatism there. Do something that is at a reasonable level. This is the one that catches most people out, because your best data set for operating and capital is historical. There have been major waves of mining cost inflation over the last couple of decades, to where if you're using stale numbers here, where you haven't been able to get on the ground and work out what exactly is going on, these can be very unreasonable. And I'll show you an example of some very unreasonable ones, because the case study that I worked through here is about 10 years old, and it was conservative at the time. It is quite ludicrous how aggressive it would look today. So we're here to look at the fundamental concepts. This is this independent technical review. Not only do you get those on the technical reports, many investors employ their own. At BMO, I mentioned that we have 15 analysts, many of us with industry experience, including myself. We have, I think, 50 or 60 bankers. Many of them have relevant experience themselves. However, we hire independent third parties to vet our investment decisions. So having that peer review is invaluable even to us. And management experience, I would actually argue, as much as it's management experience, it's experience with management. So my experience with the management team. So here's where we're going to go now. We're going to look at this mine design. So resource estimate, we sort of looked at that. Mining method selection, reserve estimate, metallurgical test work, processing method, and economic assessment. So here's what we're doing. This is a one-year process. This is Masbate in the Philippines. It was an overgrown historic mine, sort of a decrepit mill sitting there. There's a big harbor sitting over here, sort of a mountainous range. It's still, so this is Q4 2008. It was commissioned in Q4 2009, and it is still running today. It's getting towards its twilight years, but it's still running today. So the iterative process we're talking about is from this sort of overgrown, sort of difficult to work in environment, to this sort of, I guess, for me as a mining guy, a very neatly landscaped area is the process that we're going here. So first thing we have to work out, when we've got this deposit, are we going to do open pit or are we going to do underground? So let's go through some of the key facets of open pit and underground mining. What are we going to do here? Well, here's a picture of an open pit. There's your surface. Oh, I should do it this way. There's your surface. This is the road. Here's another bit of the whole road. It actually goes around like this. There's the face and the wall. don't know if you can see that little blob there. That's a truck that's taller than this room. So to give you some sort of notion of the scale of this. It's Atalaya mining for anybody that's interested. Here's what we're doing. Now, in many cases, the ore will be, well, you can see the pit floors here, so the ore will be concentrated on essentially what it looks like one side of the pit. You're like, why are they doing all of this work to mine one side of the pit? Why don't they just go straight down? Why isn't this like this? Well, simply because it falls. So this angle has to be very carefully calculated, and it's calculated based on the rocks, not necessarily the ore rocks, but the waste rocks and just the rocks that are there. And you'll actually even see this change over the course of a mine life, where it'll be shallower up here where it's more clayey and breakable, and more steep in here, because you want this to be as steep as possible but not fall in on you. So here's a working bench. So what we've done here is we've blasted, and we'll get to this in a minute, blasted, and then there's a big excavator sitting in there, putting the rocks that you've blasted into a truck, and then that truck goes from the working bench along the haul road, and then up to either the waste pile if it's mining waste, or to the ore pile if it's mining ore. So here's the step. Each step is a bench, but this pit angle is kind of what sets your strip ratio. So remember we were saying here, white tables, that's what we want. The rest of it, that's waste. So if the rest of it's waste, to get to these white tables, we couldn't just mine this vertical wall. We would have to lay back so that the rocks don't fall down while we're trying to scrape away these white tabletops. So that additional amount goes into your strip ratio, and you have to pay for that. You are mining that rock. And that rock, I mean, these days in a typical open pit, $3 US, $3.50, $4 US, in that range, depending upon where you are and what the conditions are, just for the waste rock. And then you've got to get the ore that you want, and after you've gotten that ore that you've now paid another $3.75 or whatever for, you've got to pay to process that. That has to get through, in most cases, crushing, grinding, treatment, tailings disposal, sometimes a refinery. There's a lot of cost that each ton of ore has to bear. And one of the big things you can do is get this as steep as possible and as efficiently mined as possible. This is one of the most iterative processes of your mine design, because it's something that you can develop as you go, because as you are doing the drilling to put the blast holes in, you're assaying those. You're learning more about your deposit as you go. So you could be finding parts of the ore body that you thought were waste actually have a bit of ore to them, which reduces your strip ratio because you were going to have to mine that anyway, but now you know that it's ore that you can put through the mill. There's a whole bunch of things that come together for that. Here's the process. So you drill. This is a form of RC drill. So this is where we get to like a stylized conversation, I guess. Australians do separate grade control drilling, and North Americans do blast hole assays. So this is drilling a hole to put explosives in, but they can also do the assays there. Explosives are in, we've got a drill pattern here, and blast it, and then you've got your big excavator loading into these big trucks. You can have, well, you will almost certainly have multiple excavators in any open pit, and typically the way that you split up where they sit is you want your biggest excavator on the waste and your smallest excavator on the ore. And one of the other things, the way that you end up sizing things, typically you want 3 to 5 of these buckets to fill each truck. Otherwise you're sort of wasting time. And time is important for productivity. And there's the big trucks. So just sort of very briefly wrapping up open pit mining. Why is open pit mining better or worse than underground mining? Well, it is safer. If something goes ping in an open pit mine, you got a good chance of dodging it. If it may be a long way away from you. You're just not in a confined environment. On average, I think it's changed a little bit over time, but on average, the safety record of open pit mines is 5 times as good as underground mines, just because of the higher level of risk. Because you can use big trucks, big outdoors, big holes in the ground, you can pull a lot more dirt out a lot more quickly, and you can automate that. There's some great videos from Rio Tinto showing their automation of their haul trucks at the iron ore mines. Some of the risks. Pit wall stability. So that's what I was talking about, being able to lean those wall back, to the least amount you have to, but to enough that you're comfortable. Large equipment. One of the most dangerous jobs in an open pit mine is changing truck tires. Those machines are big, and they, if they run you over, and even if you're in a pickup truck and they run you over, they don't notice. They just keep going. Waste rock disposal. You don't have that so much underground. Underground, you're being much more targeted in where you're going. Here, I think you saw on the detour example that we had there, it had a 5-to-1 strip ratio. Every ton of rock that you pull out, you got to find a place for 4 tons of rock to sit on the surface somewhere. So what are you going to do with it? And what happens if that rock has some acid generation capability? So, if rain falls on sulfide rock, generally speaking, you produce sulfuric acid. That's really bad in your watershed. So it all has to be treated, and it all has to be limited contact to water, and it all has to find a space. What if you're on mountain sites like a billy goat? Where are you going to put a waste rock pile? You can't put it down in the valley. There's a river running through the valley. You have to find places for rocks. You're also at the mercy of the weather. Underground, weather's always the same. It's like being in an office tower, except a lot hotter. But it's very repeatable. The open pit. I'm astonished by how many times I read a press release from a company that I cover that's active in Canada that says it was cold this winter, and that's why we didn't make our production. It's always cold in winter. It's ridiculous. They always seem surprised. Or a mine in Papua New Guinea, it said it rained a lot in December. It happens. Anyway, you're out in the open. Things don't operate as well in the open sometimes. And a more important thing nowadays is air quality. Those big trucks, those big excavators nowadays are often electric. The trucks are more and more becoming electric, but those big trucks put out a lot of diesel fumes. Plus, you can even see it in this picture here. This big pit, a bit of a breeze blowing through. It's in the Atacama Desert, and there's dust blowing everywhere. How'd you like to live down breeze from that? So, open pit mining is generally more difficult to permit because you're creating a hole in the ground that's obvious to everybody, and that air quality impact is an issue. Many cases, the initial capex is higher. In the porphyry that we've been talking about off and on throughout this presentation, one of the things that needs to be addressed fairly early on is when you make a concentrate from the copper ore that comes out of here, what else is in it? And what I mean by that is, with the copper and maybe some gold, is there also some arsenic? Is there some mercury? Stuff that the smelters don't want that you're going to have to pay for them to get rid of. In bigger mines, you have infrastructure issues. You want to be close to, so think of the iron ore mines up in the Pilbara. Half of the reason they exist is because of the rail network, because that's what's actually giving them the economies of scale to basically be able to meet their mining costs. Power. We're going to talk about metallurgy after this. The biggest power input to every mine is taking big rocks and making them into little rocks. You have to have megawatts of power to be able to do that. And if you're in the middle of the Atacama Desert, there's not a power plant nearby. There's not a river to go for hydro. I don't think they've permitted too many nuclear installations yet. So you're going to be generating power on site with heavy fuel oil, with diesel, with whatever. You've gone from a hydro-powered plant on grid in Canada that pays 4 cents per kilowatt hour to something in Kalgoorlie, Atacama, somewhere like that. We're now talking 30, maybe even 40 cents per kilowatt hour when you're powering not on a grid. That's a massive input to your costs. So now we're going to switch over to underground. So a lot of the way to explain underground is that how it's different from open pit. The first thing you have to know about underground is that underground miners are all a bit weird. They call everything something different from what you would think. That, not a tunnel, it's a drift. That is not a slope down, that's a decline. That's not an entrance to the decline, that's a portal. This is not an elevator, it's a shaft. That is not an elevator car, it's a skip. When you talk about the top of a drift, that's the back. When you talk about the sides, it's the ribs. Everything has a different name. I'm going to try to use the English names for things as much as possible, but just be aware that there are strange names for pretty much everything. What do we need to know when it comes to underground mining? In this case, this is what's called long hole stoping. Probably the most used underground mining method in the world. There are plenty of others that are used quite widely. This is probably the most used. What are we doing? So you can see that we had an open pit. It was mined as an open pit. And this, if we assume that this ore body used to continue all the way to the surface, all they were doing was mining that blue stripe. As they went further down, the amount of waste that they had to take for that amount of blue strip got prohibitive. Couldn't do it. So they went underground. So they got the skip here, and they put crosscuts, drifts, whatever you want to call them. They put these tunnels in, and in this case, they started mining from the top. You can mine from the top, you can mine from the bottom. In this case, they mined from the top. So this is haulage level. This is where they're bringing the ore out. This is the main level. So what will typically be happening is, remember, this goes into the page. You can see this way. So this is a transverse method. So what they're doing is they've got trucks going this way and scoops pulling dirt sort of out of the page, putting them in a truck. Truck goes along here, drops it into an ore bin. Sometimes there's a crusher underground, sometimes there isn't. But in this case, ore bin, and then it goes up the skip. They blast this section here. Well, actually, in this case, it's this section here. But they blast that section there, and then they spend a week or two scooping it out. In this case, mucking it out, whichever way you want to talk about it. So this is a producing stope. So a stope, coming back to our white table analogy, this room is a stope. We've got a stope here. Typically speaking, an actual stope will be not far off this wide, probably, depending upon the ore body, maybe a bit narrower, and about 20 meters high is sort of typical. So when you're a truck driver, you're sitting there waiting for somebody to come. If you're a shovel operator, and typically you're doing this by remote, in many cases because of the rock conditions above your head, you'll be driving in, picking up the dirt, putting it into a scoop, or throwing it into the ore pass. So the selection is governed by how wide is this ore zone. The wider the ore zone, the more productive you can be. If this is very narrow, there are more expensive, but they're more expensive but much more selective methods to pull it out. And when it's wider, much wider, then there are less expensive and less selective methods to use. Long hole stoping kind of sits in the middle, which is why it's one of the more common methods. The other thing you have to be aware of, I think we mentioned this before, when you're underground, you're contained, you're constrained. You've got rock over your head. Sometimes, despite the best plans of man, the rock falls. It's more dangerous. The amount of work that goes into keeping the rock above your head that you want and being able to blast the rock to fall that you want, that's a science into itself. I think we've talked about ground conditions. They call it ground conditions. Obviously, if the rock above your head is very friable and breaks up a lot, it needs a lot more support. And we're not talking about like, for those of you who watched like Lord of the Rings or something, where it's like a hobbit hole with like nice little steel sets around or whatever. We're talking about spraying shotcrete. We're talking about putting in rock bolts. Never fully understand the physics of a rock bolt, but you basically shoot a whole bunch of bolts in there and you essentially make a keystone arch. I've seen the science. It still feels like black magic, but it does keep me safe when I'm underground. And then you end up blasting here, and so you want it to fall. So that becomes part of the challenge to be able to do all that. So as I was mentioning, there's various selection, more selective and less selective types of mining. Your most selective is probably shrinkage stoping here. So this is a form of stoping, but the holes are not as long. You leave the blasted ore here as ground support. You can do shrinkage stoping, you can probably do about that wide. So if we have an ore body that's going fairly steep, you can probably get it to about 30 centimeters if you're a very good miner. Cut and fill, widely used in Latin America. You simply keep stacking up on top of each other to make the stope. What a lot of this is designed to do is to reduce the need for extensive cycle times and ground support. This long hole stoping is what we talked about before. Sublevel caving and block caving, it's where we have big ore bodies. So your big porphyries, like those ones we were talking about in Chile, they extensively use block caving once the open pit is done. So when the open pit is down far enough and the strip ratio has gotten prohibitive, we come here and we do block caving. To give you a bit of an example, my cost numbers are probably out of date. We were talking about open pit mining being, let's call it $3.50 a ton. So every ton of dirt moved, that could be ore or waste, call it about $3.50 a ton. When you're talking shrinkage stoping, you can be talking well over $300 a ton. So you have to have higher grade to make that worthwhile. When you're talking long hole stoping, now you can get towards $50, $70 per ton. Block caving, you're more like $12 per ton, depending upon the size and how everything's going. So you need progressively less grade to pay for the technique as you become more bulk mining, but you also, these take progressively less waste. So there's a compromise. So there are some other advantages. Number one, you don't have a big hole in the ground. So if you don't have a big hole in the ground, you're not making a lot of dust. It is usually smaller scale, usually less resources, and that's less resources in terms of power, less resources in terms of consumables, but more resources in terms of labor. So to be clear, an underground mine, about 50% of the costs are labor, and an open pit mine, about 50% of the costs are fuel. So lower use of resources, less intensive land use. You can put it on a smaller place. You're actually extracting less material. You don't have those big waste piles anymore. So your tailings dam is smaller because you've extracted less material. You don't need to have a place for your waste rock. So you make a much smaller footprint. Less contact with surface water. Your dust all stays underground. It's less noisy because it's underground, but it is riskier. Rock falls, confined space, large mobile equipment. The first job I had underground, I took over from a guy that managed to drive a remote-controlled bogger into himself because it was coming back towards him. He wanted it to go right, and he forgot that when it's going backwards, go right means go left, and he drove it straight into himself and smashed him against the wall. So that's the type of thing that you would run away from, you wouldn't have an issue with, or you'd be far enough back from open pit. Underground, you just don't have the room to get away. Ventilation issues. What that mostly means is that you have to put in ventilation, so you have other shafts that have big fans on them that are moving the air, because all of this equipment generates a lot of smoke from the diesel engines. If you go to a poorly ventilated mine, it feels like you've smoked a packet of cigarettes when you're down there. Like it's tough on your lungs. Plus a bit of dust if they're not in the dust suppression. It's also one of the big reasons we're seeing a big move into electrification of underground equipment. We'll probably see, I think that most of the equipment suppliers will go to predominantly electric by next decade. Obviously you need a lot more training. You need a lot more specialized labor. That's the other thing. I think most of us in this room could probably fancy ourselves at being able to drive one of those big trucks. It's just like driving a car, except bigger. But operating a jumbo, making a drill pattern, that's specialized labor. And then if you get to the more exotic, more selective stuff, it's done by hand. So you've got a guy with a jackhammer just pumping into the wall. So it's also hard work that requires labor, requires specialized labor. And if you want to dial it up completely, try coal. It's all that plus flammable. So mine development. We're still on mine development here. So construction, post-construction. The thing to be aware of is that as an investor, this is where you lose your shirt. That downward trend that we've seen between resource and production, that's this on that curve. So I was asked Thursday last week by an investor, said, can you give me a list of Canadian mines that have been developed over the last 5 years with significant cost overruns? It was a very easy list to give him. I then thought whether I could give him one where there wasn't a cost overrun, and it was a list of 0. So it's been very challenging, particularly lately. Most of the very competent, experienced managers of this did retire over the pandemic because they weren't able to travel and get to these things, and they thought their life was kind of okay without doing that. And it comes down to management expertise. And in many cases, this is subcontracted. There are quite a few firms out there that pride themselves on being able to build a mine. But even when you're using the best of the best, you need somebody in-house that's making sure they're doing what you want, that they're not overcharging you, that they're not straying from the plan. Because, you know, there's a good contractor, but nobody loves a mine like its owner. So CapEx, and that's mostly CapEx. The final stage, so this is actually what I did for a living for most of my career. Commissioning, I was a commissioning engineer. So basically what that is everything's built. Now we just have to make it work. So I used to go in there, it was bucket chemistry and firefighting, but it's what makes a mine go from first production to first commercial production. So in this case, that's a gold pour coming out. In this case, those are copper cathodes. So there is no fixed definition for what constitutes commercial production. The reason that it's modestly important is that it moves your mining costs and revenues from your balance sheet as pre-revenue CapEx to your income statement, and you're now more able to be judged better on things like EV to EBITDA, price to cash flow, and those types of things. That's why it's important. A typical definition would be 60% of throughput for 30 days in a row, but there is no standard definition. Permitting, I think we've touched on this a few times. Whatever you think of your property, no matter how good you think it is, and no matter how quickly you can drill it, you still need years to do the permitting. That's environmental baseline studies, what do they call it? Bugs and bunny studies. You need water studies. How much does it rain? When does it rain? Where does the water go? What's a 100-year event look like? So biodiversity. Who works here? Who lives here? What are they doing now? How are we going to impact them? All of these things here go into a permit. And it's also kind of the time that the government gets to have a bit of a say on what it thinks about your project. Maybe there's some social programs that the government wants. The most common thing you'll see is schools, hospitals, all being built near mines. It's part of the government thing. It's not required for the permit, but I would say that if you didn't do it, it'd be difficult to get the permit. And this public review needs to happen all of the time. This is one of my favorite and least favorite things to put up on the board. So this is the Fraser Investment Attractiveness Index. They put it out every year. It's probably the most quoted benchmark of geopolitical safety in the mining industry. It's mining specific. It is, by my reckoning, kind of a popularity contest. You'll see that in 2024, Finland, the well-known mining jurisdiction of Finland, finished number one. Finland actually does have some mines. I cover some mines there. It is actually a very good place to go mining. But I think most people would have expected Nevada to finish number one. I've actually never seen Nevada at the top of this index, and it changes every year. For example, New Zealand, all the way up here now. It used to be way down here. I would say that Mali is going to take a trip south this year. There's things, I can quibble about this, but it is the most quoted index there is out there. It's kind of the only one we've got. And it's basically a survey of mining professionals saying, where would you like to stick a drill hole? That's kind of it. So the main thing that comes down to, I guess the other thing I didn't mention is to pay for my sins. I do have a law degree. So legal framework, strength of contract law, property laws, being able to get through the regulatory process, all of these things, transparency of mining regulation. Do you have what you have when you think you have it? And I was actually talking to somebody after the previous session this morning, and they said it's not so much that when you set up a regulatory framework for mining in, let's say, a country that isn't known for its mining, that it has to be the right system. Because as much as a country can put a system together, the mining companies are fairly well fiscally incentivized to find all the loopholes they can. And so when they go and do that, and the government is now not getting the revenue that it thinks it deserves, it gets pretty upset about giving the permits on the basis of the revenue it thought it was getting, because foreign company X did a tax mitigation strategy that wasn't sort of on their mind at the time. And I've seen that happen quite a few times where the real permit dispute isn't the fact that the company's done something bad, although there'll be some sort of press headlines or whatever saying that they're causing the death of a fish or something or other. What it really comes down to is that the mining company was too aggressive on its tax mitigation. Funding options. I think we've talked about this for the most part, but we will have presentations from most of the people that do this over the next couple of days here. And all of these people rely on, well, actually some of them rely on people like me, and some of them rely on third-party people, but these are all where the financing comes from, depending upon the size, the style, the metal, what subsequent processing needs to happen. That will determine whether or not, what type of financing you get. And this is kind of the key slide that I was using in my presentation this morning. You can find pretty much any number of these types of things. This was the one that had the prettiest slide. So here's 27 mines from 1995 to 2022. So a pretty good long span. They all have an EA certificate and they are predicted to open. So they are most of the way permitted, if not fully permitted, and everybody thinks they're going to go ahead. Of that 27, 14 actually made it into production. 13 got dinged for a non-regulatory issue, for permitting, for lack of financing, and some, just didn't work out. Of the 14 that did work out, 7 mines made it in time, and it doesn't say anything about the budget on there. The others, they went way over budget on time and on money. So you can think, when you've gone through the amount of work that it takes to find a deposit, delineate a deposit, do all the studies, get the capital together, get the permitting together, you've got a 1 in 4 chance of making it work from there. So it's astonishing how much of a gamble this is. 16.3 years from a drill in the ground to rocks out the ground. It's a long, long way. Now, a lot of companies would say that this is a bit of an exaggeration because by definition these days, there's not too much new in the world to discover. A lot of new mines that are coming on are actually old mines that are being reimagined, whether that's because of a higher commodity price or because of better technology. Nevertheless, 16.3 years from a drill in the ground to revenue out. And it's getting longer, it's not getting shorter. One of the things that I would highlight is that many jurisdictions around the world today are implementing what's called a fast-track process. So they will guarantee that within 12 to 18 months of you submitting your permitting documentation, you will have an answer on your permit, yay or nay. What that's actually done is made it go longer. The reason for that is because bureaucrats have 2 speeds, the speed that they're currently going and stopped. And what happens is, in order for them to meet this quick approval, fast-track process, they now have to be confident that everything that's supposed to be in that document is in that document and it's in the right format and they know how to get it. So what they do is they won't let you enter the process until they've vetted everything that you've put in before it. So permitting, despite many jurisdictions trying to speed it up, has actually gotten slower by trying to speed it up, which is somewhat counterintuitive, but nevertheless, it has added to this time, not subtracted. And it wasn't that long ago that commodities were really tough to finance. Now you could argue that the mines are fairly easy to finance, but because they're so cyclical, the industry is so cyclical, and it takes 16 years, it takes a cycle basically to build one of these things, you either have to be confident that you've got a mine that will last the cycle and be able to reap a harvest when the good times are here, or you have to have something that is so accretive so immediately that it can be financed and be done whenever, in whatever point of the cycle. That becomes a problem as well. Enough of that rant, I guess. And this is a typical chart that you'll see in many presentations. And once again, the Lassonde curve. So technical studies, we've gone through those. Each development stage, you do get a bit more valuation. You also, I would say, as much as you unlock value by doing each development stage, you also get access to a new group of investors. There are some people that simply won't invest in a pre-revenue company. There's some people that simply won't invest in various metals. Each development stage does unlock a different group of investors. It's risky. and it's one of the riskiest businesses out there. So I think you asked, what's the biggest financial risk I've taken? Mining is pretty speculative, even with somebody that sits in the space. So now, actually, maybe I'll just pause there if there's any questions on this part, because we're going to jump into a couple of case studies. They're going to take a fair bit of me talking around. We're going to talk about how we take those open pit and underground theories and put them into sort of a more worked case study. And then what we do once we've got the rock out of the ground, how we make that into a metal. So we pause here for a moment if there's a question. Yep, I'll continue on then. And I'll tell you that my editors did me a bit of a disservice. They cut off, some of the bits got missing here. So once again, we're going back to our porphyry model. So fluids flowing up here. This is a heat source. This is the magma chamber that's going up to the volcano there. So the volcano is not erupting. It's just a big thing of heat. The fluids are coming in from the sides here. They're coming from that subducting plate full of seawater that's now gone underground, and it's come down here where we're 5-10 kilometers under the earth, and it's 450 degrees centigrade. It's I think tens of atmospheres of pressure. So it's still liquid. It's really salty because it's dissolved all the stuff out of that crust and a lot of the stuff that it's sort of come by on the way here, and now it's looking for a way out. It's hot, compressed, salty water. It finds this here with the heat, and there's a lot of things that can move around here. So it comes up here, and in this case, it becomes a porphyry because we go from hot to cold. That's it. Hot to cold and a bit less pressure because you're closer to the surface. So everything deposits right there. It makes a relatively homogeneous ore body. It's like thin veinlets. So in a previous version of this presentation, there's a picture of my foot on top of a porphyry deposit. Like I said, they're not difficult to find, and the length of my foot has probably 3 or 4 different veins going through it. So from a mining perspective, it's very homogeneous. So this is, once again, typically what we use to mine for copper. Big copper deposits. Think Atacama Desert. So this becomes something that I've turned into a stylized deposit here. So this is a cylinder, 460 meters in diameter, 800 meters high, and just 100 meters below the surface. Like I said, the erosion has happened. Upthrust have happened. We've got a cylinder that we want to mine. We're going to mine this as an open pit. It's big, so let's see. It's got 1.8 million tons contained copper, 5.8 million ounces contained gold. You can see my copper and gold prices are quite out of date by now. But even at those prices, that's $19 billion worth of revenue, of which 38% is gold. One of the easiest things you can do as a sniff test is think of what a cost could be for something like this. NSR, that's how much you get revenue for each ton of ore that you pull out. And that is basically the grade times the prices to get that. That's your budget, right? That's what you're working with. That's the per ton. All of my costs have to be less than that. So, open pit. We've got 100 meters of pre-strip, and then as I showed you on the detour version, we mine in stages. One cut, two cut, phase, right? Now, the interesting thing to note, it might actually be here somewhere, there. So you see the strip ratio as you go through here. Phase 1, strip ratio is 1.6. By the bottom, it's 20, well, 18.7. So your average is 9.2. That's quite a high strip ratio, actually. But that's, so we've got a 47-degree pit slope, and you can see that each one of these cuts gets, from a mining cost perspective, progressively more expensive because we have to take all that waste versus just that little bit of waste there as we go further down. The other thing to be aware of is you've got heavily loaded trucks that are now going an extra 800 meters of elevation to get out. So you're paying for more fuel. usually you need more trucks because it's further to go there, and you still want to mine at actually a faster rate now because you've got to mine all this waste as well. There are some accounting tricks you can do by capitalizing some of this, but let's put all that aside for now. It's a profitable mine. Makes money. It's not the most profitable mine. Payback's only in 10 years. But what we've done is we've got 900 meters deep because you've got the 100 meters and then the 800 meters. 2.3 kilometers wide, so from here to here. So you can imagine permitting's not going to be too easy. 3.3 billion tons of waste that I have to find a home for somewhere to extract just 360 million tons of ore. Well, you have to make your own, mate. So you have to find a place to dump it. Like, yeah, well, you got to. In some cases, you have to line it. It's not like a landfill where you put your garbage. You're making that pit. You got to remember when it's broken, when it's been blasted, it's bigger. So you have to make that big of a hole into twice as big of a mountain somewhere. So pre-strip, 100 meters from the top. That costs $160 million at, like I said, there was some fairly generous, so I had mining costs of $1.75. It's basically double that now. But that's the smallest part of your CapEx. We have to work out what we're going to do with the mill. Bringing the dirt out of the ground doesn't bring copper out of the ground, it brings dirt out of the ground. We have to work out how we're going to convert that dirt either into copper or into something that can be used by somebody else to turn into copper. And I'll get into that in a minute. So payback 10 years, mining costs, we've got something that's profitable. Now, one of the things that I wanted to talk about briefly, sort of to your point, not only do we have to find a place to put the waste, one of the best places you can put waste is in your tailings facilities. So we'll get to this in a minute, but one, you've pulled the dirt out of the ground. You've got rocks that range from the size of a small family sedan down to dust. We need to get those to a certain size in order to be able to process them. We're not doing that to the waste, just to the ore. So the ore we want to be able to process. The way that we work out what size to process, what size we need to get it down to do the processing, is we want very few binary particles. So what do I mean by a binary particle? Even within an ore body, when you're in ore, a lot of it is still waste. Like much of it is still waste. And by waste in this case, I don't mean like mining waste, I mean just stuff that I don't want. And so the ore being the stuff that I do want, and the waste being the stuff that I don't want, I want them to be discrete particles, so whatever I do to them, all waste goes one way, all ore goes the other way, and I don't get ore in the waste or waste in the ore. So in order to do that, in this case, we have a porphyry system. So we're going to get down from the size of a small family sedan to probably in and around 150, 100 microns. So we're going to crush and grind down to about 150 microns, let's say. And then we're going to do flotation. What's important to note for this, after all the stuff that we've taken out of that, we still have, even of the now ore amount, we have like 90-something% of it that we have to get rid of. So not only do we have to stack our waste somewhere, the waste rock, we have to flush the stuff that came out of our mill, which is separate, and it's ground fine. Like the waste rock is just big rocks. That is ground fine, which is a problem for environmental things. It's also mixed with water. It's not great seismically. It tends to be reactive to the environment. We need to contain this. We do that through a tailings dam. The reason I've added this slide over the last 5 years or so is because it unfortunately became very important. We've had some massive tailings dam failures. We have ICMM here, their biggest push right now is tailings dam safety. I would be very skeptical in all but very few situations if somebody came into you with a new project they were building and they said, we're going to use the upstream method. It is the least seismically safe. It is the one that failed at Brumadinho. The reason that you do it is because it's cheap. Now, you have to remember, everything in mining is about how much it costs to move rock. If we look at the downstream method, the first thing we do is build this. It's kind of like the phases that we saw of the open pit mine. We do it a phase at a time. So put this phase here first. This is often waste rock. It's engineered, like you sometimes crush it, you add clay, you do a whole bunch of things here. But you put this here first, and then the next lift goes here. Can you see what happens when you get over to here? How much more rock that is than this here? But the disadvantage, so on here, every single step that you take is on ground that you know or ground that you have created. Here, it's just it's a slurry. It's just water and mud. So when you start putting tailings on top of that, and an earthquake happens, or something gets out of control, or if you have a leak, whatever, which can happen, then you end up with a catastrophe. Centerline is sort of the compromise between the two. These days, smaller mines tend to go with dry stacking, but it's often prohibitively expensive. That's where instead of putting water and essentially mud here, you filter it. You get all the water out, and you just stack dirt. But it is quite expensive to do that. So the next thing I want to talk about is get back to metallurgy, so my stock and trade. So we've got rocks this big. The first step we need to do is we need to get them down to about that big. And we do that by crushing. So crushing can be, generally speaking, with a jaw crusher, which is sort of like it implies. Fixed plate, like this, put the big rocks in the top, they jam up in the bottom, get pressed together, they make smaller rocks. So that can be in one stage, or more likely, you have a screen at the bottom. Everything that is coarser than that screen can either go back to this original one or can go to a second one, but you don't want to be re-crushing the stuff that's already at the size that you want. So you take that and you move that to the next step. So you can have various different types of crushers. There's jaw crushers, there's gyratory crushers, there's cone crushers. For lack of a better description, it's the beginning of pretty much every milling process. You generally want to get your rocks down to about that sort of size, and it can be primary, like you can have one stage, two stage, or three stage. If it's three stage, it's probably something funky happening. If it's one stage, it's probably something funky happening. It's usually two stage. So once we've got it down to, let's say, 1 inch diameter rocks, then we've got to get down to that 150 microns. In gold mining, that's typically 75 microns, as an example. So we're talking really small. So what we do is we add water to it, and we tumble it in a mill, basically like a tumble dryer. And we can have a ball mill, we can have a rod mill, we can have a sag mill. So a sag mill is a ball mill with less balls, but the rock is of a type that it breaks itself a bit. And we can have a fully autogenous mill where the ore breaks itself all the time. The most common thing you will see is a combination. You'll see a sag mill, so big balls, big mill. So the mill itself will be, I mean, generally speaking, bigger than this, taller than this room at least. And you'll go from that to ball mills. And this, instead of having screens, because you don't want to screen a muddy slurry, you have cyclones that can separate the coarse from the fine. So we then go through that, and we get it down to the size that we want. And then there's sort of two paths that we can go down from there once we've got it to that size. One is flotation, and there are other processes out there. One is flotation. What flotation does is it separates sulfides from oxides, and the other is, and it basically works on froth, and there's leaching. And what leaching does is it dissolves the actual metal that you want. So to characterize each in its own time, it's probably easiest, so for a porphyry of this type, the gold is generally within sulfides, generally chalcopyrite, and that is a sulfide. You want to separate the oxides from the sulfides because the oxides don't have any copper in them. So to do that, I'll use a story that I learned at BHP. It's completely fabricated. I make no bones about it, but it is part of the ancient law of BHP. BHP stands for Broken Hill Proprietary Limited. The way that they made their fortune essentially was being able to buy all of the tailings dumps of all of the copper mines at Broken Hill and process them using the process of flotation. They were one of the pioneers of flotation. And the way that they are supposed to have learned about flotation was an Irish washerwoman called Rosie O'Grady. So what Rosie O'Grady would do is she would take her husband's clothes after his full day at work, put it in the wash basin, start working with the soap and scouring it through. And she noticed that all the stuff that her husband said was the good stuff was sitting on the froth. And all the stuff her husband said was the bad stuff was sitting in the bottom of the basement, of the basin. So she went to management and said, I reckon if you wash that ore, you'll be able to get some good money out of it. It explains the process of flotation very well. Rosie O'Grady is completely fictitious. Froth flotation was invented in the 1880s by a German scientist, and BHP came about it quite honestly. Nevertheless, that's the story that explains flotation for you. So sulfides stick to bubbles because they're hydrophobic. Oxides sink in water because they're hydrophilic. They soak up water. So when we take the sulfides off, those sulfides are now our copper concentrate. The vast majority of that material that we've taken off is chalcopyrite. So chalcopyrite is about, I think it's 36% copper by weight. And it also carries the gold with it, so it's associated with that. So what you're then going to do is take that. You're never going to get the 36 because you're not making pure chalcopyrite. It may have pyrite, marcasite, arsenopyrite, all sorts of other things in there as well. Because like I said, all you've done is taken the sulfides off. Generally speaking, you haven't done too much to make it just the copper sulfides. Therefore, when you sell it to a smelter, which is what you usually do, you sell that concentrate to a smelter, they are going to pay you based on the copper content, and they're going to want above 29%. I've seen as high as 33, but definitely above 29%. So that's sort of the wiggle room you have on your copper concentrate. So that's what we're going to do with our porphyry. The smelter's going to deal with our concentrate that we've made by crushing, by grinding, floating. Concentrate goes this way, tailings goes to the tailings dam, and that's basically our porphyry system. However, if this case study was a weathered porphyry, so that means that it's been up at the surface for a long time, there's been a lot of wind, rain, doesn't really ever work this way, but the top areas of porphyries are often oxidized. So if we were to say that this was a fully oxidized one, now you can't float it. Not easily, you can't float it. So we have to find a different way to get the copper out, given that we can't create this sulfide concentrate and sell it to a smelter. So what we're going to do now is we're going to take that now 150 micron ground oxide material, and it's all oxide, both the stuff that we want and the stuff that we don't want. It's all oxide, and we're going to tip acid into it. And what the acid does is it dissolves the copper out. And so this is what becomes your SXEW plant that you'll probably hear about. You can also do this on a heap, and we'll get to heap leaching in a minute. But in a vat leach, so big tank, lots of material, stirred with acid, you then take the liquid, because what's happened is the acid has dissolved all the copper. The important attribute of oxides in this case is that liquid can get into them. Sulfides are glassy, they don't allow liquid through them, so they can't, you can't do an acid leach on a copper sulfide and get decent recoveries, because the copper is entrained in the matrix and you can't get it out. When it's in an oxide format, you can get it out by dissolving it in acid. In that case, we dissolve it with acid. We take that leachate, it's called, so it's a highly acidic copper sulfate solution, and we do what's called SXEW. SX stands for solvent extraction. Solvent extraction, you basically whiz it up with a bunch of quote-unquote kerosene, and you take a large volume of the leachate, the acid solution, and a small volume of the kerosene with a bit of other chemicals in it, and all of the copper that's in here, because of what you put in the kerosene, wants to be in the kerosene. So you basically make this blue, bright blue acidic water go clear, because now all the copper's in your kerosene. And then when it's in the kerosene format, it's not really worth that much. So what you do is you then aggregate all that kerosene into a big volume, and then you put a small volume of very acidic material in, and the copper then comes back out, and then you can do what's called electrowinning. So we have now a very strong solution of copper in very strong acid. And if you've done the experiment in high school where you took your key and you dunked it in a bowl of copper sulfate, you put the copper sulfate crystals in water, you dunk it in there and you apply a bit of a current to it, and you end up with your key being copper coated. Maybe I'm the only nerd that did that in chemistry class, but that's basically the process of electrowinning. So for electrowinning, we produce, from electrowinning, we produce what's called cathode copper. Cathode copper is generally a pure, saleable, 99.99% copper version that you can sell direct to the exchange. The smelter concentrate that we made from that flotation process, it goes to a smelter, and then the smelter uses heat and oxygen to basically convert that, minus a bunch of other stuff, they convert that into copper metal, and that becomes copper anode, which they then do a subsequent electrowinning step to make copper cathode. So we all get to copper cathode in the end. A lot of people really like oxide copper projects because they're cheaper to run and you get the revenue right there. But there's not many of them in the world and they're not that big, is kind of the problem with them. So that's a very small detour through the world of metallurgy. So the, yep.
So the tailings, you have to worry about more?
Worry about?
Radioactivity?
So in some cases you do have to worry about radioactivity in your tailings. Obviously if you have uranium in your ore, because now you've essentially concentrated it, it's kind of rare though, you don't see that too often. I've only really ever seen that in South African gold mines, where they've actually been worried about the radiation coming from those tailings. So it's not that common. And in many cases, uranium mines, well, in many cases they're done in situ, so there's not a tailings dam. So there are situations where you don't have to make a tailings dam. We'll get to those in a minute. I'm going to give you a very brief overview of a different type of deposit. This is called a VMS, so a volcanogenic massive sulfide. This tends to be at the bottom of the seafloor. This is what's called a black smoker. If you watch National Geographic, you'll see a lot of pictures of tube worms hanging around here. They say this is kind of where they think life was first formed, in this type of chemical environment. What ends up happening here is you end up with the sulfides, that sulfide liquid coming up, and it just goes straight up. It doesn't get trapped in anything. It just goes straight up into the ocean. So we've got the ocean here, and then it deposits. So it's like a mini volcano that blasts sulfides into the water, and then those sulfides over millions of years deposit. And then after a while, Earth moves, tectonics move, it comes out of the water, and if you're lucky, it gets folded and tipped on its side and looks like that. One of the other things to know about VMS is if you have somebody coming in with a VMS, they're typically found in clusters. They're typically very rich but kind of small, but if they can get their hands on a decent cluster, they're pretty good. They tend to also come with a bit of a chemical soup. Copper, lead, zinc, gold, silver, all in the same thing, all in sulfides as a general rule. So now we have to take copper sulfide, lead sulfide, zinc sulfide, and the associated gold and silver. They're not sulfides, but they are associated. Generally the silver goes with the lead and generally the gold goes with the copper, but it can vary. We have to separate those. And yes, we are going to use flotation again. But the reason that I'm bringing this up there is in our porphyry example, we just did what's called a bulk float. We just took all the sulfides and shipped them off to the smelter. Here, we're doing a differential flotation, because what we can do is we can add chemicals to basically the soap that makes the froth, so that it will be repellent, well, in this actually it'd be adsorbent, but repellent to, like we'll do the lead first. So that means we have to depress the zinc and the copper. So we do the lead, so we put it in a collector, so this makes the lead really want to stick to the bubbles, but we put it in a depressant that makes the copper and the zinc not want to stick to the bubbles. And then we go from the next step, now we're going to pull up the copper, and then we're going to pull up the zinc. And we can do that just using the same flotation technique with different chemicals added, and make separate flotation concentrates that we can sell to separate different smelters as well. And this is one that I use to explain heap leaching and low sulfidation epithermals. So in our porphyry example, here's your porphyry. As those fluids swing around, they come up here, and this becomes a low sulfidation, generally gold, silver. There are base metals associated with it, but they're generally not economic. But this is pretty much every gold and silver mine you've ever seen in Mexico is one of these. low sulfidation or high sulfidation. And the difference between the two is sort of the proximity to the heat. So here what we're doing is we've got a whole series of, because they tend to form up as a whole series of veinlets that are cross-cutting. So think of it as sort of a less homogeneous porphyry from that perspective, I guess. And we're going to take this one as an open pit. I've cut down quite a few of the slides here. But the thing to note is here, we have a grade of 1 gram gold and 50 gram per ton silver. At the time when I put this would have been very marginal because of the size. It's kind of small. It would have been extremely marginal to put it through a mill. So that's that leaching process we're talking about. That's crush, grind, put in a leaching, in a big tank, stir it up, dissolve the gold, electroplate the gold, and sell the gold. That would be a leaching process. Today, that's probably what you would do at these grades because you get good recoveries. And it's also important to note that to dissolve gold, gold is a noble metal. It's called a noble metal because it doesn't dissolve in much. The only thing it really dissolves in is a cyanide solution. And it's the cyanide that you're thinking it is. So you have to keep the pH relatively high. It has to be above 10.5. You have to add an amount of cyanide, and the cyanide actually complexes with the gold, with oxygen as a catalyst, and so on and so forth, but it can dissolve gold out of rocks. So 1 gram per ton, 50 gram per ton silver. Silver is typically more resistant to recovery by cyanide than gold. Gold is generally much easier, but nevertheless, in a milling scenario, sort of like what we talked about with the copper being dissolved in the sulfuric acid, when we talk about gold being dissolved in cyanide in pretty much the same mechanical devices, we're talking 95% recovery on the gold, maybe 75% recovery on the silver. When I put this together, it was supposed to be an example of heap leaching. So heap leaching is where this grade can't pay for crushing, grinding, leaching, and electrowinning. But it can pay for some. So what we do here is we dig it up, and kind of like what we were doing with the waste pile. So instead of putting it in a waste pile, we put essentially garbage bin liners. They're a bit more sophisticated than that, but we put down layers of plastic. We stack the rocks up. Now we can either do it as they've come out of the mine, like I said, size of a small sedan down to dust, or more typically, we can do one stage of crushing, maybe 2 stages of crushing, get it down to rocks sort of in this sort of range. Literally just shove it on a heap. It's called a heap leach because it's on a heap. And you put it all in a big pile, and it's literally garden sprinklers sprinkling cyanide on top of it. And as that cyanide sprinkles down the heap that you've made, it dissolves the gold, works its way down because you're continuously pouring onto the top, and it hits that plastic layer, goes down into a pond, and then we can take that dissolved gold in the pond and run it through the same electrowinning circuit that we would have with a mill. Obviously the advantage is you don't have to grind. You don't have to take it down to 150 microns. We're taking it down to 1 inch, maybe down to 2 inches. The thing that you pay is recoveries. Remember I said 95, 75%? We're now talking 75% at best, probably more like 60% here. In this case, that's why I said it would go to a mill. The delta on that recovery pays for the grinding. The other thing with a heap leach, you've built a big heap, you've taken all the gold out of it, you don't need any tailings, it just stays there. You have to do a little bit of rehabilitation and usually spray some grass on the side, but it basically just stays there. And that becomes basically your tailings dam. And you can see the prices I was using there. So yeah, I used a 74% gold recovery, 43% silver recovery. That's fairly typical for a heap leach. I put this in just because it's kind of my first love. There is what's called refractory gold. Refractory gold refers to gold that is encapsulated in non-desirable sulfides. So there is not too many places in the world that'll take an arsenopyrite con. Arsenopyrite by definition is arsenic sulfide. Nobody wants it. So people do want the gold. You can see this is a micrograph. This is actually quite large for gold, but it's about, I think it's about 5 nanometers from memory. This is sort of the size we're looking at there. So what we have to do is we have to basically do a flotation to get all the sulfides, which is the arsenopyrite, and then we have to convert the sulfide into an oxide because we can leach the oxide. And so, and there's other ways you can be refractory as well, but the way to convert a sulfide to an oxide, kind of similar to what they do in the smelter. You add heat and or pressure. So in this case, roasting, it's literally like, it's an oven that gets it really hot and adds some oxygen and oxidizes the sulfide. So sulfur plus oxygen becomes SO2, which is terrible for the environment and really hard to permit a roaster. You can do pressure oxidation. With some chemistry, you can add pressure and oxygen, and it does the same thing as the roaster, but because of the fact that there's arsenopyrite has a bit of iron in it, and it often comes with pyrite, if you've got the iron to arsenic ratio, okay, it actually deposits a relatively benign form of arsenic, which you can actually dispose in tailings. So that's the general method that's used. Biooxidation is kind of what it implies. Bacteria eats sulfide and poops oxide. And fine grinding is a bit more of a chemistry experiment. Hasn't really worked commercially, but there's always somebody trying to say that it'll work. So I'm just going to skip through these because I think I've covered most of them off here. But yeah, SXEW, so that's your electrowinning, that's your copper cathodes. So grinding, leaching, filtration, solvent extraction, pretty much the same sort of thing, makes yellow cake if you want to do uranium. You can also do an in situ leach. So instead of pulling it out of the ground and putting it on a heap, you put your leachate in here, you take it out of there, stays in the ground, no tailings dam, no nothing. Very challenging from a, you need to have exactly the right geology, and permitting is a bit of a challenge, and your recovery is very low because you don't have too much ability to steer where the liquid goes. But very cheap, as you would imagine. Your effective recovery is quite low though. Iron ore, one of the weird ones where you don't have too much of a tailings dam because pretty much everything you mine you ship. Iron ore is kind of the product. That's what you make. It relies on, I think I mentioned in the infrastructure section, relies on having rails and then having a ship to the customer, which is often in China. And we are pushing time, but we will get to that in a minute. Yeah, very little beneficiation. And this is the reason that the nickel price will generally be cyclical, in my opinion. Every time the nickel price gets high enough, the laterite mines all come in. There's 100 of them mothballed. The only reason I left this in is because the leaching in an autoclave part that was done for a nickel laterite in Gag Island in Indonesia is how I met my wife. So I put that in there. So, and then I always characterize aluminium processing as making solid electricity. You'll find aluminium is one of the most abundant elements on the earth. It's pretty easy to find bauxite deposits. You have to go through all of this, but when you want to get to this part here, all you do is you find the place with the cheapest power. So in Canada, that's Quebec, because they have hydropower, 4 cents per kilowatt hour. You'll see there's a lot of Quebec-based, that's what Alcan was. And coal, another one where you don't have too much by way of tailings, but like I said, underground mining for coal is not my cup of tea, but you know, it is the backbone of many areas in the in the east coast of the US. But you basically, your processing here is getting rid of some of the stuff, but more just getting it sized right. And this is where I try to put on my best impersonation of one of my colleagues. Oh, we've got this all working today. So we're going to go into steel making. So iron ore, coal, lime, scrap steel, depending upon which part we're into. So what do we do with iron ore when we get it out of the ground? Iron ore goes here, and then we make. So in this case, we've got the electric arc furnace to do this part here, and some recycled steel, refining, and then into casting. For a blast furnace, which is the other method of making steel, we've got coal becoming coke, goes into the blast furnace with some limestone, and then goes into pigs, so pig iron casting, or goes out here, makes molten steel, and then we go into continuous casting again. That's usually one company. Well, there's two types of companies. There's the type that use electric arc furnaces and the type that use blast furnaces. Sometimes they're a bit of both, but those are the two main methods of making steel. It's kind of the only thing we use iron ore for. I could put a chunk of iron ore on the table. I don't think anybody would find a practical purpose for it. So we've made it into steel. That steel then, through the continuous casting, can be blooms, billets, slabs, or thin slabs. The slabs and thin slabs go to plates and pipes, and that can be done hot, and it can be done cold, and it can be done a combination of the two. The blooms and billets, the big square ones, they go to seamless tubes, structural forms, and bars and rods. They're extremely spectacular to go see, but kind of boring from a processing perspective. Here is the two different methods of making steel again. Here's your blast furnace. Here's your electric arc furnace. And a little bit more detail on the electric arc furnace. Sorry? Depends upon how much access you have to scrap steel. Electric arc's usually easier and cheaper. This is how you make primary steel though, so you need these to make the scrap steel essentially. And here's the casting. Here's, like I said, there's companies that specialize in basically making these, that make these parts, the steel finishing. And this is where steel end markets are. So that's the end of that portion of the presentation. We've got a section on commodity price forecasting to come now. I'll try and get it done in about half an hour. But does anyone have any questions on the mining or metallurgy? Okay. Yep, go ahead.
A question about Saudi Arabia and the prospects for. Question about Saudi Arabia and the prospects for metallurgy, processing, refining, especially when it comes to the alumina piece that you were discussing. Any comments on Saudi Arabia's prospects in that side of the industry?
Well, given how far that type of material gets trucked or shipped, if you've got cheap power, it'll come to you. Cheap power and an efficient regulatory regime. Not cheap domestic power, cheap industrial power. Like 4 cents a kilowatt is not that much. So you figure, I don't know what I think my parents' electricity bill is like 50 or 60 cents a kilowatt hour for home. So there's a big markup. Yep.
What's a competitive price for processing mined rock? I mean, per ton, on average. Let's assume copper.
So if you're assuming that it's been mined and it's sitting in a tailings dam and you're reprocessing it, you're using hydraulics, so you're just blasting it with a fire hose, and then you're pumping it into a mill that's barely doing anything, and dissolving whatever copper is left, because you're generally going to be in an oxide format, because that would be the tailings from a flotation plant usually, so you'd actually be going for the oxide set. Your costs would be pretty minimal, probably $5 to $10 a ton less would be thinking out loud. With the presentation switched over. Okay, so we're going to go from the ridiculous to the sublime, I guess. I'm going to try to explain commodity pricing to you. If I do a good job, I'll surprise everybody, because it's a dark art. It's not something that anybody, even our commodities analysts, we have a commodities team, will admit that nobody's ever gotten it right. So this is the best attempt to show you at least the methodology for getting it least wrong. So here's some of the buckets of commodities in the world. So most people sit here, look at the LME base metals, quoted prices, traded precious metals. They're more traded than they used to be, but they're in different buckets as well, but fairly easy to find their price. Bulk commodities, these tend to be in different degrees of purity, so there's multiple prices for these. Minor metals, the market tends to be a lot more opaque, and there can be a larger contract market than spot market for them, which can throw off the spot market a bit. And then minor bulks, these are pretty challenging. They tend to be mostly private contract. Some of the things that we've been talking about here, here's the steelmaking raw materials. A lot of these are in the bulk commodity section. Yeah, they go as steel goes. They go as a bucket, as a general rule. Battery raw materials, obviously a lot of focus on these at the moment with the preponderance of people wanting to do more with batteries. Lithium price has obviously been extremely volatile. So this is what I was talking about, price visibility. Here's all the exchanges. If you don't have it on exchange, you can get it on one of the consultants. I think several of them are just outside. The specs, so LME copper is grade A copper cathode, minimum 99.99%. There is no traded market on an exchange for copper concentrate, for example. But we do know what TCRCs are, and we're going to talk about that in a minute. Premiums, so the difference between 62% iron ore and 66% iron ore, you could argue that that's a premium because you pay more to get more. And some people are willing to pay that premium. If the premium gets too small, you actually get less of the premium product. Or conversely, if the discount gets too small. So it's applied to the reference price, but it's inferior. It's one of those things where, you know, I don't need a polished piece of wood to put some decking underneath my car or put something on my car, but I do if I want to put like a finished wall section up or something like that. So the discounts apply to different quality, and people want different things for different reasons. This is really where the commodity analyst comes in. They have to balance top-down and bottom-up analysis. Top-down is kind of financial pub talk. You know, it's what's the GDP doing? What's the Chinese economy growing at? Where's construction going? What do you think about these data centers? How's electricity coming into the picture? Like I said, it's financial bar talk. It's wider thematic, and it does move trends. Like, I mean, to lack of a, you know, it is probably responsible, the top-down portion is probably responsible for more of the volatility. Bottom-up, and this is what we spend most of our time on at BMO, is detailed analysis of supply and demand trends. So for us, supply is pretty easy. We have 15 analysts covering most of the listed mines in the world. We have models. We know where they're going. We know when they're supposed to roll off. We got the supply side for most commodities, to be quite frank with you. Demand side, we have some consultants. We have, you know, there's some widely published data. We have that as well. And it comes out quite frequently in government publications. So generate alpha, bottom up is crucial, and there's a level of detail which generates less incremental return. So as our commodity analyst says, getting deep in the weeds is good, getting tangled in them isn't. So mine supply, that's what we spent the last 2.5 hours talking about. Then it goes to the smelter. Remember we were talking about the copper concentrate. So it goes to the smelters. If it goes to you could argue that a steel-making facility is a refinery for iron ore. You could argue that the potlines and those aluminium refineries fit this mold as well. So basically, intermediate product gets sold into here. It's not based on mine supply. It's based on what is usable today. Usable including inventory. Here's some of the interesting things that have been happening. As you might imagine, with the commodity prices going up, head grades are going down. Because stuff that we used to characterize as waste is now profitable as ore. That reduces our effective strip ratio. Because now that stuff that we thought was waste that we were going to have to put on the waste pile is paying for itself by going through the mill and generating revenue. And that's a function of price. It's also a function of better technology, but less so in this case. Where it is a function of better technology is this case. This is the power consumption to make a ton of aluminium. That's been getting better and better as people get more and more efficient at using electricity. Because the price of electricity, I mean, it's not like less people are using electricity these days. It just keeps going up, so people are getting better at using it for aluminium. But the next thing we know is that when we're saying that supply is inelastic, let's face it, if I was a palladium miner, here's your palladium supply. It's been bouncing around 6,500 ounces for, 6.5 million ounces for the last 10 years. Over that same time, palladium's done this. I mean, if I was a palladium miner, why wouldn't I just produce it all here when I made all the money from it? That'd be great. Doesn't work that way. You mine through the cycle. You can't easily shut down and restart a mine. Think of where you're going to get your workforce from. How are you going to re-engage the community that you've just shut down their general store? The hotel owners, the schools, the kids, everything. So the mine keeps chugging along. In the case of palladium, there hasn't been too much stockpiling, but in theory, a mine that is very profitable could stockpile a portion to push this bump a bit earlier, but the response to price spikes is extremely muted. I mean, realistically, what I find generally happens in this case, this gets people excited about building new palladium mines, so they finance them, which creates this, well, actually creates this low point from the last time it spiked up. So raw material constraints have the potential to drive prices. In this case, this is alumina. So if we don't have enough coming from the ground or enough scrap, which is an important factor as well, we have a potential raw material constraint. That's what happens. It turns out that in a tropical environment, it rains. And it tends to do that during the wet season, which is why metallurgical coal is always down in Queensland in December. I don't know why the market has not realized this, because it seems to move on it every time, but that's a supply disruption. There we are. So scrap is kind of an interesting thing. The one we have in here is gold recycling versus gold price. So this is the change in gold recycling. The example that I best like to use, though, is I was asked at the earlier session, how do we think of essentially shadow inventories in the world? So let's think of silver. In the mid-80s, silver, the price spiked. Do you have any idea how much of Grandma's silver service went to the local silver recycling place? There was hundreds of millions of ounces of silver coming out from essentially antique silverware that nobody would have counted as inventory because it was a family heirloom, until it wasn't, because grandson needed a Porsche, I guess. But this is gold recycling. Copper recycling is a common thematic. Obviously, you need steel recycling to have an electric arc furnace. But there's some trends here that are quite important, and the way that they've been sort of a secondary effect moving the markets in most commodities of late. So here's trade flow. This is what happens when you have the sanctions on Russian coal imports, and more trade flow here. So that can move markets as well. And here we go. Demand leads cycles and supply reacts. So this is going to be our worked case study here. This is going to be an example that seems to be at least controversial, so I'm sure we'll get some discussion going on this in a bit. But this is the copper demand from energy transition. So I think somebody was asking about electric vehicles before, renewables, charging infrastructure for your electric vehicles, storage. I guess we can add data centers to that now. Whole bunch of things here. You can see that the copper demand from just energy transition is expected to quadruple this decade from the beginning of the decade. So on that basis, I mean, it's not everything in copper, but we need, theoretically, that much more. So here we are, 2026. We need that much more mine supply, absent copper demand shrinking in other areas, which it doesn't seem to be doing. So the next slide, I'll actually go to this slide first. Where did it go? This. Actually, this one. No? I guess it's a fair way through. Never mind. I thought that was closer in the presentation. So the first thing that happens is obviously there won't be any where am I at? Yeah, there won't be any inventories, right? Mine supply isn't enough to keep up. Whatever inventory there is gets consumed by all this. So apparent consumption, real consumption. Apparent consumption moves the market, but real consumption is the inventory build. It comes in there. So by definition, inventories have dropped, the market's in deficit. It means that the mines aren't keeping up with the end producers. So this is why we talk about China, because it's such a large consumer of so many of the metals that we make. And you can see here, it's actually, China's share is actually going up, not down over the last decade. So Chinese floor space is China property, that's why people focus on China property, end use. Big portion of it, this drives the steel market pretty significantly. And this is one of the things I wanted to talk about here. Per GDP growth, look how much electricity it takes now. That's what's driving the copper story. Now, whether that's our EVs, our data centers, our just moving electricity around the world. The more people and the more things that we're doing, the more electricity we need, and it's at a higher level today than it has ever been before. Here's the amount of renewables that have been added, obviously important for the silver story. And the ETFs can be a form of inventory, particularly for gold. So central banks is another inventory of gold. And one of the other controversial things that we went through at the last session was one of the big drivers of the gold price is the de-dollarization trend that we expect to continue. It's not so much that gold is going to take over the US dollar as a reserve currency. In fact, I would say it's a very small part of that piece. All I'm saying is that as a reserve currency, the US dollar is shrinking in importance and everything else is growing in importance, but the US dollar market is so much bigger than everything else that every small thing that gets an incremental new flow, it gets exaggerated by the size of the market. So, you know, I'm not anticipating that I'm going to be going to a grocery store with a gold coin and buying groceries. I'm not anticipating that a car manufacturer is going to be talking to a steel manufacturer and paying in bars of gold. What I'm saying is that there are multiple customizable solutions for everybody, of which gold will be a portion. Now, there may be some renminbi plus gold, there may be some BRICS plus crypto, but whatever it is, because it's such a smaller amount than the US dollar, this is what I think has really driven the gold price. And you can see when we look at it in renminbi foreign related bank, that's the growth trend. So here's warehouse stocks, inventories. So over time, less and less it gets held on exchange. It becomes invisible to the market. You could argue that it's invisible to the market because it's in its end use. And arguably in its end use, it is scrap waiting to become inventory. Right now, I think it makes, well, she's saying it's bad for analysts. And nobody really wants to go on the exchange because nobody wants to know how desperate you are for copper or aluminium. But the next thing I wanted to get to is warehouse stocks, total reported stocks. It's always a matter of who's reporting and how much are they reporting. And here is your supply-demand model. So aluminium was in this much of a deficit, and now and then it sort of rebounded, and we expect it to go back into a deficit in 2028. Why do we expect aluminium to go into a deficit? I mean, people aren't going to drink that much more soft drink. They're going to use aluminium in more airplanes. No, what we're predicting here, and I'll get to this in a minute, is because of the bullish scenarios in place for copper, there almost inevitably comes some substitution for aluminium, and that is what we're predicting here. And you can see that. So this is our gauge of how much substitution you need. So when the copper price is 4 times as much as the aluminium price, we substitute. We substitute. Where are we now? We're in an area where we're getting close to substitution again. When it's down under 3 times, we'll just use copper, thank you very much. So this here is a longer term trend, but it does factor into many people's calculations. And this is kind of what everybody used to use. So 10 years ago, if I was presenting at a conference, we would be going through nauseatingly what these mines are, whether they're going to switch off, why this is my copper price forecast or my iron ore forecast or whatever, my 90% marginal cost. These costs are either going to come down because it's a ramp up or they're going to get switched off or whatever, and we'll be going agonizingly through these for every metal. There's a bit of on here about how to predict the costs or how to calculate the costs, but here, sort of the incentive price. So when do you bring on new mines? That's what we've been talking about this whole time. It's as much a function of costs as it is investor demand, and the underlying metal price shapes investor demand. So TCRCs, this is what I sell copper concentrate to a smelter for. Currently, negative. So what that means is there's not enough copper concentrate in the world. The smelters are desperate for that concentrate. They're paying you for it now instead of you paying them for it. Remember, they're converting your copper into, well, your copper concentrate into copper. And they're now doing it for better than free. It's because there's just no copper concentrate and everybody's so hungry for copper. It tends to self-solve, but that's kind of the weird situation we're in right now. I don't recall it ever happening. No.
Why is it happening now?
Because the copper demand is dramatically outstripping the mine supply, and the mine supply is what feeds this. So I'm actually going to get to that. And you can also see smelting capacity went up huge. So eventually smelters get shut down as well. Because this is unsustainable. I mean, imagine if you paid your customers to buy your cars and you were a car salesman. These are the margins. How are we doing for time? We're getting a bit tight. Zip through these in a bit. This is what we were talking about. Gains and losses shared through the value chain. You'd like the miners to make a margin, the smelters to make a margin, and the end users to make a margin. That dislocates. We've just seen a dislocation on the copper side. And on the zinc side, the miners are doing better. Just because there's so few zinc mines out there nowadays. This is the slide I wanted to get to. This slide has been in the market for probably 5 years. And there's always a bit of a surplus to a massive deficit. And that deficit has gotten smaller and moved out over the course of the last 5 years that I've seen this chart. It's because this is unsustainable. There's not enough inventory to cover this. This has to come from somewhere. So what do? We get better. We thrift. We don't use as much copper. Like those data centers, do they need all that copper wire? EVs, maybe we can do something a bit smarter, like use less copper. It gets too expensive, maybe we sell less EVs. So you have the price doing the demand destruction on the end product. You have the producers of the end product getting smarter with what they do with the inputs. And, I mean, do we need to have copper running all through our cities, or can we do that with aluminium? At these prices, you do it with aluminium. That's what we're talking about with the aluminium build-up. I can guarantee you this will not happen. Like, it can't happen. Where the copper price ends up as a result is the thing I can't tell you. Because if this can't happen, we either have to reduce demand through jacking the price, or we have to reduce demand through getting better with it, and who knows how much that's going to slow things down. So, final slide, I promise. So, commodity forecasting is an art as well as a science. Each commodity market is different, but they often trade together. Like we've seen, iron ore, metallurgical coal, they tend to trade together, absent some idiosyncrasies, but they move with steel and steel demand. Volatility is high due to supply and demand being price inelastic over the short to medium term. And when producers are making money, well, as you'd imagine, we talked about this in the permitting section, in the environmental section. If a company is in a nation where they are extracting the resources of that nation, the nation gets one chance to see those resources before they leave shore. That is their one chance to tax them and get revenue out of them before they're gone forever. When the producers have too much of a grin on their face, the government likes to wipe that grin off. And shareholders want more capital returns as well. And so do employees. In the long run, commodities trade above, this is, I think, self-evident. But the one thing to be aware of, that things do tend to work out over the long term, but it can take longer than your career. And don't rely on sell-side forecasts. So I guess she's done herself quite the disservice there. And forward curves are what it costs to buy something in the future, not a forecast of price. That is my final slide. I am open for questions if you guys want, or if you want to sneak out and see some of the rest of the exhibits, that's fine too. Thank you.
Could you go back to your point about cost curves and how popular a discussion point they were 5 years ago, just to explain a little bit more about why they're not a popular discussion point now, or why they've fallen out of fashion?
Well, I guess the simple answer is that over the long term, they still probably make sense, but we're so far divorced from them right now that, here we go. So it was always the 90th percentile. That was always how you fixed your long-term price. It incentivizes new supply, allows supply to roll off. That was where you were happy as a commodity analyst. On average, most commodity prices are trading somewhere around here. Like even the least profitable is still profitable in most commodities right now. Like you think gold, think copper, think even iron ore is doing pretty well right now. So the reason people don't talk about it is kind of the first point on my conclusion slide, because commodity analysts are always wrong. And they just don't want to highlight that by saying that, we'll get here eventually, but we're so far away from it. Let's put it this way. If we got back to the 90% cost curve of gold, I can go to every gold conference and talk to the crickets, because there won't be anybody there to listen to me. So the retracement to that, or more likely the cost increase to that, is what's going to be the long-term trend. But 10 years, 15 years, who knows? It would be a major shock to the commodity market if it immediately retraced to that 90% base.
This is regarding the rare earth elements. Why the world has failed to produce rare earths and only China is able to do that?
Sorry, I didn't quite catch all of that.
Rare earth elements are produced only by China.
Okay, rare earth, why are they only produced by China?
To cater the requirement, particularly the magnetizing material.
Yeah, so we can talk magnets, we can talk antimony, we can talk about a lot of things that, I would say the West, but I would say the rest of the world have just sort of abrogated to China. Because China has, very surprisingly to many people, China has a massive resource industry. We're not talking about secondary processing. They are, to this day, the world's largest primary producer of gold. They have significant copper properties. They have significant coal. They have significant resources. So they have an active mining industry and a high level of government sponsorship for growth. To do that, they've brought, a lot of smelting is done in China to this day. And when we're talking about rare earth elements, and we're talking about antimony, and we're talking about all those things, they're kind of seen as dirty industries in most of the rest of the world. So China does it for almost free, and it's only now that we're worried about China turning off the taps of those rare earth elements, of antimony, of those other ones, that we're worried about being able to get supply, that we're now starting to worry about refining capacity elsewhere in the world. So on that basis, it's not a price conversation. If it was a price conversation, we'd just leave China with it. If they were happy to sell it to us and we knew we could get it whenever we wanted it, we'd leave it the way it was. The problem is that there's a sovereignty now attached to that refining. So you need that refining capacity in-house because some of those products are necessary if we want to go to war with somebody else. And it doesn't matter what country you're in, you're going to have a source from somewhere that is friendly to your regime. Oh, sorry, I can't hear from back here.
The difficulty seems to be in the processing, not the mineral availability.
Oh, I mentioned during the presentation, you used to pay if you had too much antimony in your copper concentrate. It was a penalty element. The smelters had a hard time getting rid of antimony because it's bad for the environment. You had to pay to get rid of it. Now they're paying you because it's a byproduct credit. So things have switched. And a lot of it is because actually it's a price insensitivity to have sovereignty over the product.
I just had a question about smelting in sort of so-called ex-China jurisdictions. What's the sort of time frame, best case, worst case scenario for rolling out, massive smelting midstream capacity across all the metals you would describe, but mostly the minor metals?
So the minor metals are usually associated with major metals.
Yeah.
For example, if you have a nickel refinery, you've got a cobalt refinery. If you have a copper refinery, you often have a molybdenum refinery. All of those things go hand in hand. For probably too much information, my sister runs the Neostar smelter in Tennessee, which is being refurbished as we speak. $8.4 billion going into that. So she's quite happy. She's got a good capital budget in front of her now.
Are there 5 more like that being under development in the United States?
Yeah, but once again, do we need scandium? Do we need germanium in the quantities that these smelters can produce? Well, we could get it before. We just had to get it from China. So rolling it out is additional to existing smelter capacity more than segregated, standalone minor metal smelters.
It's just that relationship seems to have deteriorated so badly over the last 12 months and looks to continue to deteriorate, that those sorts of markets are getting tighter and tighter, and demand is getting higher, prices are getting higher. So it just seems like smelting is the most obvious route, especially the Neostar project.
Yep.
I mean, I'm just wondering how quickly can you bring those sorts of large-scale midstream projects?
That one's 3 years.
So 3 years from today. Yeah.
Yep. That's what they're forecasting, 3 years.
That's an existing smelter, though.
Yes. Yeah. So, but like I said, you don't make minor metal smelters. You add on. So, for example, at Bingham Canyon, which is actually where my sister used to work, they have their own smelter there, and her task was to get the moly circuit. It's mothballed. It's just sitting there.
Right.
So if you need moly, there's half a dozen plants that will just switch it back on. Right. No problem. If you need scandium, it's a little bit of a hydrometallurgical plant out the back of a lead smelter. Like, these things are
titanium dioxide, but it's also the sort of scale these markets are requiring. I think you said that they're relatively small. Well, they are very small, but the demand picture is much bigger. Would you not say?
The scare of demand is much bigger. Like I was talking about with the inventory. Like, you can't have negative inventory. Sure. I mean, if we stop firing missiles at each other, that's a decent inventory to leave where it is. So we won't need those magnets. We won't need that antimony for the blasting caps. That should be the inventory. Maybe that's a world peace story for another day. But nevertheless, the scare factor is if we start using the products, which are generally, the scare factor is that most of those things are products that are intrinsically useful for making war on another country. And that's where it becomes kind of diabolical. The rest of it, we need it for consumer this and consumer that. the growth rate versus the capability of particularly China, but other smelters as well, to be able to produce that stuff, the capex is like nominal. It's very little as a general rule.
Just hasn't happened yet.
Well, it's never had to happen because you don't want to have the back end byproducts of the environmental cleanup. Where if somebody else is willing to take that environmental externality, let them have it.
Just that I think that story's over. I don't think letting someone else do it any longer works. So there has to be some form of, new supply coming online through these smelters.
You can argue that many countries in the world have done themselves a disservice by letting go of all the intellectual IP of how to do this. Absolutely.
Another point, just the educational point, the IP.
Yeah. So, interesting times that we live in. Let's go with that. Oh.
Just one thing that modifies those demand curves. Back in the 90s when nickel was booming, they said that the amount of scrap, additional scrap that came on the market was the equivalent of 2 major mines coming into production. So the amount of scrap that comes back out when the price is high is phenomenal.
Yeah, it's the period between commissioning those new mines and the products of those new mines becoming scrap that makes the price surge. And like I said, I mean, I guess I'm an old man, but like I met my wife over an autoclave full of nickel laterite because we were getting ready to provide the nickel for that big boom back in '94. So, like, it surges, but only one of those mines ever made it into production out of those huge nickel laterite mines.
Yeah, I know what you, but the scrap can come much more quickly than a new mine, is what I'm saying.
All right, how long do you leave stainless steel up?
Sorry?
How long do you leave a stainless steel structure up? That's what's going to have to become scrap, right? That type of thing.
Yeah, but
I mean, there's other higher churn things, but the prediction was that we needed nickel for the economy of the 2000s. Well, it turns out we needed copper, and maybe it'll turn out that we need other things as well. But these things, they do go through cycles. But I can say that nickel hasn't been a happy hunting ground for commodity analysts in quite a while since then. Okay. Well, thanks very much for your time, everybody.